Well, good morning, dear students. So today you know that financial management marathon, but in this session I'm going to cover each and every important concept with respect to examination. So along with explanation, just I will give you some running notes. You better to make it a note, and this would be useful at the time of exam, because just once you refer what is the points. But here I'm not going to just tell or write the important concept. I will explain you the past 10 years question paper, and I will identify you which area is important, and at the same time, if the examiner, if you want to design a question paper for the coming exam, so what might be the strategy he is supposed to use. Simply financial management thinks about the future. The students you are learning financial management, you have to think about the future question paper also. Are you getting my point? That's why, right? Financial management. Before going to that, you have to understand our question paper first of all. He is our villain. The battle is going to be done with him. Even though if you put a lot of hard work, but whom you are going to fight if you don't know, then it would be waste. So financial management question paper is this. From the given chapters, he may ask 10 marks question. He may ask 5 marks question. He may ask what is it? Even the fill in the blanks. MCQs also we can expect. But the previous pattern is different. Now latest pattern is different. But either it may be a difficult or easy. But one thing is confirmed. That is the paper is lengthy. Unless until you don't have much practice, right, within the given time period, you cannot handle it. It is one of the best fact you have to understand. And the thing is, once you learn a capital budgeting, suppose first chapter, don't expect that the question would be expected only from that chapter. He may merge 2 chapters. He may merge 2 questions from the same chapter. So that is his pattern, right? Once you make it an analysis of all this question paper, and you can make it, and I told you that question paper always, what is it? Lengthy, right? 10 marks question would be there, 5 would be there, even MCQs also, right? Meanwhile, shall we start? Take your notes, get ready. Make a promise that ab nahi to, this year, if I won't clear means, in my jindagi mein, nahi kar pata. No, that's meaning is that you have to put your best efforts, right? The first one is, what is the most, while observing this past 10 years question paper, from my observation is, they've been asking the 2 important theory questions, okay? What is the 3 important theory questions? What is the financial management? What are the functions? What are the decisions? Absolutely a 2 marks question. So what you write is, what is first of all, introduction to financial management. So this is not just because of having experience in teaching, I'm explaining, because you people are invested not only money, your time, particularly when examination is getting closer, spending one day, I know that its importance. That is the reason, instead of just giving the theory summary, right, I gone with the past exam question paper, I made certain strategy. With that strategy, I am giving this information. See, financial management. Let me have an idea about what is the financial management. This is an introduction. Financial management is simply a systematic management of, what is that? Business finance. Financial management is a simply systematic management of business finance. It includes, what are they? It is an what activity? Managerial activity. Managerial activity which is concerned with planning and controlling of financial resources. That means indirectly you have to take, what is that? Decision. So now tell me, a financial management, when you are in the decision making situation, are you being top level or middle level or lower level? Decisions, top level. That means financial management is a task of whom? Top level managers. Okay, so here by considering this, what we can identify is, number 1, financial management is a, management is the 2 things you analyzed. What is it? It is a planning and what is it? Controlling. Planning and controlling of what resources? Financial resources of the company. Okay. Now tell me, when it is the financial resources of the company, right, is it a top level tasker? It is a top level management task. Management task. Okay, this is the top level management task. Simply, it is a management of what finance? Business finance. So what exactly it takes is it identifies how much finance is needed, how much that finance should be raised, how that finance should be properly utilized, and finally how the benefit to be generated, how this fund should be properly utilized. This is the only task. Once you are a manager of any company, right, if you have a skill to handle your financial resources, all other management would be under your control. So that's the financial management, is a planning and controlling of financial resources of the company. So this is the first part. Then what are the basic functions? Several times they asked, from the past 10 years, they asked this question is regularly. What are the functions of financial management? Now, you can come. You're writing, right? You better follow, involve, LICO, right? Just it is a listening means already it is over. But now you have to understand in fastest mode, okay? Now, tell me, what are the various functions of financial manager? Functions of financial management. See, any corporate company, this question may be asked for 2 marks. What is this? Financial management. This may be asked for 4 marks. Okay? Financial management functions, there are only basic 2 functions, dear students. One is, what is that? Procurement of funds. Procurement of funds. Here, and procurement of funds means what? Here you see, there are 2 major functions. Are you getting? What are they? One is procurement of funds, another one is utilization of funds. What a procurement means, how much funds you needed, you have to raise these funds by considering, what is that? Cost, risk, control. Another one is, what is it? Government rules and regulations. So in procurement of funds, you have to consider 4 important tasks. What is this? 4 important tasks. One is, what is that? You have to consider risk. Another one is you have to control cost. You have to identify cost. And another one is you have to control. Control means ownership rights. Another last one is government rules and regulations. There is a CM, Delhi CM is now in the near to Tihar jail. There is one of the daughter of ex CM now in Tihar jail. Because they couldn't made any murder, but they done some financial transaction beyond rules and regulations of what? Government. Even though the procurement of skill is wonderful, but you don't know the government rules and regulations, you would be sent to Tihar. This is a procurement. What is the procurement of funds means? Raising of funds from various sources. Okay, either it may be long term or short term sources, or both. You may raise the funds. Second one is, whatever the funds you will raise, you should make, what is it? Utilization of funds. Utilization of funds means you should not keep fund idle. That means you can say, sorry, finance it. Idle not. Idle not means the fund should not be kept idly. Okay, so you have to utilize these funds. You must generate, what is that? Return. That return should be greater than cost. That is the lines I gathered this one from CA Institute new study material. What they saying, funds, what is the utilization of funds means, dear students, you have to understand, you have to invest on what assets? You have to invest on fixed asset and current assets. You must generate return. That return should be greater than cost to be paid. This is the one important question you may cover in coming exam. Okay, this is the procurement of funds. Another point is, what are they? Second one, they are being asking from this, decisions of financial management. This is the repeated mode they've been asking for 4 marks. What are the decisions of financial management? Now, decisions of financial management means, you see, we are discussing decisions of financial management. Decisions of financial management means 3. There we wrote what? 4. Kya sir 4? In procurement of funds, you can understand functions means 2 only, right? Procurement, utilization. Coming to decisions, it would be 4 marks. They will ask you 3 concepts. You have to keep it in mind. What are the decisions? Number 1, financing decision. First, a company has to raise the funds from various sources. For that various sources, it has to consider what are the sources. Sources you may see long term, short term. Okay, by considering risk, cost, control and everything. But the financing decision means it has to raise the funds from various long term sources, short term sources. The finally cost should be very, very low. So that is an important point. See, financing decision indicates rising of required funds at what cost? Least cost. Investment decision means whatever the funds you raised, you have to invest. Okay, invest on the asset and you must generate what is it? R to be greater than cost. Okay, that is another one is what decision? Investment decision. Investment decision. I brought this pages 350 pages. I will make you to write 350 pages. Along with you, I will also write. Are you getting my point? I am not lazy. Okay, I am crazy about the financial management. And at the same time, if you have dare enough, and the total, how many slides I made it? Are dekho re 728 after completion of this. What ma? Total, if you complete, this is a summary means at any cost, including question paper. Yes or no? If you put this much of efforts, a failure will touch ra. If it touches, it gets blast ho jayega. Right. So this is the another important point. What Maji? Investment decision. What is the investment decision? The funds whatever you raised, you have to keep idly with you. Yes or no? What you have to do? You have to invest. Where you have to invest? What the financial management says, you have invest either fixed asset, current assets, but wherever you will invest, sir. But you must generate what, sir? Yeah. So you must generate. Idle not, already I told you, right? You can write one more point. So we should not, idle not is one point, and we should generate what is that? Return that should be greater than cost. This point is enough. You can write comfortably in public exam. And third one is what is that? Once you generate a return, dear students, more your cost means surplus funds lies in your hand. So what to do with that? You have to provide a reasonable dividend policy. You have to maintain proper dividend policy. Dividend policy, it is another important function. If you won't maintain the dividend policy properly, automatically you cannot create the wealth. In such a case, dividend decision means dividend decision. What to means? It will happens only when you take effectively what decision? Financing decision, investment decision effectively, then only you will get a chance to do which decision? Dividend decision. When R is greater than C, you have a surplus. Then only you will have, when your R equal to C? No. When R is less than C, Gaya. Are you getting? So that's why dividend decision will only come when R is greater than C, cost. Okay. But what to do means you have to consider by considering your reinvestment opportunity. What is that? Reinvestment. If you retain these funds, somewhere you will invest, right? By considering this reinvestment opportunities, what happened? So whatever the profit you made it, this profit what to do means there is a two questions will arises. What to do? Should I do R? Should I do div? What is a D? Dividend, paying a dividend, or else should I retain? That depends upon what is it? Opportunities. I don't have any reinvestment opportunity. Better to give it whom? Shareholders. Are you getting? But once you have a wonderful opportunities are there, then better to retain and reinvest. Clear? So these are the two important concepts being asking over the period of 5. Wherever in the question paper any question is complicated, then better to concentrate this question. One more question is there because of lacking of time, I'm not saying here. That is objectives of financial management. What are they? Objectives. This is another important point is objectives of what is it? Financial management. Financial management. What are the financial management objects? You can consider two types. What are they? One is what objective? Profit maximization. Another one is what is that? Wealth maximization. Wealth maximization. Profit maximization objective means at any cost company has to make what? Profit. Okay, wealth maximization means you have to take a decision in such a way that whatever the profit you made it, how to provide a dividend or how to return, how to take a decision, all the aspects is nothing comes under category of what is it? Wealth maximization. See, profit maximization is a narrow objective, small objective. Wealth maximization is wider objective. Which objective is part and parcel of which object, you know? Well, profit maximization is a part of wealth maximization. These are the three important questions, dear students, right? The next one you have is nothing but time value of money chapter. Clear now? Three important. Any of the question is very tough. These three questions will save you. Either they may ask you decision, either they may ask you objectives, and either they may ask you, yeah. Coming to time value of money. Time value of money is not such an important chapter in financial management directly. But whereas cost of capital, dividend decision, investment decision, yes or no, advanced concept in investment decision, all the chapters, core elements is based on this chapter. So that's why you must understand this chapter. You must understand its tables. Unless until you don't get this command over this concept, right? Even if I explain what is IRR means, you will see my face in a different way. Okay, that is first a time value of money, right? Put it hardly, I won't take much time for this because this first chapter what I discussed is very, very important for your examination purpose. Coming to this is not directly, it is what? An indirect. So what is this unit number 2? This is at second we are taking, what is that, ma? Time value of money. See, time value of money, what is the idea of this one is? See, time value of money, you can say, what principle it is? Simply you should understand, it is a basic principle. Whatever the decisions used to learn the financial management, everything is based on this. All the financial management decisions are based on this. What it speaks about, a rupee today is worth more than rupee to be earned in future. So it means that indirectly you can convey, see, today you have a 1 rupee, in end of the period also you have a 1 rupee. Both are same? Huh? No, from the currency point of view, both are same. But the money finance purchasing capacity point of view, both are not same. So indirectly you are a businessman, you invest in a business, you start in a business or you deposit in a bank. Today you deposited how much? 10 lakhs. After 10 years, if bank gives you same amount, will you take it? No. Sir, say you deposited how much? 10 lakhs, sir. Same bank will provide you 10 lakhs at the end of the period. Why can't I say yes? It's no. Because, you know, you are checking what value? Currency value. But you have to consider what is that? Purchasing capacity value. Because a rupee today never be equal to rupee to be earned in future. What is the reasons? But you see, there is a simple logic. If you go to the temple, you leave the 2 slippers, right? After 1 hour, if you come, if you will ask a small slipper? If you deposit 2 lakhs in a bank, after 2 years, will I ask same 2 lakhs or more than 2 lakhs? If I go to temple, if I leave my 2 slippers, will I ask additional slipper? Sir. Will you ask it? But that logic could not be applicable in everywhere. But here the thing is, there are the 4 reasons why present rupee is always worthable. Now tell me, what is the time value of money? Yeah, it is TVM is the one of the basic principles, sir. Okay. So there is no direct question from your material. But why I should learn, sir? Because this principle gives base to all the financial management decisions. Either financial management decisions. What are the various financial management decisions? Tell me, how many decisions? 3 decisions, Maji. Financing decision, investment decision, dividend decision. If you don't know time value of money, believe that the 3 decisions you cannot take it. Are you getting? So very, very important. Now tell me, what is the time value money indicates? TVM indicates that what it conveys, rupee today is not equals to rupee of tomorrow. Simple. You try to understand, today you have a 1 rupee. This 1 rupee after 10 years, you have a 1 rupee means both are not same. For the sake of purchasing capacity point of view, both are not different. Right? Sir, only this is the Only in this concept, entire financial management decisions are based on how funny it is. Not funny, ra. You try to understand. You take investment decision. What, Maji? If you, sir, in charge garu, volume ఉంది పెంచండి. See, what it indicates, if you make investment decision, hello, if you are investing in 1 lakh in a business, after for 10 years, if the same business gives you 1 lakh, will you take it? You should not take. Why should same 1 lakh you are giving, no. This 1 lakh is not equals to 1 lakh rupee to be earned in future. Once you know time value of money, then only you will start to debate. Otherwise, what happen, you will take it. But if the company, if you invest 1 lakh, that company gives you 90,000, then 90,000 it is giving means you won't take, and at the same time you have a great perception about the company. Yes or no? Great or worst? Worst. Arey idiot, what you are doing during the year? You have taken decision? Yes sir. You are top class managers? Yes sir. Take a glass of water, jump and made a suicide. Arey, don't you know the one chapter? You are taken financing decision, investment decision, dividend decision. But the thing is, you don't know one concept. What is that? Time value of money. Without knowing this, if you take a decision, it is not at all called decisions. Are you getting? So that's the reason you have to understand the time value of money well. So whenever you will invest in a business, that business should not give the same return to you. It has to give some additional benefit. Are you getting? Some addition should be get it. That addition is called time value of money. If you invest your money in bank, what to do? If you invest in a bank, you should expect interest. If you do business, what do you expect? Profit. Okay, this is the basic idea for this chapter. So whenever you will invest, you must expect a profit. If the same amount gives you, will you take it? Will you take it? No. Can you tell me why present rupee is always worthable than future one? Means you must know that reasons why present rupee is valuable or worthable. There is 4 reasons we can say. Number 1, no inflation impact. Do you agree? No inflation impact. Number 2, no inflation impact we can say. Another one is no inflation impact means today I have a 1 lakh rupee. How many things I can buy today? In future I cannot buy. Because if I take any amount in future, there is a certainly what impact? Inflation impact. That's why present rupee don't have what impact? Inflation impact. Another one is opportunity benefit. What is that? Opportunity cost benefit. That is, if you take money today or if you have money today, this money you can invest here and there and you may get what? Opportunity cost benefit. If you take the money in future money means you cannot take what? An opportunity. You cannot enjoy that opportunity. That is the reason which rupee to be preferred? Present rupee is preferred. Another one is risk of uncertainty. If you take money today, what is not there? No risk of uncertainty. But if you prefer future, certainly there would be a risk. Are you getting my point, ma? So another one is, what is that? Preference for present consumption. See, any individual in the market, they want to spend their money when? Now. They want to use this money and they want to solve their wants and they have to get the satisfaction now itself. But if you depends upon future, right, automatically you have to do more sacrifice. So that's why each and every person will prefer which rupee? Present rupee. Why? Because to spend that money today and to solve their wants as on today. At the age of 95, what is the use to see the Colgate gel ad? Hello? At the age of 95, what is the use of see Colgate gel? The KFC person got an idea at 85 years to prepare a chicken. But at the time, he cannot eat the chicken. Arey man, when you have a wonderful idea to prepare a chicken recipe, but you are unable to eat, what is your idea? Is it a great idea, Sedji? It's a great idea to the public, not for you. Are you getting? So that's why when you have an identity, you have to spend. Are you getting my point? Yeah, these are the reasons. But in time value of money, basing on this, in time value of money, we should understand 2 concepts, ma. One is discounting. Another one is compounding. The students, what is a discounting? Discounting means deducting. Compounding means adding. Whatever the future value you given, to find it out its present worth as on today, you must know what value? Discounting. Discounting indirectly, what is that? Deduct. Compounding means what is that? Add. Okay. In present, what happened? Where I should use this discounting technique, I will tell you. Investment decision is there. Hello. You have to take an investment decision. Investment decision, entire capital budgeting, 22 problems are given. What is this idea for this? If you invest some amount, they will give you in future. Will you compare both? Would be same? No, you should not compare. What you must learn, what is that? Time value of money. So if someone asking you that deposit this amount, I will give you, that means you should not blindly say yes. What you have to do, you have to understand time value of money. Whatever the amount you are going to get it in future, you have to bring into present. So investment decision plays very, very important. In cost of capital chapter, I want to purchase a debenture. Okay. When I want to purchase a debenture means, today I am going to make investment, but if I purchase debenture, I am going to get the benefit in future. But the future rupee, present rupee is not equal. I must learn the time value of money. To understand the fair value of debenture, whatever the interest and benefits I supposed to get it in future, I have to bring into present. A company, dividend decision, a company says, invest in my company, I will give you the given percentage rate of interest. So after 5 years, he will give you 5 rupees of dividend, means I should understand for my investment, he is giving after 5 years, means if I bring into that rupee today is nothing but 1 rupee. It is a negligible amount. I don't make investment. If I want to understand the subject in such a level, what I do means I should understand which one? Time value of money effectively. So what is the discounting means? Deducting. To know the present worth, what happened? We should understand discounting first, particularly. What is that? Discounting. Here you will discount single cash inflow. What is that? Single cash inflow you have, and a series of cash inflow also you have. Here, this is, you see, in our material, let's come to here, single cash inflow. Single cash inflow, if you want to find it out, here two concepts are given. One is, what is that? Calculation of future value. Future value means, will you do compounding or discounting? What, Maji? Just only I told you. Compounding. Present value? Discounting. Whenever single cash inflows are there, to bring into present, what you do means, you have to find it out. Here in compounding, discounting and compounding is there. How to find single cash flows? What value? Future value. For finding single cash inflow future value, what to do? Future value equal to, you use this formula. What is this? Future value equal to present value into future value factor R percentage n number of years. Sir, where should I find future value factor, sir? So table number 1 will support you. Hello? This table, if you learn this future value, what will understand means, where you can use your funds. You have a funds, you have a multiple banks, where you can utilize. It guides where given funds should be used. Given funds must be utilized. I have a 10 lakhs rupee, Majai. Okay, I have a 10 lakhs rupees. You are a chart accountant. I came to your office and I want to hold this money for the 10 years. I will ask you, tell me which bank would be where I should invest. Where I should invest means simply what you will do. You will take my present value. Yes or no? You will take my present value. You will calculate what value? Future value. You will calculate future value. In which bank future value is more, you will recommend that bank. So for calculation of future value, simple logic. What you have to do? Future value equal to present value into future value factor R percentage n number of years. Dear students, one more point I would like to tell you. This future value depends upon 3 important factors. Number 1, how much present value you are depositing, and what rate you are depositing, and what number of years you are holding. Yes or no? And another one is, what about the compounding pattern? So compounding may be done. What is that? Compounding may be done monthly, annually, quarterly, right? Future value depends upon this concept on 4 aspects. What are they? One is how much you supposed to deposit, at what rate you supposed to deposit, how many years you supposed to hold, and at the same time compounding pattern. Okay, this is the future value single amount. Coming to, there is a one more point is there for coming to future value of single amount. Okay, future value single amount. Thereafter you have, what is that? Present value of single amount. Present value of single amount, how do you calculate? I will tell you. Future value of single amount formula, future value into present value in future value factor, R percentage. Yeah, similar to, you have a single future cash inflow, and here coming to present value of single amount. Present value equal to future value into present value factor, R percentage, n number of years. Which table supports you? Table number 3. What is that? Table number 3. This present value also be calculated like this. It is a reciprocal of which value? Future value. So present value equal to 1 divided by, what is it? Future value factor. Or you can reciprocal of what value you can say? Reciprocal of which value? Future value. Simply you reciprocate, you will get the present value. If you know the present value guides you that how much to be invested. But if you learn present value, what we will learn? Where to be invested. Okay. Now you clear about the future value formulas? Just you have the idea about what is the future value, what is the present value, what is the future value factor. Now tell me future value single amount formula. Present value into future value factor, R percentage, n number of years. What about the present value? Yeah. So here my observation with respect to this one, right? Let us come to, if it is how do you calculate the future value means, suppose you see here, I take a small example in order to make you to give this one. The formulas, everything. Future value depends upon compounding pattern also. Yes or no? Simple is whenever you want to calculate, suppose if you deposit 1000 today at a 12% rate of interest, annually compounding, if you wait for 4 years and 6 years, how much this value would be? Future value equal to present value into future value factor, R percentage, n number of years. Similar to present value also. Present value equal to future value into present value factor, R percentage, n number of years. Thereafter, you have one more topic is finding future value of annuity. What is that? Future value of annuity. Annuity means multiple equal cash inflow. What is that? Multiple equal cash inflow. When same cash inflow generates over the period to bring into present, what is the technique we will use? What is it? Future value of annuity. Very simple. Future value of annuity equal to whatever the cash inflow regularly you will get, it is called what? Periodic payment. So periodic payment into future value of annuity factor, R percentage, n number of years. So where you will find the future value of annuity means, so table number 2 you will find it out. Table number 2. So it means that every year same cash inflow you used to get it in future, and to bring this total cash inflow, if you invest here every year, what happened? You used to get, what is that? Same. By making investment here, you are going to invest here. For first year you will invest, second year, third year and fourth year. Every year by investing, how much value you are going to get, it is called, what is that? Future value of annuity. And this would be called, every year you supposed to make investment, it is called periodic payment. So future value of annuity equal to, what is the calculation? Periodic payment into future value of annuity factor, R percentage, n number of years. Similar to that, you have one more topic is called present value of annuity. Present value of annuity, what it indicates? Periodic payment into present value annuity factor, R percentage, n number of years. Where should we get this present value of annuity factor? That you are going to get it, the table number 4. Table number 4. what this indirectly conveys, you are going to get the same amount over the period of how many years? 4 years. First year, second year, third year, second year, third year, and fourth year. Every year, same cash inflow you are getting means to bring it into present. So whatever the value you are going to get it as on today is called, what is it? Present value of annuity. Particularly for investment decision, in future we used to get the same amount over the period of given number of years. If someone will ask you, so how much you are going to deposit means, what you have to say? Will you sum it up that value? No, you should not sum it up. What you have to do? You have to bring it into present and you have to sum it up. In order to do that one, so which table will support you means present value annuity factor will support you. What is annuity? What is annuity? Annuity indicates annuity. Keep it in word. Annuity is nothing but multiple equal cash inflows. Multiple equal cash inflows. So every year same cash inflow generates over the period, then it is called annuity. Somebody will assure you that I will give you 1 lakh, 1 lakh, 1 lakh, 1 lakh over the period of 1 lakh. 4 years, try to deposit means just 4 lakh 90, 3 lakh 90,000 means you should not consider that your investment is 3 lakh 90. For that purpose, they are giving 4 lakhs every year, but they are giving in future. What you have to do? You have to bring it into present. For that purpose, present value of annuity will support you. Thereafter, one more topic also you should understand, that is a few present value of perpetuity. What is that? Present value of perpetuity. Perpetuity indicates, perpetuity is nothing but an infinite cash inflow. What is that? Perpetuity is an infinite cash flows. Wherever the cash flows will generate over the period of long period, that is called perpetuity. You know the Puttaparthi group of organization, regularly I used to say in class, when Puttaparthi Sai Baba was there, at the time devotees used to go and give the donations and they used to run the organization. Now no more Babaji, but how much annual cash is required in the early of his pass out? What happened? They made it an annuity. They went to the bank and made a deposit, and they've been getting certain interest amount over the period, and this amount they are going to get it forever. So forever equal cash inflow you are going to get it is called, what is that? Perpetuity. How do you calculate the present value of perpetuity means? The formula is simple. What is this? Cash flows divided by rate. Cash flows divided by rate. This is, if you deposit certain amount here, what happened? It is going to give you same amount over the period of forever. Forever you are going to get it. This is the present value of perpetuity. But there is a one more concept is there. Another one is, last one is present value of growing perpetuity. PV of what perpetuity? Growing perpetuity. Growing perpetuity is very, very sophisticated one comparing to which perpetuity? Normal perpetuity, because it considers inflation impact. It considers inflation. So that is the reason it considers inflation. Indirectly what it conveys, if you deposit this amount here, okay, every year you are going to get the cash flows over the period, but it increases. Such a incremental oriented cash inflow you are going to get it forever. Such a cash flows are called, what is that? Such growing cash flows. In order to get such a cash inflow, how much amount to be deposited is called what perpetuity? Growing perpetuity. So present value, how do you calculate present value of growing perpetuity? Perpetuity equal to, how do you calculate? Cash flows divided by rate minus growth rate. But here condition is, growth rate is always less than what is that? A rate of interest. This is the concept, right? So dear students, with this time value of money is very important. Even while teaching 9 hours of financial management, at least half an hour I should allocate time value of money, because I told you time value money is a basic chapter wherever I will explain IRR. If you feel that sir IRR is not getting connected means not IRR getting connected, you don't know the time value of money. Sir NPV is समझ नहीं आ रहा है सर. टाइम वैल्यू, जब बालू सर टाइम वैल्यू एक्सप्लेन कर रहा था ना, क्या कर रहा था तू? ఏం చేస్తున్నావు బే? Once you have an attention of time value of money, you have command over this one, right? Tell me, future value of single amount formula. Which table supports? Table number 1. Present value of annuity formula. Present value of annuity formula. You first, if I ask you future value, immediately they have guess. Balu sir will ask you present value, right? I'm not a same bowler. I'm a too talented. Tell me, present value of annuity equal to periodic payment into, yeah. Balu sir, do you have a reason why present rupee is always worthable? 4 reasons. Inflation impact, opportunity cost, risk of uncertainty, and yeah. So present value of growing perpetuity, present value of normal perpetuity, which is the best one? Growing perpetuity is the best one because it considers which one? Inflation impact. But normal perpetuity could not consider. Okay, right. With this, we completed the 2 areas. What are they? One is a introduction part of financial management we completed. Another one is time value of money, right? But because if I go with this problem, our time would not be sufficient, right? Then we will take Mahabharat. Can you guess it? Which chapter it is? Yeah, capital budgeting. Capital budgeting, 10 marks chapter. If you are clear with respect to this chapter, this year no need to spend to pass. This attempt is sufficient, man. पास होता रहो लेदा अब नहीं तो कभी नहीं. This attempt at any cost, sir, I have to get cleared at any cost. That is called, what is that? Capital budgeting. Capital budgeting, it indicates, see, one more thing, let me tell you, the few concepts, I made it all these things because of time is not sufficient. Future value of annuity, formula Maji? 1 minute. Annuity is being classified into how many types? 21 types, yes or no? Very good, 2 types. What are they? Future value of annuity, present value of annuity. Future value of annuity formula? Periodic payment into future value of annuity factor, R percentage, n number of years. Present value of annuity, someone will pay later, but I have to invest now. How should I solve this issue? By learning which one? Present value of annuity. Present value of annuity formula? Periodic payment into present value of annuity factor, R percentage, n number of years. Associated problem. Then perpetuity means equal or unequal cash inflow? Perpetuity, equal cash flow over the period of forever. That is nothing but its present value is called what? Present value of ordinary perpetuity, present value of growing perpetuity. Which perpetuity you will prefer? Can you tell the reason? Inflation. Ordinary perpetuity, okay, you are going to get it, but long run you cannot get it, right ma? That is the problem associated with this also. Next you have capital budgeting. Come on, make it note. So total capital budgeting. Capital budgeting exactly 11:10, 1 hour exclusive I will spend because we started the class at 9. Half an hour introduction, time value of money is spent. Capital budgeting 1, cost of capital, leverages. Before lunch I will complete this. After lunch again Mahabharat 2. Bahubali first part, you know that 2 session. Bahubali first is capital budgeting. Bahubali 2 is working capital management. That's enough. If you are good at before breakfast, after lunch, I will give you gift this year. What is it? Financial management. What ra? Anukora, feel avalaga. Arey, this results వచ్చేసింది, discount చే results ని. When you are going to get the results? Future ra, discounted. You see, visualize it. Yes, pass हो गया बच्चा. చెప్పు మమ్మీకి రోజే. Okay. Alright, capital budgeting. Let us have this is our material. I will tell you the secret how to attend. You people attended right in this class, right? You have to understand certain logic, I will tell you. But regularly I used to say This is from 2018 to, while preparing this material, 2018 to 2023 we sat with the faculty members. We made it analysis. From capital budgeting, which area they been asking. You try to understand, surprisingly, they are concentrating only one topic. What is that? NPV. This is exclusive of financing cost is also here. What is that? This is here actually. So this is also NPV. That means if you are good at NPV, you can solve any of the problem. Question. Second one, if you observe another strategy, they've been asking what is that? Comprehensive model. This missing model they will ask you. This missing model also composition of which one? NPV. Capital rationing also part and parcel of which one? Indirectly NPV. That is only two models they've been asking. One is NPV, another one is comprehensive problem. Comprehensive model means you must have an idea about all the methods. But you must have a specialized knowledge with respect to one method. Which one? NPV. This is the story. That's enough. You are spending a lot of your time unproductively. It is a waste. But have an idea about each and every concept. See, you are the students. You never be called good only if you write 100% presentation to the question paper. But you would be called good only if you clear 100% pass. The thing is, don't run behind all the areas. Concentrate about what is the most important. It is not my opinion. Just this is an investigation we've done. From this, we've been identifying. Okay. Now, let us basing on this, let's move to what are the various methods of capital budgeting. Very simple. What is the meaning of capital budgeting? Yeah, simply it is an long-term capital budgeting means capital budgeting is an long-term investment planning. It is just planning. It is not a regular action, dear students. It is a long-term investment planning. But here investment means not a current assets. It concentrates what asset? Only a fixed asset. Fixed asset. So to make a investment on what assets? A fixed asset, you need a plan. That plan you can make effectively, then only it should be possible. Sir, without a plan, if I make investment, what will happen? Disaster will take place. What is that? Disaster will take place, because investing is a long-term project. Involves small amount or huge amount. What? That includes what is that? Huge amount. You can say huge amount also, or you can say substantial expenditure. Substantial. Marasnara? Liko. Once you are writing means it is registered here. Okay. People may take your watches, your chains, your dress also even, but your knowledge never be. That's why once you are writing means you are injecting the subject. Total 8 chapters. But it would be very, very hard in your life before, at least very close to examination also, you never write like this. Will you write? No. But here you are getting a chance this day. Likh pura. Pura. Ink aiponi, pen aiponi. Huge amount. It is also called substantial expenditure. Substantial means what? More. Huge. Since it is a more, you need to learn what is that? Capital budgeting. Second one is, it is a irreversible. What is that? Irreversible. Irreversible. Irreversible in nature. That would be the another important point. Another one is basically investment on what decision? Investment on fixed asset is a complex decision. What decision? Complex decision. And at the same time, it influences long run effect. Okay. Now let's have my idea with respect to this. This is one of the restaurants they constructed in Israel. You see how much big it is. See here the car. కనిపిస్తుందిరా ఇది కార్ పక్కన ఇక్కడ ఉన్నాడు ఒకడు. నా హైట్కి అయితే నేను ఎక్కడుంటా నాకు కూడా తెలియదు. ఓకే, దిస్ ఇస్ ద సచ్ ఏ బిగ్గెస్ట్. How they used to make investment in this project? So that much bigger. Where's a car? Here ra. Where you sir? Here ra. Inga parda angergada nanu. Such a biggest restaurant they constructed. Where it is? In Dubai not. Then this is the story, regularly I showed. This is the Palm Island. By filling the ocean, they constructed apartment with the swimming pool. Arey bachcha, idhar se idhar aaya to idhar pani hai re. Why you are? Because they want to make. Are who is going to buy rack? Why you are making investment? Why you are making time means you try to understand. If it is a long shot, this would be. This is their plan. Try to understand how much their investment is, how much their cost, how much the profit, how long they will get it, what is the tax, what is the cash inflow, what is the matter of depreciation, what is the risk element. What about our Polavaram? किधर है रे? बहुत प्रशांतम रहे, बहुत प्रशांतम है. You don't worry, you don't have a chance. Your kids become CA, then only they will complete that one. So such a situation, you see, this is the closest. This building here, this closest building would be like this much building. This is not in Bradipet Center, okay, ma'am. It is a deep ocean. By filling that ocean, they constructed apartment, they are selling. If you see, you will get the laugh. Okay, but try to understand this much of efforts they have taken means this man is getting shocked. Apartment this is a Hindustan Times. There is an article said one apartment they sold for 677 crores. Yes, that means it is a worthable. What Maji? How many apartments you see here? These many apartments. So that is the reason they made it investment. Here this is a new another restaurant they are going to plan. It is called Moon Restaurant in planning Dubai. You try to understand once lights are getting on, right? No need for moon for Dubai. Hello. Dubai ko moon nahi chahiye because once lights are getting on, try to understand what about this one. So such a restaurants they've been constructing. What about, again question, what about investment? What about the profit? What about the tax? What about the cash inflow? Whether it is worthable or not. How they do? They will come to your office and you have to make a plan. And if you say, banker, investor, customer, all other people could get shocked. Oh my God, how ra? For that purpose, what to learn? One chapter. What is it? Capital budgeting. Generally the people, those people who couldn't attend this class, they will think then how they do this so. Very simple. They do because of, what is that? By learning concept called what? Capital budgeting. Now tell me, capital budgeting is a long term or short term? Long term. It will convey how to invest on what asset? How much to invest? Yes or no? Whether it is worthable to invest or not. Example for this capital budgeting. See, madam, how is she looking? So investment on land and machinery, factory building, new business, everything comes under this category. Now coming to what is the importance? Substantial expenditure, long period, irreversibility, complex decision. So what is a capital budgeting means? I will tell you, a capital budgeting, such a subject, right? In capital budgeting, dear students, make it note, this is very important point. Capital budgeting means it is a combination of various methods, dear students. That means you must learn what are they? Various methods. Agar methods nahi na aaya, gaya. क्या गया रे? Methods you have to learn, right? Methods means I will tell you methods 2 and 4. How many methods? 2 and 4. 2 methods. It is there in your material. While going on writing methods, we will lose our time. But you have to remember this is a 2 and here is 4. After methods, each method has its own calculation. Each method need what? Its own calculation. To do calculation, you must understand what is that? Formula. While using these methods and calculation, sometimes you have to take certain assumptions. You have to take assumptions. And you have to follow certain times, what is that? Conditions. These are the very, very important point. Now tell me, learning capital budgeting means you are not learning what? Just simply line. You are learning what? Methods. Each method has its own calculation. Each calculation required formula. If you don't know the formula, means gone. End of this class, I will ask you all the formula, including time value of money. Hello? So formula, before going to understand formula, you must know methods. Are you getting? Methods required calculation, calculate required formula, formula calculation required assumption, and along with that you have to follow conditions. Now come to our material also. In mastermind material, they have given what are the certain running way we used to consider. Here they given a techniques. What Maji? Techniques means methods. So here 2 methods. What are they? ARR, payback period. Whereas here 4, 2 plus 4. net present value, profitability index, internal rate of return, discounted payback period. The same concept I projected in this way. You see, methods of capital budgeting. Here it is 2. What are they? First method, traditional method, ignores time value of money. What are the payback period? Accounting rate of return. What, Maji? Another one is modern techniques considered which one? Time value of money. One is net present value, internal rate of return, profitability index, discounted payback period. You know, before going to start this one, we discussed about, we identified some secret with respect to this chapter. Examination purpose, which method they've been asking? First one is NPV they are asking. Another one is, they are asking which one? All the methods they've been asking. Okay, so that's why we must have an idea about each and every method, but we must be very specialist in one aspect. Which one? NPV. Clear? So let's move to the concept. Methods are finished, and you know that to calculate this NPV, first we will go directly. Which method means I will take you to the payback period. What is it? Payback period. It's the first method. Simply you understand what is payback period. Method 1. Payback period. See, payback period. It indicates, if you understand this concept in different way, you make a postmortem of this. What is that, ma? Payback period. So this is the title they given, you know. If you observe in a deep way, you can find 2 words. Here is, dekho. You have to understand. Okay, 1 pay, 2 back, another one is 3. So if you invest in a project, how long you have to wait to recover your investment? That's enough. So payback period is the time period in which invested amount to be recovered. It is the simple line. What do you say? It is the time period or length of time required, length of time to required to recover your investment, recover your, or where whomever it may be, recover the investment. You can say recover investment. Simple word you remember. It is the investment. It is the time period, length of time required to recover investment from cash inflows. What is that? Cash inflows of the project. Here 2 things you have to understand. Point number 1, keep it my word. One is, it speaks about what? Time period. Number 2, to speak about time period, you have to understand what is your investment. You have to understand what is your cash flows. Hello? Cash flows being classified into 2 types. How many types of cash flows? One is, by doing business regularly you will get the cash flows. So cash flows means there is a 3 types cash flows, or you can say first one, cash outflow. What is that, ma? Cash outflows means your investment, what is going from you. Cash inflows, what is coming from your business. This inflows being again classified into 2 types. What are they? Operating cash inflow. Another one is terminal cash inflow. Terminal cash inflow also called optional. What is it? Optional. You may get it, you may not get it. Once you use the asset and if you sell in the market, if you get the cash inflow, then it is called what cash inflow? Terminal cash inflow. But regularly by doing business, whatever the cash inflow used to get, it is called what cash inflow? Operating cash inflow. So payback period speaks, it is a time period in which your investment should be recovered over the period. Are you getting? So how do you calculate this payback period? Means you should understand the calculation procedure. To calculate payback period, first of all, you have to estimate what is your cash inflow generated from the project. Every year cash inflows are equal over the period. In such a case, payback period would be calculated like this. Payback period equal to initial investment, okay, what the investment used to make, divided by annual cash inflow. If you take this formula, every year what is the initial investment divided by annual cash inflow used to get what? Payback period. But whereas every year equal cash inflow, we won't get it, Balu sir. Yes. In such a case, what to do? You have to make a cumulative of that concerned cash inflow and identify that payback period can also be calculated. Identify here. So investment maximum recovery year. What is that? Investment maximum in which year? Recovery year. In which year your investment is maximum recovered, you take it that one, plus you take balance divided by, for the sake of next year cash inflow. These are the two important points should be considered. What is it? Tell me first formula. Payback period equal to initial investment divided by annual cash inflow. Second one is initial investment maximum recovered year, or you can say investment recovery year plus balance divided by next year CFAT. I will tell you here it is. See, here the cash inflow. This is what payback period. Whatever I explain, I am giving some image touch. You see, here in investor making investment in this project, what ma? Cash inflows going or coming? Going. Cash outflows is going, right? Then this cash inflow gives certain cash inflow na? It is going or coming? Coming. So he has to ask how long I have to wait to recover my outflows from what? My outflows from my inflow. It is called, what is it? Payback period. This payback period may be year plus days, year and months. It may be in. Hello? So you have to understand. Payback period, meaning just now I told what is this? This is a time required to recover what? Your initial investment from your cash inflows. To calculate payback period, first of all you estimate how much cash outflow you are supposed to make. What ma? Thereafter you calculate cash inflows. How many cash flows I told you? Here it is. Operating cash inflow. Even you have to learn all these things. Everything is a particular. Operating cash inflow, terminal cash inflow, everything you have to calculate. And operating cash inflow, terminal cash inflow, then you have to apply the formula. For formula, what I told you, tell me. When cash inflows are equal, in such a case, initial investment divided by annual cash inflow. You see, when cash inflows are equal, suppose here you see, every year cash inflow equal or unequal? Equal. In such a case, formula would be initial investment divided by annual cash inflow. Investment divided by annual cash inflow, 2 years. When every year cash inflow is unequal, not equal, in such a case, this is the covered year, balance divided by next year CFAT. You see, here the cash inflows are not equal. In such a case, what to do? You have to make a cumulative and you have to find it out which year maximum investment recovered, balance next year CFAT. You see, he invested 10,000. You have to wait for how many years? 4 years you have to wait. Because if you invest 4 years, maximum you will recover how much? 9. So that's why we have taken 4. What about the balance? 4 years you recovered means 9,000 you got. 1,000 left, right? This 1,000 is the balance. For the sake of this balance, next year cash inflow you have to consider. That is called, what is that? How much that is? 8,000. Suppose if in the next year is 8,000 is there, you have to wait for 8th year to recover your balance. This is the way to take the problem. Okay, but how to take decision making? Decision making is payback period is less than standard payback period. Accept. Sir, what is the most important point is note. Important point. Note means you try to understand standard payback period. What is the standard payback period? It is a decision oriented payback period. Dear students, whenever standard payback period is not given, you cannot take a decision. So to take payback period or to discuss whether the project is worthwhile or not, client has to convey a standard payback period to you. Okay, so when the project should be accepted means, dear students, payback period is less than standard payback period, accept. Payback period is more than, for example, client is expecting 4 years his money has to come back, but you calculated, surprisingly it is a 6 years. In such a case, what do you do? What will you do? Will you say it's a good? No, because the payback period is more. Hello? So that is the point to be considered. So payback period is more than standard payback period, reject. Payback period is equal to standard payback period. Either accept or reject. Okay. Then coming to mutually independent. What is a mutually independent? Independent means, you keep it in mind, in India, all the religions are needed. Yes or no? Like that, you can keep a shortcut. Mutually independent means, I have project A, B, C, D, but I need all. In such a case, what should I do? I should accept all the project if the payback period is less than standard payback period. All I needed. See, in is there, no? In such a case, keep it in shortcut. India, all the religions are needed. Means all the projects are needed. What about the exclusive? I used to say excellent. In the class, all the people are there, but excellent would be one. So another shortcut is exclusive means excellent project. In such a case, what do you accept? Accept the project which has least payback period. So this is the decision making with respect to payback period. Tell me, payback period speaks about amount of time. Note, standard payback period if not there. So if there is no standard payback period required to take what making? Decision making. Okay, but this method is very, very worst. This method ignores, what is that? Ignores time value of money. And it ignores time value of money. It ignores another one is post payback profitability. Post payback profitability means what, Balu sir? That means whatever the cash inflow the project generates after payback period, it won't consider. It will consider cash inflow till to the date of recovery of investment. Once the recovery is finished, right, it never consider. This is the one of the point you should consider with respect to, what is that? Payback period. Ignores time value of money, ignores post payback profitability. Another important point also you can consider, ignores core interest of investor. What is the core interest of investor? To check the time recovery, to check the profit. But this method won't consider. So this is the another important concept of this payback period. Okay. Second one, you have accounting rate of return. What is that? Accounting rate of return. Accounting rate of return. Accounting rate of return. See, if you make observation, it consists of three words. What are they? Number one is, it is a return, but return is expressed in rate. That return is nothing but what? Accounting rate of return. Sir, what is accounting rate of return? See, it is the average annual yield made from the given project. Yield means what the meaning ma? It is an return. Yield means what? Return. But it is an average return earned from the given project. It is the average annual yield made from the given project, which is expressed in rate or percentage. It is always expressed in percentage. Suppose ARR of the project is 15%. What is the meaning of this? ARR of the project is 15%. Meaning, if you invest in this project over the period of 5 years, every year it will give you how much return? 15% only. More than that it never gives you. So 15%. That's why whatever the investment you supposed to made in this project, you better to raise funds from more than a, less than a. You are earning 15%. Will you raise funds more than 15%? Once you calculate ARR, being a CA, you can find it out that by investing in this project, how much return we can generate. Once it would be very clear. Once you know I am going to make how much return? 15%. Is it mandatory to raise funds more than 15%? No, that is the reason it will guide you. So this project looks you better if your funds are raised less than 15%. If you raise funds more than 15%, bhaiya, tu mar gaya. The project has gone. That is the idea about this one. Sir, if the project life 4 years, sir, then means what is that? Over the period of 4 years, every year 4 years, every year 15%. Every year 15%. That is the return you are going to generate by investing your amount in this project. If the project investment, if you are raised from outside, keep it in mind that your cost should be less than this 15%. Okay. So there are different methods to be calculated. Rules you have to follow. Just now I told you, no? You have to consider all the rules with respect to payback period. Meanwhile, before going to this, we can understand what are the various way to find it out. Which one? I'm not concentrating. I don't want to waste your time while spending which one? Payback period ARR. Because I know the secret I told you, which would be important. Yeah. So now tell me, coming to ARR calculation, how many ways are there in which to calculate ARR means? There are 3 ways. One is version 1, version 2, version 3. You can say ARR can be, you write once again the formulas. Calculation, you know the formula? Calculation of ARR. How do you write the formula? First one is ARR, if you want to find it out, means ARR can be estimated on total investment basis. What is that? Total investment basis. In total investment basis, you know, dear students, ARR calculated like this. Average profit, you take it, divided by, make it a total investment. Make it a total investment. Average profit into 100. Average profit divided by total investment. This is the first ARR on total investment basis. Balu sir, how should we get average profit? Very simple. Sum of number of years profit, divided by what you will take? Number of years. Number of years you can take it. But the profit means what profit? CFAT or PAT? PAT. There is a difference between PAT and CFAT. PAT called accounting profit. How it should be calculated? Sales minus variable cost equal to contribution less fixed cost. Okay. Fixed cost, you will get the PBDT less depreciation, PBT, tax, PAT, add back to depreciation. So this is the way you have to calculate CFAT. But no need to wait for CFAT. Just you better to stop at PAT. First method is average profit divided by average investment. Second one is ARR is calculated on average investment basis. What is that? Average investment basis. Now tell me, average investment basis, this is another method, dear students. According to this method, ARR can be calculated like this. How? Average profit divided by average investment you can take. Average investment should be calculated. Average investment equal to, see, half of initial investment you take. If at all scrap value is there, you deduct the scrap value plus scrap value plus what is that? Any working capital is there. Sir, what is the hidden reason for scrap value is nothing but why you are deducting, why you are adding. It is a contradiction question arises generally. See, whatever the amount of asset got depreciated completely, from that you have to take how much percentage? 50%. For example, you invested this much of worth of asset, but over the period it becomes 0. For every year you are making this much of profit. For given profit, how much your amount is allocated means it would be very difficult to identify each year. That is the reason what FM says, here asset is how much percentage? 100%. Here it is 0%. You do one thing. What is that? Make it 2. That means 50% of investment or else half of initial investment. But the asset, whatever got depreciated, from that you have to take 50%. If the scrap value is there, this 50% doesn't work out to it. That's the reason you deduct a scrap value and make an average, and again you add the scrap. If at all any working capital is there, you can add it. This is the very, very important method. In exam hall, if the nothing is asked on ARR, then better to go with which method they specifically won't ask, then better to take which method? Investment, average investment based is the best. And third one, dear students, go with the third one is, third one is ARR on annual investment basis. What is that? Annual investment basis. Annual investment basis ARR can be calculated. Here ARR equal to average of annual rate of return. ARR equal to average of, what is it? Annual rate of return. So here what you have to do means, beginning of the year you took the asset, right? With this asset you made a profit. So you do one thing, to make this profit, this much of investment you made it. Okay, you convert into percentage. Second year the asset gets little bit depreciation, right? From this depreciation, again this depreciated asset, you made what? Given profit, and convert this is also as a percentage. Third year also, what is that? With this depreciable asset, third year you made the concern profit, convert into percentage. Okay, and finally ARR equal to average of annual rate of returns. So whatever you calculated returns, that you have to make, what is that? Average. This is what used to calculate annual rate of return. This annual rate of return, this is A and B. You see, B divided by A into 100. Every year, how much return you generated, and that return to be, what is that? Made average to find it out. Which one? Annual ARR. That ARR is nothing but average of annual rate of return. Okay, these are the very, very important. I will tell you one secret. From the past 10 years, ARR not at all came in the history. But the thing is, in the method, if they asked in your batch, right? Your batch in the history. Okay? That is the reason. Now tell me, ARR, how many ways in which we used to calculate? Number one, total investment based, average investment based. And another one is annual investment based. This is annual investment based. Okay? ARR is always be calculated with cost of capital. What is it? ARR is always calculated with cost of capital. If ARR is greater than cost of capital, accept. ARR is less than cost of capital, reject. ARR is equal to cost of capital, either accept or reject. Mutually independent means accept all the project if ARR is greater than cost of capital. Mutually exclusive, I told exclusive means excellent. Excellent would be only one where highest ARR should be accepted. So ARR need CFAT accounting profit. Accounting profit. What is the limitations of this one? It ignores, it ignores time value of money. It considers accounting profit. What is it? Accounting profit. There is a limitations of accounting profit. Accounting profit considers both cash expenses as well as non-cash expenses. Accounting profit considers credit sales as well as cash sales. That is the reason it absolutely fails to predict the relationship between which one? Set profit and available cash balance. So ARR method is not such a sophisticated one. Thereafter, one more method. What is that? NPV. In NPV plays very, very important role, dear students. Another important method is NPV. Net present value. Net present value. Simply what it indicates, NPV represents benefit or wealth generated from the project, benefit or wealth generated from the project as on the day of investment. Now tell me, what is this logic? You try to understand net present value. Here, if you decode this logic, you will find the three words. What are they? Value, present, net. Value means it is a benefit, dear students. This benefit, you are going to make it, what is that? Net. Net off means all the expenses you are deducting. Variable cost, fixed cost, yes or no, tax, and even interest. First of all, you are deducting net present value means if I make investment in this project as on the day, how much benefit I supposed to get it as on the day of investment. This is the question expected by your client from you. So what you have to do means you have to calculate this net present value represents what is the benefit generated as on the day of investment. You see, it is the benefit derived from the project as on the day of investment. This method which conveys directly wealth generated from the project. So how do you calculate? NPV means first you have to understand what is the present value of cash outflow, then what is the present value of cash inflow, you have to find it out, then cash inflow minus cash outflow, you have to do so, you will get the NPV. NPV equal to present value of operating cash inflow plus present value of terminal cash inflow minus present value of cash outflow, or you can also say present value of cash outflow minus present value of cash outflow. Coming to how do you take a decision? If it is a single project, objective is very simple. Calculate NPV. NPV is greater than 0 or NPV positive, accept the project. NPV less than, reject the project. NPV equal to 0, either accept or reject the project. Mutually exclusive means here multiple projects again indicates mutually independent, mutually exclusive. Mutually independent means accept all the project if NPV is greater than 0. Accept all the project. But mutually exclusive means only one. What do you say? Accept the project which has highest NPV. This is the observation to consider. In this model, you need to understand one of the problem, cello limited problem, which is there in our mastermind material, in your material also. Study material problem. This is the cello limited problem. See, try to understand in this problem. This is a cello limited company is there. Okay, why this problem I considered, I want to explain to you. This problem, in this problem, a company makes investment 1,25,000, but the scrap value it is going to get 30,000. But client says 80% being payable at the starting of the project and remaining 20% at the end of the period. You see the first model problem where you are going to pay installment basis for the given project. Okay, so for before this problem, not at all problems. Because if you are handle this problem, that can be easily handleable. So 20%. The machine would produce how many units? 50,000 units. And production is estimated that selling price would be 3 rupees. And direct cost, word is given. Direct cost means variable cost. What is that? Variable cost. The student who knows the direct cost variable, another name of direct cost is nothing but what is it? Variable cost. Then only he can understand. Otherwise it would be difficult. Right. And here direct cost would be 1.75 and annual fixed cost including depreciation is calculated on what basis? Straight line basis. Okay, and it is a straight line basis is given, but that means depreciation given. What is the straight line method formula? See, the student who knows the straight line method formula, he cannot handle this one. Are you getting? So cost minus scrap divided by life, it is okay, but you know one more thing, depreciation is considered only in the presence of tax. When there is no tax, no depreciation. Surprisingly in the problem, no tax. So what happened, you know, in the flow, what happened, you will calculate a depreciation, but actually you should not take into the consideration. So this problem conveys the multiple tasks. If the student able to understand these concepts, then he can easily solve any of the problem. You know, I told you, you know, that NPV they've been asked, one of the model being asked from this. Okay, so that is another one is first year and second year sales promotional expenditure not included in the above cost. It is not at all included in the above cost. In such a situation means it is not included either variable cost or fixed cost. So that is the point. How much it is? First year it is 10,000, second year it is 15,000. You see how many times this being is asked. And this problem is there in a new study material, in mastermind material. So wherever in entire India, student has to learn this problem. From Bradipeta to Bangladesh, not Bangladesh, sorry. I went to beyond. Okay. So this is the problem. What is why I have taken this problem to explain? Because you have to understand these many points. What is that? Estimation of present value of cash outflow when investment is made at different time periods. What is a direct cost? Yes or no? Treatment of depreciation in the presence of tax, in the absence of tax. You should use present value factor, present value of annuity factor also. And how to find annuity factor for the middle of the years? Middle of the year, same cash inflow. Why? Because first year is different, second year is different, but year 3 to year 5 used to get the same cash inflow. So that is the observation with respect to given problem. Okay, right. Then for this purpose, we check it. Tell me, what are the various factors they've been asked? What are the factors they asked? What are the factors? Multiple investment, direct cost. So, okay, ma? Yeah, here it is. First, what we have to do, ma, you see, cost of machine 80% in the beginning, right? We take directly. But 20% we will make when? At the end of the first year. So, we have to bring into present value factor. So, that is the work we have done. This is one important. Here we calculated depreciation. But we know that since there is no tax, no need to consider depreciation. But because to deduct this, it is from fixed cost. Why? Because fixed cost including depreciation. That's why we have to deduct it. Then we have to find it out. Now you see, year 1 we have taken, year 2, year 3 to year 5 we have taken. Number of units produced, contribution, total contribution we got it. Fixed cost where working note we done it. Less sales promotional expenses first year and second year. We could not done year 1 and year 3 to year 5. Then we got the PBT. PBT also nothing but PAT and CFAT. By multiplying present value factor here and there. But how do you get this annuity factor? Because we made a sum of present value factor of year 3, 4, 5. By multiplying this, you got the operating cash inflow. Finally, terminal cash inflow used to get at the end of the period. Because no tax, no need to calculate capital gain or capital loss. So finally, NPV should be calculated. Present value of operating cash inflow, present value of terminal cash inflow minus cash outflow. You used to get 31,710 is the NPV. Since NPV is positive, we can accept the project. So this is the NPV, wonderful model. Okay. Along with that, there is a one more problem is there, XYZ Limited. Hello. In this XYZ Limited problem, what is the most important observation they made it? XYZ Limited problem, if you check it in study material, here you see, this is our problem. Several times they've been asked this model, XYZ Limited. See, you check it this one, why I have taken this one, you see. How many times this model been asked? In this model, idea I will tell you, where we will make a discussion. The project life is how many years? 8 years. But here the client is going to buy a machine initially by spending 3.5 crores. But whereas additional equipment is going to buy 25 lakhs from the third year cash inflow. Third year cash inflow is going to buy. Hello? So that means first problem is what? Same project, same asset, installment payment. But this project, same project, multiple assets. Hello? Thereafter, working capital treatment is given. Working capital is required how much? 40,000. At the end of 40 lakhs. But original equipment, 2 machines are there. No? One machine is purchased at 3.5. Additional machine purchased at 25 lakhs. But no resale value for the initial equipment. Whereas additional equipment has 2.5 lakhs. Same life you check it. First year given, second year, third year, 4 to 5, 5 to 6. So how should we use annuity factor? This is a contradiction for here. Here you can use which factor? Present value factor. But there you cannot use present value factors. Here what to do? You have to sum it up present value factor for 6, 7, 8. Unless until all this concept the student don't know, he cannot answer. And another one is selling price is 240. But here he used a ratio. What is that? Variable cost ratio. Variable cost ratio means you must also know one more point is contribution ratio. When variable cost ratio 40% means contribution ratio is 60%, right? And there is a fixed operating cost amounted to 36 lakhs. Loss of any year will be set off from the next year. Loss of any year will be set off next year means whatever the loss you used to get the first year, on that year you used to get the tax advantage. Hello? Tax shield. But instead of not to getting tax shield, you will get the tax advantage which year? Next year. Set off loss. This year entire loss you can project which year? Next year. Sir, what is the treatment of set off loss? Similar to depreciation. What is it? Similar to depreciation. It is nowhere lost to the next year. But the thing is, what you are going to show means you are going to project this profit there and you want to reduce the taxable income and you will pay less tax. Once tax is paid, again what you will do? How depreciation you used to add in the same manner, you used to add back, what is it? Tax set off loss also. Are you getting? Set off loss, tax shield. Both are same. Whenever company gets a loss, that concern year, company eligible to get what? Tax shield. But what sometimes problem says, if this year, if you are silent, next year we will provide you set off loss concept. That means this year you are not going to get it any tax shield. But next year you are going to set off loss. How should I do, sir? You used to get the PBDT. From the PBDT you have to deduct what? Depreciation. Then you will get the PBT generally. From the PBT you have to pay tax. But already you got the one accessibility that what? Making set off. So that's the reason you can deduct it. Set off loss. Hello? That means your taxable income comes not only deducting depreciation but also set off loss. Deducting all these things, you will get the PBT. From the PBT you have to pay tax. From the PBT you have to pay tax. So this is the procedure to be done. You see how wonderful this problem is. If the simple logic, if you observe it, you are not going to solve it. Now you see, in order to solve this one, tax is there. That's why we calculated, what is that? Depreciation. Thereafter, we calculated present value of cash outflow. Cost of initial equipment, you made it how much? 3,50,000 today. Thereafter, 3 crore 50, no, add working capital should be added. Then additional equipment purchased. But we brought into present. Why? Because that we made into third year. Then we have taken year 1, year 2, year 3, year 4 to 5, year 6 to 8. You see the number of units, contribution, how do you get it? Selling price into contribution ratio. Balu sir, in the problem actually 40% is not given. Yeah, variable cost ratio given means you have to take into contribution. By multiplying this, you will get the contribution. Then fixed cost you deduct. PBDT will get it. Hello? From the PBDT, you have to deduct which one? Two things. What are they? Depreciation and set off losses. You see, this is the, you have to deduct two things. You see, depreciation, PBDT less what? Depreciation you have to deduct. Another one is brought forward loss also you have to deduct. But first year it is not possible, but second year it is a possible, right? So in the same manner, you have to, by deducting set off loss, after deducting PBDT, you have to deduct one is a depreciation, another one is a set off loss, then you have to find it out PBT, then you have to pay tax. For the once tax is paid, you got the PAT, right? For the PAT, what you do? Add back to which one? Depreciation. Not only depreciation, any of the year set off is done, that year what you have to do? You have to make add back. So this is the wonderful problem. This is the problem, very, very important. Whereas at the end of the period, you used to sell how many assets? 2 fixed assets are there. Another one is one current assets are there. Yes or no? So fixed assets you used to scrap at the end of the period. In order to sell the fixed asset gets 100% depreciation. In such a case, gross sale proceeds, net sale proceeds of initial equipment would be 0. Whereas additional equipment used to get the 2,50,000. That's why total net sale proceeds by selling assets used to get 2,50,000. Okay. For that purpose, you have to add one more point. What is that? Working capital also you have to add, right? By selling 2,50,000 plus working capital, you used to get, what is that? 42,50,000. Since it is to get when? At the end of 8th year, and you have to bring it into present by using present value annuity factor. Sorry, present value factor. Once you get it right, you sum it up both operating cash inflow and plus terminal cash inflow minus cash outflow, you will get the NPV. So this is the important point, dear students. Why I considered this problem means you try to understand how many points they have given. In this problem, what is that covered point is covered is number one, multiple assets to be purchased and at the same time treatment of working capital. What is a variable cost ratio? What is a contribution ratio? Depreciation in the presence of tax and the absence of tax. Using present value factor, annuity factor. How to find annuity for the middle of the same year cash inflow. And what is a tax and tax shield? What is the difference between profit and gain? And what is the concept of, what is it? Set of losses. Set of losses, it indicates any year you got the loss, instead of getting that one, instead of taking, what is it? Tax shield, you would be forwarded to next year. Okay. So this is the important problem and point with respect to NPV. Thereafter you have, what is that? Profitability index. Profitability index calculation is very, very easy. What is a profitability index? It is outcome of rupee invested. Once you invest in any project, how much the cash inflow you supposed to generate from the given project is nothing but profitability index. Profitability index formula, present value of cash inflow divided by present value of cash outflow. Why profitability index is sophisticated one means this method is very, very important at the time of, what is that? Scarcity of funds. At the time of, you see, when the funds are limited, once you don't have adequate funds in your hand, so you want to invest in multiple projects, OPI, what is this? OPI indicates order of preference of investment. This order of preference of investment can be learned with only profitability index. So profitability index is an outcome of rupee invested. What is the formula for calculation of profitability index? PV of cash inflow divided by PV of cash outflow. Whereas a profitability index conveys, how do you take the decision basing on this? When profitability index is greater than 1, accept the project. Profitability index less than 1, reject the project. Profitability index equal to 1, either accept or reject the project. Multiple projects means mutually independent. A, B, C, D. We need all. In such a case, what will do? Accept all the project if profitability index greater than 1. Mutually exclusive means A, B, C, but I need only 1. In such a case, accept the project which has highest profitability index. So basing on that, we have a problem. This is the Navajivani hospital problem. This model problem also very, very important. They asked this problem several times. Same model 2 years back also they asked, I will show you. This is the approach Navajivani hospital. You see this problem. This is the problem. You check it, very, very important model. Net present value, profitability index. They asked new study material, practice manual, November 2022, November RTP 2022. 23 they could not touch. Whereas 24 there might be a chance. Are you getting? This is the observation. In this problem, very simple. A doctor wants to buy a machine. The idea is very, very simple problem. This is here. You see, the idea is this. This is which problem? Navajivani hospital. This is the machine is there, no? This is scanning machine. So what? Nothing but in this problem, hospital wants to buy a machine by spending how much? So 2 lakhs rupees. But this life is supposed to be 8 years. But expected salvage value would be 8 years. But every year to maintain it need 22,500. But now the presently, if you don't have a machine, you have to give this machine to outsourcing. Hello? Any client will come for the sake of testing. The doctor used to give for outsourcing. Here the centers earning commission on how much? 36,000 per annum for outsourcing this one. Because of he don't have a machine, that's the reason he used to give for outsourcing. He is earning how much? 36,000. But if he purchased this machine, he used to get how much? 1,20,000. Now tell me, hospital now currently don't have machine. Whomever the patient will come, he will refer third party. That third party is giving how much per year? 36,000. That is the net of taxes. Net of taxes means after treatment of all the taxes. After treatment of all the taxes, he is getting how much? 36,000 means the doctor got an idea. Hurry, if just he is paying 36,000 commission without tax, net of tax. So why don't I purchase for my hospital my own machine? This is the idea. But in this problem, what we used to advise, what is the cost of machine we have to take? How much the cost? 2 lakhs. Since the tax is there in the problem, but in the problem, depreciation, tax is the given in the problem is, tax rate is, here it is, tax rate is in the problem is 30% is there. When tax rate is 30%, certainly you have to take. But you see, if you read the problem, you never find depreciation word. You never find depreciation. With this, what is the logic? When T is there, D should be there. So that is the reason when we have to consider depreciation is straight line method. Balu sir, who told you to take a straight line method? Why don't you take WDV method? We should not take. Why? Because problem will become, what is that? Problematic. So that is the point you have to consider. What is that? You have to analyze this. So first we calculated depreciation. Are you getting? Then you have to consider operating cash inflow. Sales revenue, operating cost you deducted, profit before depreciation and tax. After deducting depreciation, we got the PBT, less tax, we got the PAT. But this is, what is that? Loss of commission after tax, because we are losing an opportunity cost. So that's why this opportunity cost also must be considered. This opportunity cost also must be considered. But the thing is, in this problem, while evaluating a project, not only consider variable cost, a fixed cost, yes or no, legal cost, tax, but also interest, which is called financing cost, but also you should consider opportunity cost, loss. Loss should be deducted, benefit should be added. What is it? Loss should be deducted, benefit should be added. When should deduct, when to add is depends upon tax. If it is a commission is after tax means, since it is a loss, it should be deducted from after tax. Are you getting my point? If it is a before tax means, it would be deducted from before tax. If it is a benefit means, it should be added before tax. If it is a before tax is given. Okay. So this is the very, very important point. Once you calculate operating cash inflow and terminal cash inflow, you can calculate NPV. NPV equal to PV of cash inflow minus PV of cash outflow. Where is the profitability index? PV of cash inflow, PV of cash outflow. So thereafter, this is the profitability index. This two method plays very, very important to calculate what is that? Your considerations. Okay. Project evaluation. Which method so far we completed? Payback period completed, ARR completed, NPV completed. In NPV, two problems I solved. In profitability index, one. Very, very important method. Whereas IRR is nothing but maximum rate of return. IRR, you see here the one of the investor is there. He looking at the business tower project and he want to know, by investing in this project, what is the maximum return I can earn by making in this project. And he may ask is the same question, what is the maximum rate of interest which I can raise funds to make investment in this project. So what is the rate of return I can generate and what is the maximum interest rate I can pay. So that is nothing but, what is that? IRR. What is that? IRR. IRR of the project is 25%. Means, what do you mean? If you invest in this project, maximum you used to get how much? 25%. 25% used to get. But if you are actually raising funds less than 25%, then this project is worthable. Are you getting ma? So cost of capital, IRR, you should have a clarity, Maji. Cost of capital means where I should raise the funds. Hello? IRR is nothing but how much rate of return I should generate, or it will also conveys at what is the maximum interest rate I can pay in order to undertake this project. Are you getting? So this is the IRR. What is IRR and cost of capital? Both are same. If I take loan from bank, that is the cost I supposed to pay. Whatever the funds I will raise and I want to plan investment in a fixed asset, what is the maximum return I supposed to generate is called, what is that? IRR. So to calculate IRR, what you see, IRR is the maximum rate of return one can make investment, one can generate or earn by making investment. So we can say it is the IRR is the discounting rate at which NPV equals to 0. Suppose listen, I want to find it out a project IRR. I want to find it a project IRR. Simply what you do means you ask first client what is your cost of capital. By calculate NPV there. NPV is a positive means what is observation there? 10% accept 10% accept the project, that is okay. Means by paying 10% of NPV, since he has certain surplus amount in this hand. Okay, now to know how much he can pay means gradually increase that rate of interest. At one rate, what will happen? At one rate, NPV would be 0. That means come to conclusion that would be the maximum interest rate or financing cost one can pay. Since one can pay that much means from by investing that given amount in this project, he can generate that much of return. A person should beg in railway platform. A person should beg in bus stand, but a person should not beg in flight. Okay. Even the flight, if you say, sir, ఒక 2 రూపాయలు ఇవ్వండి సార్ అంటే, అరే what is the flight ticket రా? 50,000 sir. You are beggar? No. Once you are capable to pay that much, you are capable of earning that much. So this is the idea with respect to IRR. So how do you take a decision basing on IRR? IRR should be greater than cost of capital, accept. IRR less than cost of capital, reject. IRR equal to cost of capital, either accept or reject. Whereas multiple projects means A, B, C, D is there. In such a case, accept all the project if IRR is greater than cost of capital. Whereas mutually exclusive means, accept the project which has highest IRR. Whatever the point is, you can solve the problem by having the same logic. What is this? IRR is a discounting rate at which NPV equals to 0. If anybody asks you to find it out the problem, simple reason what you do means take that rate and calculate NPV. To find it out that one you can use what method? Trial and error method. By using trial and error method, IRR may lies between two guess rates. Okay, but exactly to find it out, then you have to use what is that? Interpolation. What is that? Interpolation. What is the interpolation formula? Interpolation formula is nothing but IRR L1 plus NPV at L1. Any of the method by using interpolation formula, you can make it an observation. So this is the IRR and only NPV you concentrate. And another one is, I want to tell you payback period is be completed. What is the discounted payback period? So this is the payback period which is estimated from what cash flow? Discounting cash flows. So discounting cash flows, it is the payback period which is estimated from what cash inflow means? Discounted cash inflows. This is the payback period. See here the discounted payback period. It is the payback period which is estimated from discounting cash flow. But one point you have to keep it in mind that while making discounting cash inflow, you have to consider only present value factor. So what will happens to annuity factor? Annuity factor if you take means total cash inflow will comes into the consideration at a lump sum. So discounted cash inflow, once you calculate the future cash inflow, then you observe the cash inflow. If every year cash inflows are equal, initial investment divided by annual cash inflow. But in discounted cash inflow, you never find it out. You never find it out. That's the reason you have to make a cumulative, and basing on that cumulative cash inflow, you have to find the discounted payback period. Thereafter, payback reciprocal is there. What is that? Payback reciprocal means payback reciprocal. How do you calculate ma? So payback reciprocal, it indicates if I invest in a project, how long I have to wait to recover. For example, my payback period is how many years? 4 years. 4 years means you try to understand, by investing in my project, I have to wait for 4 years. 4 years means my invested amount, suppose 100% is there. Then how much every year I can recover it? 25%. Are you getting? For example, my payback period 5 years. Tell me, what is my recovery of percentage? 20%. 20% I am recovering means 20% I am earning, right? Okay, so that is the payback reciprocal. Payback reciprocal, it indicates 1 divided by payback period. What it conveys? It conveys percentage of recovery of investment from the given project. So suppose you see here 20,000 is there. 20,000 is your investment. 4,000 is your every year cash inflow. What is the payback period here? 20,000 divided by 4. 5 years. So payback reciprocal 1 divided by 5 into 100. How much percentage? 20%. Right? But whereas finally you have to go with one more important point, I would say, that is nothing but comprehensive model problem is there. In our mastermind material, we identified comprehensive problem. This problem plays very, very important role. This is the problem, Hind Liver Company. What is that? Hind Liver Company. This problem already covered in ICA practice material. Are you getting? ICA practice material problem is there. If you don't have material, you better to check this one. Very, very important problem. It asked in November 18 and it's asked November 19. From November 18 to November 19, they could not ask. This is 2023. There would be a chance, right? Nuclear bomb may blast ho jayega. So why this problem important means, in this problem, the client makes investment beginning 7 lakhs. At the end of the period is 10 lakhs. What to do? Beginning 7 lakhs, ra. At the end of first year, he made it a 10 lakhs. What to do? You have to bring into present, right? And at the same time, this project lives, first year no cash inflow. In such a case, no problem is there in study material that first year cash inflow would be 0. Nothing is there. But in this problem, they asked cash inflows are 0 in the beginning. So what to do means ignore. If nothing is happens, first year no cash inflow means no cash inflows. Because sometimes if you do business, initially you won't get even profit also. But in this problem, first year no cash inflow. Such a model is not covered in any of the problems. So that is the reason I took this problem as an important. And this project might be viable. Required rate of return. Instead of using cost of capital, you used word what? Required rate of return. And basing on this, he asked, what is it? Net present value at 10%. What should I do? By taking cash inflow, cash outflow, you calculate 10% NPV. NPV positive, accept. Negative, reject. Thereafter, how do you calculate profitability index? Arey yaar, profitability, NPV you calculated, right? PV of cash inflow minus PV of cash outflow, you will get what? NPV. PV of cash inflow divided by PV of cash outflow, profitability index. Next, again he asked a question. Is this project is still financially viable if the company required rate of return is 15%? In such a case, what to do? We can calculate 15% means, again at 15% you have to calculate NPV. You try to understand, 2 times they asked the NPV. What Maji? And if the at 15% NPV negative, you say what? No to the project. And finally asked internal rate of return. At 10% NPV is positive. At 15% NPV negative means immediately you can take what? Interpolation. You can take an interpolation. Basing on interpolation, you can calculate IRR. Then he asked the payback period. Payback period means if initial cash inflow equal, initial investment divided by annual cash inflow, you take it. If the cash inflow is not equal, in such a case, covered year plus balance, next year CF80. You have to calculate the payback period. Then payback reciprocal, 1 divided by payback reciprocal. So this is the very, very important topic, dear students. These 3 problems will stand you. It will protect you at any cost. But finally, by identifying all these points, I identified certain points I will give you. Because we cannot go with each and every concept because time is insufficient. But you see, there are certain points. In calculation of NPV, you make it analyze all these points. Do you know difference between accounting profit, cash profit? What is accounting profit? Accounting profit, PAT. Cash profit is CF80. What ma? Thereafter, you see, what is the treatment of working capital? Do you know? Beginning you have to add, end you have to recover. Do you know subsidy treatment? Subsidy treatment? Yes, it will deduct your burden. So cash outflow you have to deduct. Do you know tax and tax shield? Yes sir, I will get a profit, I have to add sir. Loss I will get tax shield. Do you know sunk cost means before commencement of the project whatever the cost is incurred, such a cost is called sunk cost or historical cost. That cost should not be considered because that become history. Then do you know variable cost ratio? Hello? Variable cost divided by sales into 100. If variable cost ratio is 60%, rest would be contribution. What is another name of contribution ratio? PV ratio. What is opportunity cost benefit? Opportunity cost loss. Now given hospital problem we discussed. Doctor misses certain commission what he been earning. That is an opportunity cost loss. But by chance because of making investment an opportunity gets created and gets benefit, then it is called opportunity cost benefit. And the treatment of depreciation in the presence of tax, in the absence of tax. Here we discussed about the XYZ limited problem. There is a tax, there is a depreciation. Hello? But whereas Cello limited problem, there is no tax, no depreciation. Right? Thereafter, multiple assets purchased at a different time period. Hindlover company problem. Beginning, multiple assets means XYZ limited. 3.5 crores we purchased beginning ra. Yes or no? And at the end of third year we purchased another machine. Initial payment and additional payment. Two models are given. Initially purchased 10 lakhs. Hello? Additional equipment, additional payment made at the end of next year. Then there is a set of loss. Set of loss treatment. Yeah. Present value factor. When should you use present value factor? Multiple unequal cash inflows are there. Then you use what factor? Present value factor. Multiple unequal cash inflow. If single cash inflow also is there, then present value factor. Annuity factor, when should you use, sir? Multiple equal cash inflows are there, then you use annuity factor. How do you bring equal cash inflow at the middle of the year? For example, year 6 to year 10, same cash inflow comes middle, not in the beginning, not in the end, middle. In such a case, what to do means you better to add present value factor for concern year, you bring into present. Okay, must see total 16. In problem I covered few more points, 20 problems. If CA Institute want to design a question paper, beyond this he cannot go anywhere. What he may go any of the way, okay, he cannot. Once you hold this much of capability you have means, right, why you are worrying? You are a great batsman, yaar. Whomever it may be bowler, let him bowl. Let's go. You have to say, you should not request, sir, slow guy. Please. Okay. You should not beg a bowler to make what is a slow bowling. You have to become a great batsman. At any cost, you have to hit what? 6. Okay. Right. You better to go with this. Take a break. Then next we will start. Cost of one minute. Before that, I will give you an idea. For cost of capital, this is a 10 years question paper, right? 2018 to 2021. We made an investigation. We find it out 2020, they asked only one concept. What is it? Cost of convertible debenture. Are 18 to 20, how many years? 4 years, Akartalli. Are 2 years, 5 months they asked. 2020 to 24. 2020 and at the same time if you consider 2000, there is a much chance to ask only this is for 5 marks. Rest of the chapters you see only 3 models they been asking. What is it? One is marginal cost of capital, 2 times they are asking. Another one is market value, they asked 2 times. Book value only 1. Now if you make our own analysis, ఏది రావచ్చు ఎగ్జామ్కి 50% chances is there, but in the 50% only this would be given. మనం అలా అనుకుంటే వాడు ఇలా ఇస్తే okay. So in working capital is consist of multiple methods, right? Cost of capital I will complete as early. Before lunch I will give you 2 more chapters to your hand. One is cost of capital, capital structure. Have a sound break. Slow. So the next chapter we used to take cost of capital. There is a certainly a 10 marks question from this model. Ma. Damn sure, keep it in my word. Certainly there would be a 10 marks question. Cost of capital. See. This cost of capital, I discussed with you that there is a two important areas they've been asking. Number one is book value, market value, and marginal cost of capital. So first of all, you should understand what is cost of capital. So cost of capital is nothing but whenever company need a capital, this company rises from various long-term fund providers. Who are the long-term fund providers? Equity shareholders, preference shareholders. See, equity shareholders, preference shareholders, as well as whom? Debenture holders. See, lenders and other debt holders. And this is the capital they will rise from given various sources. But when company raises funds from all these fund providers, at one point of time, company has to pay cost, right? So how much cost the company supposed to earn to pay to whom? It must earn either to pay or to keep the expectations. Particularly if you say equity shareholders are there. For equity shareholders, we won't pay cost. But for the remaining fund providers, we have to pay cost. So here the cost of capital is the minimum rate of return the company must earn to keep the expectations of whom? Equity shareholders. So this is the cost, and it is also called overall cost of capital and minimum rate of return. Got it? This is the 2 marks you can get it from this cost of capital. You see, first you should understand capital. Whenever company need a capital to commence a business, so it has to determine how much capital is needed. Thereafter it has to consider capital structure. Thereafter it has to identify capital sources. So simply logic is this: a company need a capital. This capital the company may rise from equity shareholders, preference shareholders, and even retained earnings, and it may rise it from the borrowings for long-term funds, long-term and financial institution. So if you observe the source, for equity shareholders the company has to pay equity dividend, for preference shareholders it has to pay preference dividend, for debenture holders it has to pay interest, for bankers it has to pay bank loan. For considering all the people, how much does it cost? How much does it cost is considered cost of capital. So that is the point in our material also they considered. Cost of capital is the return expected by who? Fund providers. Who are the fund providers? Shareholders, lenders, debt holders. Example. Okay, so to calculate cost of capital, we have to estimate various specific costs. What are they? Cost of debt, cost of preference, cost of equity. That by if you sum it up all these things, you will get what is it? KO. So it is a systematic summation of overall cost of capital. It is a systematic summation of various specific cost to find overall cost of capital. To calculate the cost of capital, what you have to understand, there is a certain case studies we can understand. The coffee dough CEO story. He has taken a loan, but he could not calculate it cost effectively, and he is supposed to pay high rate of interest. At one point of time, he lost his life also. There is a stories are going on. But whereas his wife has clearly repaid all its debt, because she identified that highest cost oriented funds, immediately she paid and she run the company effectively. Okay, so to calculate cost of capital, coming to our subject, to calculate cost of capital there is a 2 steps. One is calculation of specific cost, another one is what is it? Overall cost of capital. For specific cost you have a KR, you have a KD, you have cost of preference, and you have cost of equity. By summing up of all these things, you will get it. What is it? Overall cost of capital. Okay, coming to here, cost of long term of debt. Here you see. Coming to here, long term. Now you can make it. What is the cost of capital? Cost of capital. It is the so it is the minimum rate of return. Minimum rate of return that a company must earn to keep the expectations. Expectations of whom? Fund providers. Who are the fund providers? Equity shareholders, fund providers, equity shareholders, preference shareholders, debenture holders. That means KO should be estimated by calculating the given case cost. What are they? You have to calculate cost of equity, you have to calculate cost of preference, you have to calculate cost of debt, right? And you have to calculate cost of retained earnings. Once you calculate all these things, if you add systematically, you used to get it. What is that? KO. So that is the point. First we have to consider how do you calculate cost of debt. So cost of debt, you have a two observations, dear students. Keep it in one. One is, what is that? Irredeemable debentures. What is that? Irredeemable. For irredeemable, redeemable is there. For irredeemable, we can use what method? Shortcut method. What method? Sorry, not short, irredeemable. If irredeemable, formula is this. Cost of debt, you see. Any source, if you want to project a cost, how much cost is going, how much cost is coming. What is that? How much cost is going, how much cost is coming. For example, your father raised a loan at 5 lakhs rupees. You asked it, what is the rate of interest? Your father told 2%. 2%, does it means that for every 100 rupees 2%? For entire given amount to 2%? For the given amount, for the entire amount, for every 100 rupees, your dad is going to pay 2%. That means cost of debt, which represents always for 100. In numerator, what is going? Denominator, what is coming? For the given amount, how much you cost paid. For cost of debt, irredeemable debenture is a calculation is very, very easy. How do you calculate means? See, cost of irredeemable debenture. What is the meaning of redeemable? Sorry, irredeemable means principal amount never be repaid. For cost of irredeemable, interest would be always paid forever. Hello? Whereas principal never be paid. For this calculation of cost of debt, you can make a note what the cost would be. Just now we calculate. Yeah, here it is. Why it is came. You will see. Cost of irredeemable debenture. Formula is that ma? Cost of debt equal to take interest into 1 minus tax divided by net proceeds or market price. Sir, Balu sir, what is the logic behind interest into 1 minus tax means? That is a tax advantage you used to get. The reason is this, how much interest you pay, from that interest, right, you used to get the tax advantage. How, sir? You will pay interest. That interest you will show in profit and loss account, debit side. Profit and loss account, debit side you will show, and with effect what happen? Your taxable income what happen? Decreases. You will pay less tax. Basing on that, you are getting a tax advantage. So that would be the reason cost of debt you used to get it. Interest into 1 minus tax divided by net proceeds or market price. And whereas if it is a redeemable in nature, you have a two versions are there. One is redemption should be done at lump sum. Redemption should be done at lump sum you can make, and redemption also can be done what? Installment. When redemption is done at that lump sum, you can use what method? shortcut method is there. What is that? Shortcut method. To use this shortcut method, dear students, you should understand there are certain conditions should be followed. The condition is this: coupon rate remain constant and redemption should be done at lump sum. The coupon rate never be repaid, but redemption should be done at only at the end. When this two condition works out, then we have to use the shortcut method. The shortcut method formula is this: cost of debt equal to interest into 1 minus tax plus redeemable value minus net proceeds whole divided by n number of years whole divided by RV plus NP divided by 2. Balu sir, what is the logic? Explain one by one, sir. Simple. I will tell you. Interest into 1 minus tax. What is the logic behind this? How much interest you are paying, you are getting a tax advantage. Clear? Number 2, how you are redeeming, what style you are following, how much you are paying, how much you are taking. So it indicates you are receiving 90 rupees, but you are paying 100 rupees, means 10 rupees you got the loss because of your redeemable value. Hello? So your way of redemption gives you loss of how much? 10. So that is the reason, once you know that, means every year you have to make certain proportionate increased income so that to pay not only interest, what is that? That cost also. Are you getting ma? This 10 rupees is the over the period of how many years? Let us take 5 years, means 5 years. You took the money today and you are promising to pay at the end of 5th year. 190 rupees you are taking, 100 rupees you are paying, means 10 rupees loss only, you know. So now tell me what the advice you used to give to your client. Array, you took 90, you are paying 10, means additionally there is a 10 rupees is the burden to you. But no, that is the reason you every year you have to pay two things. One is the interest, another one is that loss, what you supposed to pay. In order to add that loss to interest, you have to make it divided by. Why? Because that 10 rupees is not for one day or 1 year. This is for 10 years. Once you make it divided by with a number of years, you will get the 1 year amount. That 1 year to be added for this one. That means you have to pay interest, but also you have to bear the loss. You have to bear the loss because of your redeemable value. That is the reason RV minus NP. Then why should we took RV minus NP? You try to understand. I took the net proceeds and over the period I paid the redeemable value. So to pay this concern cost, should I consider net proceeds? Should I consider RV redeemable value? Means both will reflect. Both will reflect. That's the reason what they say, better to take an average. Better to take average. That is nothing but opening value net proceeds, ending value RV divided by 2. This is the what method? Shortcut method. This method to be used, coupon rate remain constant and redemption should be done at lump sum. Whereas if it is not in lump sum paid, then you have to go with what is that? IRR, internal rate of return. In the internal rate of return, you can calculate from company's point of view, you can calculate from investor's point of view also. What is that? Company point of view, investor's point of view. But you know, what is the logic behind how an investor IRR will make? Investor's IRR will make a cost of debt. How it makes? There is a biggest question. See, if there is no what cost? If there is no what cost? Flotation cost, dear students, in such a case, we can argue that return of whom? Investor will become cost to whom? Company. Yes or no? Return to investor will become cost to company. But when the flotation cost is there, this logic does not work. In such a case, you have to calculate what is it? Cost of debt. Cost of debt you have to calculate from whose point of view? Means company's point of view only. When flotation cost is there, company's point of view IRR you have to calculate. Where in company's point of view IRR, it is not the return, it is what is that? Cost to be paid. Whereas investor point of view, IRR equal to what is this? Tell me. IRR equal to return earned by whom? Investor. That investor return would be the cost to the company. Whereas if the cost of debt from company's point of view are doing, then IRR is nothing but return made by whom? This is from company's point of view, IRR is nothing but cost paid. From whereas investor point of view, so IRR we are calculating from investor's point of view and that is the return earned by investor. Thus, that is the cost paid by whom? Company. This is the indirectly we will make analysis, but here directly we do it so. So this is with respect to cost of debt. So coming to here, you see redeemable debentures. Coming to our material, redeemable debenture means redemption may be done at lump sum, redemption may be done at coupon rate. See here, this is the method, approximate method. What method? This is also shortcut method should be used. But to use this shortcut method, you have to follow the given condition. Number one, amount to be paid only at the maturity, and at the same time interest rate remain no change. If the two things will happen, then you can identify. Okay, for that purpose, shortcut method formula. What is the shortcut method formula? Just now I told you. What is the shortcut method formula? Interest into 1 minus tax divided by net proceeds or market price. Okay, ma? Whereas thereafter, the next situation is cost of preference. What is that? See, I will show you what is the cost of long-term debt. In long-term debt, first of all, you have to understand what is here. Redeemable or irredeemable? Irredeemable debenture, where principal amount never be repaid to the client. In this model, cost of debt formula equal to interest into 1 minus tax divided by net proceeds or market price, where net proceeds formula face value minus discount plus premium minus flotation cost. Whereas at market price would be calculated for not exist new company. For what is that? Existing company. For existing company also, they will come to your office to know the market prices fluctuations. Okay, when market prices decreases, in such a case, what would be the impact on cost? When market price increased, then what would be the impact? By considering market price fluctuations, certain companies, they want to know what would be their cost. That is the cost of debt. Coming to, you have a cost of preference. What is that? Cost of preference, not this fair value. You will come to cost of preference. This is the cost of preference. For cost of preference also, the estimation would be same. You come to here, cost of preference. The two formulas you should understand. Cost of preference. Yeah, cost of preference. Now, first you should understand what is a preference, whom it is a preference. So, cost of preference. Yes, okay. You can make some notes, PowerPoints. Cost of preference. So that is nothing but KP. Cost of preference would be calculated. So here, preference with respect to whom? Preference with respect to, they used to give whom? Equity. Preference with respect to what? Preference with respect to what? These shareholders would get what? Early payment of dividend comparing to equity, and at the same time what payment? Principal repayment also. What ra? Okay, principal. So here you, one more point you should understand. Preference dividend is not an expenses. It is not an expenses, but it is a charge. It is a charge. It is appropriation of a profit. When company makes a profit, then only it has to pay, what is that? This preference. When company won't make a profit, it is not. Okay, but the preference dividend, because of this, there is no impact on, what is that? No impact on tax, right? You won't get any tax advantage. But whereas for debenture, we used to get the tax advantage. So that is the impact of preference dividend. But here the cost of, while calculating preference also, cost of preference can be estimated in two ways. Number one, if it is a irredeemable preference shares, you can take irredeemable preference share calculation. So cost of preference equal to preference dividend divided by net proceeds or market price, you can take. Whereas redeemable means same logic would comes here also. Redeemable preference shares. One is you can use redemption done at lump sum. When redemption done at lump sum, Redemption done at installment. Now try to understand, for redemption done at lump sum, you can use cost of preference using shortcut method by following condition. Coupon rate remain constant. In such a case, preference dividend plus redeemable value minus net proceeds whole divided by n number of years whole divided by RV plus NP divided by 2. This is the condition. Can you say what is the condition here? So coupon rate remain constant. Redemption should be done at lump sum. Whereas you can follow IRR. IRR whose point of view you can do? One is what is that? One is investor point of view. You always give a preference from whose point of view to solve? Investor's point of view. Why? Because it is very easy for you. Why? Because already you calculated from whose point of view? In capital budgeting, you learned IRR. That experience will count you here. Okay. Whereas investor's point of view, another one is, what is this? Company's point of view. Company's point of view, you can do so. So this is the observation, dear students. See, irredeemable preference shares, redeemable preference shares. Irredeemable preference shares, see, it will be, preference would be paid. Irredeemable means perpetually. We never pay the principal amount. What is the formula? Preference dividend divided by net proceeds you can take, or market price. Okay. Thereafter, redeemable preference shares. Redeemable means at the time of maturity, means lump sum. For the lump sum, whenever the lump sum we can pay, then we can use what method? Shortcut method. Whereas installment we can go pay, we can use what technique? IRR. IRR would be done from whose point of view? Investor's point of view and company's point of view. Okay. Thereafter, if it is a, for example, if redemption is done at installment point, then what technique we will follow? IRR. No flotation cost. Then no flotation cost is there. In such a case, no flotation cost. Better to calculate whose point of view? Investor point of view. Whereas when flotation cost is there, then company point of view. Sir, what exactly the difference is? Difference is very simple. When you are calculating IRR from investor point of view, your way is to identify how much rate of return he is generating. Who? Investor. And hence he is earning this much, means you say that this much cost you are paying. That is your observation. Whereas when you are calculating IRR from whose point of view? Company's point of view, means that is not the return. That is exactly cost you are paying to whom? Investor. Okay. That is. Now, is there any mandatory to pay preference dividend? Is there mandatory? No. The coupon rate of the calculation pattern of cost of preference and cost of debt remain same, or not same exactly. It is a similar. To whom? To not whom. To what? What? Cost of debt. So here we noted the cost of debentures should be done investor's point of view when there is no flotation cost. Flotation cost. Okay. With this, we completed cost of equity, cost of preference. Next, coming to another one is, what is that? Cost of equity. Yes, cost of equity. Very, very important model. Once this model is completed, then you know what is the observation we made it. Book value, market value, comprehensive model. 3 problems I will explain. Because if you attend this session, means certainly it would be benefit to you. Okay. Cost of equity. Cost of equity is nothing but it is the minimum rate of return the equity shareholders expects. So it is cost of equity is the minimum rate of return that a equity shareholder expects. So this is denoted as cost of equity is nothing but KE. It is denoted as KE. See, dear students, here some points should be, you have to understand. Key points. So calculation, it is a very difficult task. Which one? Which one estimation? Calculation of KE estimation is a difficult task because number one, no coupon rate. What is it? No coupon rate. Number two, no fixed obligation. No fixed obligation. Number two, expectation varies. Yes or no? Expectation varies. Equity shareholders expects different. In one company they will expect, what is it? We need only dividend, they will ask. In one company they will ask only, we need only EPS. Another company they will expect, what is it? Capital gain also they will expect. Some members they may ask individually, but some members they may ask, what is it? All. So that is the reason calculation of cost of equity is very difficult. At one point it says that no need to pay cost, no cost to be paid. Why? Why no cost to be paid? Because equity shareholder is a owner of the company. What ma? He says that owner of the company. But at the same time it says that risk reward, profit is reward of risk return trade off. You see, risk return trade off. Risk return trade off, it indicates what is this? If you take, if anybody takes more risk, he deserve to get what? More return. Hello? But then who is the highest risk taker in the market? Equity shares. Then he deserve to pay high return, right? But FM says that no cost to be paid. Why? Because he is the owner of the company, man. So that is the reason guesstimation of cost of equity become, what is it? Very difficult task to find. But that is the reason, because of considering all these factors, right? All these factors, we used to make different types of methods. So different methods are came into the picture. What are the various methods came into the picture means there are 4 methods came. Number 1, what is that? Dividend based. What is that? Dividend based came. Dividend based. Another one is EPS based. Another one is yield based. Another one is a risk based. These are the different points we have to consider. And how many ways, ma? Dividend based, EPS based, yield based, and risk based. First of all, if you comes to conclusion, here you see, where is, here it is our material. First irredeemable debenture coming to equity. First equity dividend based. In the dividend based, the formula is, in this, what is the assumption of this model is, and this model dividend per share remain, what is that? Same. Why remain same means, here company follows 100% dividend payout ratio. What is that? 100% dividend payout ratio indicates whenever company makes a EPS, from the EPS there is a 2 types of ratios would be. What are they? Retaining ratio is there. What is that? Retaining ratio. You see, EPS would be the combination between these 2. One is dividend payout ratio, another one is the retaining ratio. Now try to understand, when the company paying 100% dividend payout ratio, then what would be the retaining? Is there any chance of retaining? No. Why? Because you are giving a dividend. In such a case, when company follows 100% dividend payout ratio, then EPS equal to DPS. What the equity shareholders expects? They will expect only cash dividend. What they will expect? Only cash dividend they will expect. They never bother about the capital gain. So if at all equity shareholders expects only cash dividend, then company wants to follow EPS as to declare a dividend, and company wants to follow 100% dividend payout ratio, then cost of equity would be like this. Cost of equity equal to DPS1 divided by market price. Here in this model, what is that? This model also 2 versions. No growth in dividend model, growth in dividend model. In no growth, company follows 100% dividend payout ratio. That would be the reason KE equal to DPS 1 divided by net proceeds or market price. Net proceeds are market price. This is the way you can calculate the cost of equity basing on what model? Dividend price approach. Okay, ma? What is a dividend price approach? Tell me some futures. In this model, what will happen? EPS of the company, in EPS, company follows what? 100% dividend payout ratio. When company follows 100% dividend payout ratio, retaining ratio is 0. So here equity shareholders expects only cash dividend, right? Since company follows 100% dividend payout ratio, EPS equal to DPS. Then what is the cost of equity formula? DPS 1 divided by market price. Okay, ma? Right. Thereafter, another model is called earning price approach. Earning price approach is similar to your parents' approach. What the parents always says, whatever the amount we will earn, right? We won't take for you, for whom sake? For you sake only, you know. They used to make such a wonderful dialogues and go and ask if give me 2 lakhs rupees I want to buy dress materials, means they will give you 2, not lakhs, 2 slaps. But you know, final statement what they made it, yes, nothing but what? This is amount, whatever we are making, this is for you only. Same situation, equity shareholders also conveys. See, in this model, KE of the company is not the dividend paid. Hello? What he paid. But KE of the company depends upon what he made. Keep it in. It is not paid. It is what? Made. तेरे लिए वो कितना कमाया वही है cost. तेरे को कितना पे किया वो नहीं cost. Because you know, even from 100 rupees, the rest amount is with him, right? That amount is not his, yours only. So that is the earning price approach. In this approach, company never concentrates about the dividend paid. It considers how much EPS it made, earnings amount, how much earnings made, not how much cost it paid. In this model, what we will take? KE equal to, what is that? EPS divided by market price. So only simple logic you try to understand. What is this logic is? KE of the company not depends upon dividend paid. KE of the company is what it made. In this model, EPS equal to DPS only. Why? EPS equal to DPS only. Why? Whatever the EPS it makes, it directly pays as a dividend. Okay? That is another model. Whereas constant growth model, this is the growth rate model. This model was proposed by who? Yeah. First of all, in this model, growth is there means you should understand how a company gets a growth. How a company gets a growth. Growth is happens because of the 2 reasons. One is company has to at least maintain certain retaining ratio into rate of return on investment. So any person's growth rate is happens because of these 2 reasons. Number 1 reason is what? He has to what? Retain. He has to retain some amount and thereafter he has to reinvest somewhere else. So his return or growth rate depends upon 2 things. Mastermind made me paid salary last month. My growth rate is happens, whatever the salary they paid, I have to spend certain amount. Rest of the amount I have to keep and that balance I may invest in here and there. Then only growth will happens. Whatever the salary they used to give, every month I will celebrate Diwali. Then you know my life would be Bogi festival. Tagala padi poddi. Okay na? So that's why what is that? I have to retain and reinvest. Then only growth rate will happens. So growth rate equal to retaining ratio. Yeah. EPS consists of 2 parts. What are they? Dividend payout ratio, retaining ratio. Can you tell me Gordon model company has to give a growth, it should follow 100% dividend payout ratio? When you follow 100% dividend payout ratio, your retainings would be 0. Can you tell me what is the equity shareholders expectation in this model? Equity shareholders expects plus. What's our plus? They will expect a dividend, they will expect growth also. That is the reason in this model, cost of equity formula equal to DPS 1 divided by market price plus growth. So equity shareholders expectations are, what is that? 2 would be there. One is dividend, another one is growth rate. Okay, growth rate formula? Retaining ratio into rate of return on reinvestment. Right. Here, thereafter, there is a one more method came to the situation is realized yield approach. Here. Here, what is the growth rate model formula, Maji? Constant growth rate model. Constant growth in dividend model. This is not working here. Okay, you got the constant growth rate dividend model. Another one is realized yield approach. What is that? You see, what is the meaning of yield? Yield means return. Actually, the chapter is discussed with respect to what? Cost. But here, why they are considering return means return from whose point of view? Investor point of view. According to this method, what conveys how much return the equity shareholders earns, right? How much return equity shareholders earns? That return is nothing but what? Cost to the company. But how should I calculate the return earned by investor means this return depends upon your holding period. What is that? Holding period. For example, if I purchase a security 1 year, I purchase a security and hold for 1 year means I used to get a dividend benefit. Hello? Then I have to understand the two things. One is the dividend yield. What is that? Dividend yield. Because of my investment, how much yield I generated, that is called what yield? Dividend yield. And after paying a dividend, my share value is increased means, again at increased share price I sold means I will get it what yield? Capital gain yield. So capital gain yield. Now tell me, total yield equal to? Dividend yield plus capital gain yield. Dividend yield plus capital gain yield. So this is with respect to by holding 1 year. If it is not 1 year, sir, more than 1 year means what should I do, sir? Then you have to collect the data of the concerned client. You have to calculate IRR. What is that? IRR you have to calculate. 1 year means you have to calculate dividend yield, capital gain yield. More than 1 year means you have to follow IRR. Dividend yield is nothing but dividend divided by market price. At what price you purchased and how much yield you got it. Are you getting? So market price EPS, dividend divided by market price into 100, what yield? Dividend yield. Whereas latest minus late divided by latest value of equity share, and what the share price you purchased divided by the purchased price, then you will get it. What is that? Dividend yield. Are you getting? See, yield here it indicates you see, this is what method? Realized yield approach. Yield means return only, right? In this approach, what happened? When estimation of KE, when holding period is how many years? 1 year. 1 year means what yield you have to calculate? Dividend yield. If it is a dividend yield, capital gain yield. Dividend yield equal to DPS1 divided by market price. Capital gain yield means MP1 minus MP0 divided by MP0. So this can also be calculated. DPS1 plus MP1 minus MP0. With this also you can calculate the KE. But if it is more than 1 year, then you have to go with what is that? IRR technique. What is that? IRR. IRR from whose point of view? Investor's point of view. Then that is the next one is what method is there means capital asset pricing model. Dividend yield formula? Dividend yield. DPS1 divided by market price. Capital gain formula? M1 minus M0 divided by M0. So this is the capital asset pricing model. This model was suggested by Sharpe. What is that? Sharpe. So this is also called Sharpe model. This model conveys that KE of the company depends upon risk element of the company. What is that? KE of the company depends upon a risk element. Risk here it indicates, you try to understand an elephant who is walking. See, from here to here means it is taking some risk, right? So certainly it should be get some benefit than what it is getting here. Hello? So this model conveys, first of all, you should understand what is, here the question arises, what is risk? What is risk? Tell me. What is risk means you should understand what is risk. Risk indicates uncertainty of return. If you invest in any company, so there is a probability or chance to either receive or not to receive. What is that? Your invested amount or return. That is called risk. There are two types of risk. One is diversifiable risk. Diversifiable. Another one is non-diversifiable risk. Diversifiable risk also called, what is that? Unsystematic risk. What is it? Unsystematic risk. Non-diversifiable risk is called systematic risk. So systematic risk arises because of not domestic factors, but what? External factors. So this non-diversifiable risk is systematically measured, which is called beta. This beta would be in three ways. One is greater than 1, equal to 1, less than 1. If beta is greater than 1, what to do? You have to pay high cost. Beta is less than 1, low risk, lower cost you have to pay. And if it is a beta equal to 1 means it is a normal. According to this model, what the logic behind is this: KE of the company consists of two parts. What is that? Risk free plus what is that? Risk premium. One must get the risk free rate as usually. Along with that, one has to get what is that? Risk premium. Here risk premium, it indicates how should it be identified is KE equal to RF you have to give. Plus here there is a RM. RM means return on market portfolio, which consists of two rates. What is that? Risk free rate, risk premium consist. Already you have given what is that? Risk free rate. Now to find it out risk premium, what do you do? From RM, if you deduct RF, you will get what? Risk premium. That risk premium you have to give. How much you have to give is depends upon beta. Then you have to bring the beta value here. If the beta is greater than 1, you have to give high risk premium. Less than 1, what is that? Low risk. You know the law of demand formula? Can you tell me law of demand? As price increases, demand decreases. Very good. Do you know law of supply? What it indicates? As price increases, supply increases. Can you tell me this CA-PFBM approach? Which law it is very close to? Law of demand or law of supply? How? What, Maji? As price increases, supply increases. That indirectly conveys what? As risk increases, that cost also should be increased. This is the formula. This formula suggested by who? Can you tell me what is risk? Uncertainty of risk. Types of risk. Diversible and non-diversible. Which risk is not at all measurable? Which risk is that is measurable? Which one? Non-diversible risk. Another name is a systematic risk. That is a measurable. That could be in three ways. What is that? Greater than 1, less than 1, equal to 1. As this beta increases, risk premium should be paid more or less? More to be paid. Getting? That is the important point. So this is with respect to cost of equity also. We completed according to CAPM approach. KE equal to RF plus beta into RM minus RF. Then you have another one is, what is that? Retained earnings. Retained earnings are funds belongs to whom? Equity shareholders. Whenever there is an existing company, that too high profit making company, that too whenever it retains certain profit belongs to whom? Equity shareholders. Instead of distributing, in such a case, the company has to calculate cost of retained earnings, KR. So sometimes it would be calculated in two ways, KE equal to KR. KE equal to KR, because equity belongs to whose funds? Equity shareholders funds. Retained earnings also funds belongs to whom? Equity shareholders funds. In such a case, KE equal to KR. But conditions, there should not be what cost? Flotation cost. But whereas sometimes this is the one approach. Second approach, what happened? We used to calculate KR. KR, you know, how do we calculate? Means sometimes investor expects certain rate of return. When he expects certain rate of return, what you do means you have to deduct what is it? Its brokerage. If you invest outside, whatever the brokerage will goes, you deduct it. Minus 1 minus personal tax. What is that? Personal tax is there. The tax also you can pay. After paying this one, whatever the amount you will get it, that you can declare. This is an important point, right? Personal tax also you have to deduct. So two approaches you can follow. One is that, what is that? KR equal to KE. KR equal to KE. Another one is, see, cost of retained earnings. First approach, what do you say? KR equal to KE. Cost of retained earning equal to cost of equity. Sometimes we may calculate what is that by considering, see, we have to deduct a brokerage, we have to take what is that? Personal tax. From his expected rate, we can calculate cost of equity. And this is the way we have studied all the specific cost. Can you spell irredeemable debenture formula? Interest into 1 minus tax divided by net proceeds. Can you tell shortcut method formula? Interest into 1 minus tax plus RV minus NP divided by RV. Yeah. Do you know the logic why we made it N? Because N number of years. Because that loss should be we have to bring into per annum. Because to add to interest. Okay. Thereafter, what is that? Cost of debt, cost of preference calculation is similar. There is a dividend model. No growth in dividend model. KE formula. DPS 1. Yeah. EPS model formula. EPS divided by market price. CAPM approach formula. KE equal to RF plus beta into RM minus RF. Realized based basing on realized yield approach based. KE also we can calculate, right? Where if you holding for 1 year, you can calculate what? You can calculate where KE equal to dividend yield plus capital gain yield. If you hold for more number of years, IRR you can technique. These are the specific cost. Once the specific cost is completed, then we can calculate what cost? Weighted average cost of capital. What is weighted average cost of capital? Just now, beginning of the chapter itself, I told that whatever the specific cost you estimated, what you do means you have to add all the specific cost. Weighted average cost of capital is the systematic summation. What is that? Systematic summation of various what cost? Specific cost. Specific cost, what are they? KE, KP, KD. Another one is KR. You see, what is weighted average cost of capital? Weighted average cost of capital is also known as overall cost of capital. It is a systematic summation of various specific costs. How do you calculate this format? You try to understand. To calculate weighted average cost, you can follow these two techniques are given in study material. One is you understand what is the capital structure they raised. Then you go with an amount. Then you go with a weight. What is a weight? From this total, you can take this specific amount. Hello? Then you will get the weights. And you calculate the specific cost. And the cost of capital would be, how do you get it? E equal to weights into specific cost. WS. What is that? WS, keep it in mind. WS is the summation of WS is nothing but weighted average cost. First you have to take capital structure, then you have to go with amount, then weights and specific cost, and if you multiply both, you will get it. This is the way to find it out, various cost. What about the marginal cost? The word marginal represents what is that? Additional. Marginal cost of capital means the word additional cost. Whenever the company wants to raise additional funds, in such a case, we have to calculate what cost? Marginal cost of capital. See, one important point you have to keep it in mind that whenever you are raising additional funds, okay, additional funds means that too from debt means automatically risk element what happen? Increases. For example, I'm an existing company. I have 100 lakhs. Okay, I have 100 lakhs. Now I need a 20 extra. If I calculate 100, that is the cost of capital. With the 20, if I calculate for 120, what is the cost of capital? Then it is called marginal cost of capital. Are you getting ma? 100 if I calculate, that is the cost of capital. Additionally, I want to raise one more 20. This time I want to calculate 100 plus 20. Then it is called marginal cost of capital. So to calculate marginal cost of capital, one point you should understand. Already you have a debt, right? Yes, sir. Additionally, you are raising 20. Yes, sir. If additional 20 also consists of debt means old debt, new debt will increase. What? Risk to whom? Equity shareholders. When risk increases to equity shareholders, you have to understand cost of equity to be recalculated by keeping risk perception. For that purpose, what happened? How should I know that the equity shareholders risk is going to increase, sir? How should I know, sir? Very simple. You see, before when 100 lakhs is there, at the time dividend is different. When 120 you are thinking, at the time dividend is different, growth rate is different, market price different. Dividend increases, growth rate increases, market price what happened? decreases. So this is the point you have to keep it in mind. Now tell me, cost of capital, marginal cost of capital, both are same. What is the cost of capital? Cost of capital means whenever you raise a given sources, if you sum it up all the sources, you will get what? Cost of capital. Marginal cost of capital means additional cost of capital. When you are additional cost of capital, what the point you should keep it in mind? Array, already you have a 4, additionally you are raising 1, hello? Already old debt also is there. Additionally you are raising debt means old debt plus new debt. Total debt what happen? Increases. In such a case, risk will increase, right? So for that purpose, how to conceive means whenever additional funds are raised means you have to understand the risk element of equity shareholders. For that purpose, you check what about the dividend. Dividend increasing means risk increasing. Growth increasing means risk increasing. Market price increasing means, market price decreasing means risk is what is that? Decreasing. So this is the point to be kept in mind. Okay. Then based on this, we have a very important problem here in this model. You see, this is the problem, PK limited problem. Actually the company has how much money? Let us take amount in lakhs. If you take 200, 60, 100, the company current share price is how much? 20. Whereas next year dividend to be paid 10 per equity share, which pays how much rate? 5%. Assume tax rate is 35%. Compute weighted average cost of capital. Okay. Along with this, what the company is saying? Compute what is that? New weighted average cost of capital. If company raises additional 50 lakhs by debt, here 50 is there. Already previously 100 lakhs is there. 100 plus 50, 150 lakhs. So a lakh by debt issuing what rate? 12%. Previously how much debt? 10%. Now because of this rising debt, there is a risk element to whom? Equity shareholders also. Okay. So that is debenture. This would result in increase in expected dividend. Equity dividend would be how much? 12.40. So previously how much this dividend? 10 rupees. Now it will goes to 12.40. Growth rate remain unchanged, but the price of equity should be 160. Previously share price is how much? 200. Now it become 120. In such a case, how should we solve this issue? Means simple. I made it so small observation. You see it. This is the problem. First, what you have to calculate? Estimation of specific cost. Cost of equity. Are you getting ma? Cost of equity. Market price, growth rate, DPS 1 given. I calculated KE. KE is how much? 10%. Cost of preference. Preference dividend divided by net proceeds. 11.5%. Cost of debt. Already 10 is the interest into 1 minus tax divided by 100. So that is a 6.5%. Now I have to calculate what is this? Weighted average cost of capital. Weighted average cost of capital. Either you can go with the table. Whatever the table is there, W into S, you know. So to make a W, total divided by specific cost. You see, equity share capital divided by total capital employed. With this I used to get what? W. And I have to multiplying with what? KE. What, Maji? So instead of table, I am using like this. So KE into equity share capital divided by total capital employed plus KP into preference share capital divided by total capital employed plus KD into debt capital divided by total capital employed. By estimating this, you got a 9.27%. This is just cost of capital. Okay. But whereas you need to find it out, what is it? Marginal. Additional cost you are raising, right? So in calculation of marginal cost of capital, cost of equity changed, right? Cost of equity market price is how much? 160. Growth rate is 5%. Dividend per share is 12.50. Then KE would be 12.75% K. Coming to cost of preference, remain same. Cost of old debt, remain same. But cost of new debt changes, right? Because you are rising at 12%. 1 minus 0.35 divided by 100 into 10. You will get it how much? 7.5%. 7.8%. Now you can estimate weighted average cost, that is indirectly marginal cost of capital. So KE, equity share capital divided by total capital employed plus preference share capital divided by total capital employed, debt capital divided by total capital employed plus KD. And this is old one, this is a new capital. By estimating you will get it, what is it? 10.41%. 10.41%. Okay, this is the way used to calculate cost of capital, and marginal cost of capital. There is a one more model also covered in study material, that is nothing but basing on what value? Cost of capital basing on book value, cost of capital basing on market value. What is the book value? Number of securities into issue price would be what value? Book value. Whereas market value would be number of securities into what is that? Market value. Market price as on today, if you take it, it is a market value. So examiner will ask you cost of capital and marginal cost of capital, or you may ask cost of capital basing on book value and market value. For 5 marks they will consider it. Okay, but how do we solve the cost of capital book value? Means you try to understand one simple point. Same calculation procedure, but number of securities into issue price you will take. Issue price you will take, then it is called book value. Market price you will take, that is called market value. Sir, which value to be taken into the consideration, sir? Are book value is a historical value, man. Even if you take it, it does not convey your current status. That is better to take always market value. But the thing is, one of the surprising factors, even if you calculate market value, after calculation, if you check, market value gets changes. What is that? Market value always gets a fluctuated. That's why which value would be preferable means to know the current status, always which value is preferable? Market value. But while calculating market value, you have to understand one Maha Mantra. That is nothing but no equity while calculating weighted average cost of capital basing on what value? Market value. If there is no flotation cost, there is no need to calculate equity retained earnings separately. Why? Because retained earnings would be part and parcel of equity. Hello? If there is a flotation cost is there, in such a case, you have to understand what is the composition of equity and retained earning. In the same composition, you have to split the market value also. Suppose I will tell you simple example. In market book value, I have 50 lakhs of equity, 50 lakhs of retained earnings. Total is how much? 100 lakhs. Hello? Since I used to calculate KE for equity, KR for what? Retained earnings. In the market value, I have 500 lakhs. How much, ma? I have 500 lakhs. Suppose if there is no flotation cost means okay. But if the flotation cost is there means KE is not equal to KR. In such a case, market value consists of two parts. What is that? KE and KR also. In such a case, for KE, for KE you have to calculate, KR you have to calculate. Sir, in such a case, market value, how should I do, sir? Because market value is a lump sum amount only. In such a case, what composition equity and retaining is there? 50-50%. So now what you have to do here also? You have to also make a proportionate in same proportionate. Means 250 you have to take for equity, 250 you have to take for retained earnings. Okay, this is when apportionment you have to do when there is a flotation cost. No need to calculate KR and KE if there is no flotation cost. Only this point is the one of the problem in our material. But remaining rest would be the same. For example, in the problem you check it. So equity is there. What is that? Equity 10. Retained earnings 5 lakhs. In market value it is a 2 lakhs. Retained earning is nil. Preference shares nil. Preference shares 7. Debenture is there. Now after tax cost of capital difference, equity share capital is given. Retained earnings are given. Preference share is given. Debenture is given. Calculate weighted average cost of capital, book value and market value. In such a situation, what we have to do? You see here we are calculating what value? Book value. Retained earning amounts, weight, specific cost, weighted average cost. Whereas if you calculate what is it? Capital structure, you are going to proportionate which one? Retained earnings and equity. Why? You see the problem. What is that? Cost of retained earning is how much? 15%. Whereas equity is 8%. So KR is not equal to KE. In total, 10 plus 15. Total in 15, 10 is what is that? Equity, 5 is retained earning. In such a case, from what the same proportionate you have to split here also. What is that, ma? So here for total 15, what the same proportionate is there, same this 20 also it should be apportioned. Here it is nothing but you have to take 13.33 is the equity share capital, retained earning 6,66,667. Now tell me, I will ask one small question. If it is 18%, then no need to calculate. Okay. So this is the way you find weighted average cost of capital. Dear students, total I made it entire summary. I observed certain points. I am bringing in front of you total 30 points. This 30 point, beyond this, examiner never cross border of the paper. Okay. Okay. More than this is nothing, because just to keep it eye on all the points. What is that? Keep an eye on convertible debenture. See, more than regular class, 20 hours I used to take this one. But here I used to confess it into 1 hour. It's highly impossible. But the thing is, my best I am doing. With that time period, what I have to convey, because, if I start to solve one problem, how beautiful our students write. I know that better experience. For one problem, 2.5 days we used to write. So they will apply fair and lovely. So such a situation, I want to convey this one within the given time frame. I cannot able to solve the problem. If I solve one problem, that's enough. Even with a lot of attention, I solved capital budgeting problem. I know that one problem goes out. Within 1.5 hour or 1 hour, we have to complete. But what I thought I collected all the core information I am presenting here. Examiner maximum will ask only this information. Cost of convertible debenture. The debenture which would be converted into equity at the end of the period, whose cost would be calculated, is called, what is it? Convertible debenture. What is the fair value? Fair value is nothing but present value of future benefit. For example, if I purchase a debenture, whatever the benefit I am going to get it from this debenture, if I bring the total value into present, that is called what value? Fair value. Fair value also called intrinsic value. What value? Intrinsic value, investable value. Then redeemable debenture. Principal amount never be paid. Never be paid. Paid. Irredeemable debenture. It is redeemable debenture, redeemable preference share. Growth rate, advantage on interest, explicit cost, implicit cost, cost of equity basing on growth rate, cost of retained earning, marginal cost of capital, capital asset pricing model, risk element to equity shareholders. Hello? And risk element to debenture holders. Debenture holders risk element does not make any sense. So, okay, risk element of equity shareholders, when risk element of equity shareholders increases, means he will expect more dividend, and he will expect, what is that? More dividend he will expect, and more growth rate he will expect. What? Market price, he invest less. Then the flotation cost treatment, realized yield approach, all these methods, these are the key points. If you go with this, all the points, right, there would be a question. Maximum he may ask you 10 marks question, you can comfortably handle. Okay, ma? Right. These are the point which is available. I will give you this material, no problem. Okay, Maji? And here, what are the topics? These many topics covered. This one, ma? Where it is? Here. Flotation cost. What is another name of flotation cost? Issuing cost. A deep discount bond. I discussed it several times. No interest to be paid. At the end they have given. Importance of cost of capital. Why company used to calculate cost of capital? Because whenever they used to go for financing decision, they want to know the cost of capital. Whenever they will go for investment decision, they want to know the cost of capital. And the realized yield approach, earning price approach, thereafter, and why we do RV minus NP divided by N. Why we will do N, why we will do 2. There is a 2 questions. N when will we do? 2 when will we do? RV minus NP to identify whether we have a cost or loss. R denominator to find it out average investment. We will make what? 2. Okay, irredeemable debenture. Irredeemable debenture. Formula for redeemable debenture, that is okay. Cost of preference. Okay, how do we derive KE? KE for how many methods we have? Dividend price. EPS based, CAPM approach. Yeah. Do you know difference between DPS 0, DPS 1? Dividend already paid. Dividend to be paid. Marginal cost of capital, weighted average cost, both are same. 100 cost of capital, 120 is marginal cost of capital. Okay. Number of security into issue price is nothing but book value. Number of security into market price. Right. So this we concluded this part. Then next one, cost. Two chapters damn important. You know that first investment decision, cost of capital. Another one is capital budgeting is there, but capital structure is there. Capital structure is important, but not that much of which one? Comparing to capital structure, cost of capital plays very dominant role. Let's make capital structure before lunch. I will conclude. What is your investigation here? From 2018 say, now you can make your own observation, become a James Bond, make investigation. ఏం కనుక్కున్నారు చెప్పండి ఇక్కడ क्या पता लग गया रे which model is being asking sir EBIT EPS analysis only asking sir thereafter financial break-even point sir thereafter nothing sir but you know there is a what approach net operating income approach sir theory asking sir that too without tax sir with tax also they ask sir that means sir Balu sir by attending this theory part right you have to convey two models sir what is that one is what is that EBIT EPS analysis one sir financial break-even point indifferent point analysis one sir another one is a net operating income approach theory sir Balu sir with tax without tax that's enough sir if it is a follow same trend he will follows so he may ask you but the thing is you know Balu sir certainly EBIT EPS analysis he may not ask why समझ गया ना इसको छोड़ दो इस बार so what method no I will explain but our analysis speaks that this time ये में पूछेगा क्या which one ma financial break-even point why my analysis is EBIT EPS analysis getting closure right he may not ask but comparing to this one theory also asked it 2 years back but you know बहुत long हो गया what financial break-even point so that's why this method may be they may consider if not so what is that theory with tax or without tax sir what is this called strategy okay it may work it may not work Array, something is better than nothing right okay so that is the observation yeah coming to EBIT EPS analysis our class up to no they given like this yeah but okay I will leave 1 o'clock no problem see capital structure simply what is a capital structure means you see these are the people Satyam Computers whereas Vijay Mallya ji whereas Coffee Day CEO and Reliance company that three people they could not design you know if you observe their balance sheets and if you find it out their strategy Satyam Computers went for 100% equity okay but he lost his ownership whereas Coffee Day who is our Guruji Vijay Mallya ji 80% debt it does not work Coffee Day CEO 95% debt whereas Reliance 51 equity 49 debt they maintain proper relationship that's why their share value moving in such a way that tomorrow you know entire Mumbai these people will buy keep my word right one day will come where Mumbai 90% will be in the hands of Reliance they will buy and one time period 30 to 40% India would be in the hands of Reliance only the same progress will goes out yeah some simple you should understand what is capital structure capital structure is the mix of long term funds or short term funds long term funds in order to make this long term funds observation see capital structure is the mix of long term funds long term funds in order to every company ultimate objective is to select a capital structure is an what is that optimum one to find it out see capital structure it is a mix of what funds long term funds what is the objective of capital structure to determine optimum capital structure what is an optimum capital structure means at that capital structure you supposed to generate what is that highest EPS and highest No, highest market price and lowest, what is that? Weighted average cost. Any capital structure makes you such a way, then it is called, what is that? Optimum capital structure. See, to determine optimum capital structure, everyone has to consider three elements. What is that? Risk, cost, control. And here the point is, to determine cost should be high or low? Low. Risk should be low. Control should be? Control means what? Ownership rights. And at the same time, government rules and regulations also must be considered. Government rules and regulations also must be considered. Are you getting my point, ma? For cost means low cost you have to raise, means you have to go with what? Debt. For risk, equity. For ownership, if you want to protect, go with equity, sir. Debt you have to go to protect your ownership. And for the government rules and regulations also you have to follow. When you are raising funds, you are doing business, you have to concentrate government rules and regulations. Just now I told you, one of the Madam G, okay, that is. So to determine optimum capital structure, we have to make different types of analysis. In exam, what analysis they've been asking, ra? EBIT, EPS analysis, EBIT market price analysis, indifference point analysis, financial break-even point analysis. Analysis means systematic study, ra. After making all this analysis, one person can identify which capital structure is optimum. And along with this analysis, he can follow approaches. So approaches indicates net income approach, net operating income approach, traditional approach, and approach. First here you try to understand, every corporate company, they will give you certain capital structures like plan 1, plan 2, plan 3, plan 4. What you have to do is, from the given capital structure, you have to estimate which capital structure is the optimum one. First one, examination they've been asking, right? What analysis? EBIT, EPS analysis. What you have to do is, from the EBIT, you calculate what is that? EPS. Which financial plan comes what is that? Highest EPS, that would be recommended as optimum. Are you getting? So here, to find it out, EBIT, EPS analysis, it is the analysis. The optimum capital structure can be identified by estimating EPS from EBIT. Which financial plan consists, what is it? Highest EPS, that would be declared as optimum capital structure. See, how do you calculate EBIT? Sales minus variable cost minus fixed cost. Or else you can also calculate like this: total capital employed into rate of return on capital employed. Hello? There is EBIT equal to EBT plus interest. So to find it out, this one, you have to understand the structure. Every financial plan, you have to take sales less variable cost, contribution less fixed cost, EBIT less interest, you will find EBT less tax, EAT less preference dividend, earning availability to equity shareholders, number of equity shares, you will find what? EPS. So this is the way you can find it out, EBIT, EPS analysis. Along with that, you can also find it out, one more is nothing but EBIT market price analysis. By combining this both, I will tell you. What is this first one? EBIT, EPS analysis. Another one is here to market price analysis. What is EBIT market price analysis means? In this analysis, along with EPS, we will calculate which one? Market price. Market price we calculate by taking which support? PE ratio. What is PE ratio? You have to understand. PE ratio is the ratio which shows the relationship between EPS and market price. How many times the market price is higher comparing to its EPS can be learned with PE ratio. If PE ratio of the company is 20 times, what do you mean of this? If 1 rupee it is earning, its market price is 20. Okay. By analyzing the PE ratio, we can understand that whether the security is overvalued or undervalued. So here the what is PE ratio? It is the ratio which shows the relationship between, it always conveys in times. PE ratio equal to market price divided by EPS. Then market price equal to EPS divided into PE ratio. Then EPS equal to market price divided by PE ratio. It should end చెప్తున్నాడు. అరే బాలు సార్ ఎన్ని ఫార్ములాస్ చెప్పేశాడే. ఆ ఫేస్ ఎక్స్ప్రెషన్ ఏదమ్మా? రైట్. Observation is, చూడండి, when debt increases, debt is high, risk also Then PE ratio low. When PE ratio low means automatically market price would be low. That means debt creates risk. Risk downs PE ratio, which downs what is that? Market price. So debt is low, risk low, PE ratio high, market price is high. So this is the observation. You have to make such a James Bond, right? With this problem, we will complete this two analysis at a time. Which one? EBIT, EPS analysis, EBIT to market price analysis. Actually, they have given my time is 1:30. What the timetable they given to you? Do you get any time? No, they given 1:30. See, if it is a 1 o'clock means afternoon session, what the time they given? 2:30, yeah? 3:30. 1:30 to 3:30. This one problem only. Yeah. This is the problem from study material problem, the Quality Automation Limited. With this model, we can discuss the two concepts. What are they? EBIT, EPS, and EBIT market price analysis also. The problem is given like this, dear students. Profit before interest and tax they given, less interest they deducted. Then you got the PBT. Income tax rate is 50%. Whereas here profit after tax they given. Number of equity shares is 80,000. EPS is 25. PE ratio is 10. Now present PE ratio is given. Dear student, try to understand. In the problem PE ratio is there means you should not stop the problem at EPS. You have to take to this problem up to market price. The market price, current market price is 25. Now what the problem is speaking, the company is planning to start a new project, required total capital outlay of 40 lakhs is needed. How much? 40 lakhs. This is their present capital employed. This is present capital employed. Now the situation is the company wants 40 lakhs. You are informed that debt equity ratio higher than how much percentage? 35% pushes the KE up to 12.5% means reducing the PE ratio 8 and raises the interest rate. Additional amount borrowed is 14%. Find out the probable price of the share it. If additional funds are raised by loan and additional funds are raised by equity. So with this we can state the two analysis. That means you try to understand. They are asking what is that? Additional market price they are asking to find it out. Market price, how do you find tell me? Market price equal to EPS into PE ratio. But the retained earning of the company also how much? 12 crores. Now 1.2 crores is there. Now the additional point is very simple. What you have to understand in the problem is, see, present capital employed, how much it is there? Present capital employed is number of equity shares into 10 rupees. How much it is? 80 lakhs. Debt capital is there. How do you calculate debt capital? Interest divided by rate of interest. Hello, ma? So 10 lakhs. Undistributed reserves also is there, 120 lakhs. If you total sum it up, you will get what is 300 lakhs. Hello? Now, what is that present rate of return on investment mean? Present they must earning, how much their EBIT they been earning? 52 lakhs. Hello? 52 lakhs they been earning by spending how much? 300 lakhs means what is their present rate of return on investment is 17.33%. That means if the additionally they will raise either 100, 200 lakhs, 300 lakhs also, if nothing is mentioned in the problem, the whatever the rate of return, whatever the rate of return the company been earning, the same amount they may generate in future also. Present how much rate of return they been generating, if nothing mentioned in the problem, in future for rising any amount also, they will generate the same capital. Now additionally they are raising how much capital employed? 40 lakhs. So you have to you have how many plans? Two plans. What is the first plan? Debt. Another plan is equity. To calculate market price, you need to find it out EPS. To calculate EPS, at least you need EBIT. How much you will find the EBIT? EBIT how much, sir? Shall we take 52 lakhs, sir? That 50 lakhs is the present or proposed? Present. 52 lakhs is the present capital employed of the company. Now such a present capital employed company is rising additionally 40 lakhs. That means for their additional, this with this capital employed, certain additional capital is getting to be added. Then in future, how much EBIT we supposed to generate? Problem is silent. In such a case, what to do? Sir, present how much rate of return they been earning, and the additional funds also same return they will generate. That is the reason first we calculated present rate of return on capital employed. Present rate of return on capital employed is how much ma? 17%. On the additional funds also they will generate 17%. For that purpose, what I have taken EBIT. First 15 lakhs. First EBIT present propose you have to take. What is the present employed? Here, what is this? Present how much ma? Not 20% it is. What we have to take? Present capital employed, how much it is? Here, present capital employed is, we calculated 300 lakhs, additional capital employed. So, you have to take the two versions. What you have to take? First one, what you have to take? Debt you have to take. Another one is equity. So, you have to estimate EBIT. What is that? EBIT. EBIT present capital employed 300 lakhs. From 300 lakhs plus, this is the 40. Total 340 lakhs, 340 lakhs into what rate we have to take into the consideration? Same 17.33 you have to take. 17.33 if you multiply, you will get what is that? EBIT. What you will get it? EBIT. Actually, this is the 1 minute. This is the cost of capital. Here it is. EBIT used to get it. Here I have taken. This is marginal cost of capital. This is capital structure. Yeah. Here it is. So the problem is changed, I think so. Okay, no problem. Here, what we do is, we used to calculate present capital employed. Are you getting? Present capital employed. The same procedure, what we have to do? EBIT you have to take. From that, what is it? Less interest. Interest includes what is it? Two interest. What is that? Old plus new interest you have to take into the consideration. Then you will get the PBT. Less tax, PAT. Then if it is a preference dividend is there, if you have to take. But if the preference dividend is not there, then what to do? If the preference dividend is not there, okay, here it is. Preference dividend is there and the problem? No. So what we have to do means you have to take EBIT, from EBIT to what is it? Less interest. Old interest plus new interest. From the old interest minus new interest, you will get what is it? EBT less tax, what is it? EAT divided by number of equity shares, you will find what is it? EPS, right? After calculating EPS, you have to find it out debt equity ratio in each of the financial plan. Hello? Once you calculated debt equity ratio in each of the financial plan, if the debt equity ratio is more than 35%, then the PE ratio from 10 to you have to come to 8. Hello? If the debt equity ratio is less than 35%, then you can take what is it? PE ratio, how much? 10. By multiplying debt equity ratio with what? EPS, then you have to find it out. What is that? Market price. So this is the procedure we have to calculate. So we have to calculate what ratio? Debt equity ratio. We have to find it out each of the sources. Basing on that each of the sources, you have to take PE ratio and whatever the EPS you calculated, EPS into debt equity ratio, if you multiply, you will get what is that? Market price. Which financial plan consists what is it? Highest market price, that should be recommended. See, option 2, issue of 100% equity is the most, maximize the market price of share. This is the optimum. Basing on this, we can find it out two things. Number 1, what is the PE ratio? What is the PE ratio? It is the ratio which shows the relationship between two things. What are they? Market price and, yeah, as PE ratio increases, market price increases. As PE ratio decreases, what is the debt equity ratio? In the problem they are given a debt equity ratio. What is the debt equity ratio? It is the ratio which shows the relationship between debt percentage in total capital employed. So debt equity ratio formula is debt divided by capital employed. So another one is, how do you calculate EPS? How do you calculate EPS? Earning availability to equity shareholders divided by number of equity shares. How do you calculate market price? EPS into PE ratio. How do you calculate return on capital employed? EBIT divided by total capital employed. How do you calculate total employed? Total capital employed. So total capital employed, you have to calculate equity capital, sir. How do you calculate equity capital? Number of shares into share price. If you multiply, you will get what? Equity capital. So debenture interest amount divided by rate, if you take into the consideration, then you will get the debt capital. Yes or no? Then retained earnings, if you take into the consideration, by adding 3, you will get the total capital employed. EBIT divided by total capital employed. You can find it out this. So in the given financial plan, by taking EBIT to, you have to make a journey to EPS, and by multiplying with the PE ratio, you will find what is that? Market price. Comparing to EBIT EPS analysis, this model is very, very important. Okay, this is the EBIT EPS analysis. And then there is another analysis they given, indifference point analysis. What is that? Indifference point analysis. See, first, what is EBIT EPS analysis? From EBIT we calculate EPS from market price. Now this point is indifference point analysis, financial break-even point analysis. Financial break-even point. Do you know what is the financial break-even point? 2 marks question, MCQ. Financial break-even point. Break-even point indicates what? No profit, no loss. So financial break-even point indicates that is the level of EBIT at which EPS is 0. So whatever the profit you will make, that profit entirely used by the company to make their settlement of cost. So when company makes a profit, but in the pocket nothing. Why? Because that cost goes out. So financial break-even point is level of EBIT at which EPS remain 0. Then what is the indifference point analysis? It is level of EBIT at which EPS remain same. Between the two financial plans, if you want to select which plan would be the best means, you have to identify indifference point. At the indifference level of EBIT is there, suppose 40,000. Suppose 40,000 is there. What we can convey, hello, Mr. my dear client, you need a given amount. You have 2 financial plans. One is 100% equity, 50% debt to 50% equity. You want to select which plan would be the best. So if the indifference point is 40,000 means, what it conveys, by using this given plans, if you raise a capital, by doing business, if you make just this 40,000 rupees of EBIT, no need to worry in selection of the given financial plans. Why? Because both the plans will give you same EPS. This is the indifference financial plan. Indifference point. What is a financial break-even point? It indicates from the given financial plans, whatever the plan you are going to choose, you have to consider the commitments of the concerned plan. For example, a plan is there, equity is there, debt is there. What is that? Equity is there, debt is there. If I choose equity, is there any commitment? Is that certain amount I must able to earn? No. Why? Because that is a equity. What I will convey, if you choose this plan, no financial commitment, just you are relaxed. But sir, next plan I will choose, sir. What is the next plan? Sir, 50% equity, 50% debt, sir. That plan suits to you, man, once you are able to earn how much? The remaining 50% debt you are raising, right? On the debt you have to pay what? Interest. So unless otherwise you cannot able to earn to the extent of interest, it is a very, very danger. See, financial break-even point indicates if you want to get a Rama like a husband, you must be Sita. If you want to get a Sita like a wife, you must be Rama. If someone tries someone, you know the story. Ek ko nose gaya, ek ko head gaya. Rest you will identify. That means Once you are committed to implement the concern plan commitment, you have to commit to commitments of the concern plan. For example, simple logic. You decided to complete CA, but you are reading like a BA. In such a case, you cannot pass BA also. Reason is very simple. You are not going to write BA. So this is the two plans, ma. Financial break-even point, indifference point. Tell me, what is the financial break-even point? It is the level of EBIT at which EPS remain 0. Where is indifference point? It is the level of EBIT at which between two financial plan, EBIT remains, what is it? Same. You see, indifference point. The word indifference means no difference. Analysis means systematic study. What is indifference point? It is nothing but the level of EBIT at which EPS remains same in between two financial plan. What we estimate? We will estimate EBIT. What analysis could be made? At that level, EBIT, EPS remains same for the given two financial plan. How do we select an optimum capital structure basing on indifference point? If the company earns more than indifferent point, take what plan? Risky plan. If the company earns less than indifferent point, take what? Less risky plan. If company earns the same indifferent point, then there is a no difference. So this is the indifference point analysis. Dear students, in EBIT EPS analysis, selection criteria is what? Highest EPS. In EBIT market price analysis, selection criteria is highest market price. In indifference point, we will identify that at that given level of EBIT, if the both plan will gives you, what is it? Same EPS, then there is no need to worry because both plan will convey same amount. So indifference point formula, x minus interest into 1 minus tax minus preference dividend divided by number of equity shares. So x minus interest into 1 minus tax minus preference dividend divided by number of equity shares. Balu sir, formula remains same only. Formula same, but values are not same. Preference. So this indicates indifference point. And financial break-even point, just now I told you, it is the level of EBIT at which EPS is 0. For example, EBIT should be equal to fixed financial commitments of the plan. For example, plan 1 you choose 100% equity. This is, what is that? 100% equity means, is there any financial break-even point? No. Whereas if you choose 50% equity, 50% debt means, yes, financial break-even point is there to the extent of interest. 50% equity, 50% preference is there. Then financial break-even point is nothing but preference dividend. But you know, one more secret is there. When you are calculating financial break-even point for preference dividend, what you have to take into the consideration means preference dividend divided by 1 minus tax you have to consider. Okay, that is the important point. Coming to see, this is the problem you try to understand. This is the several times been covered in our exam. This is the problem you try to understand. Very simple problem. Nova Limited has a 60 lakhs in debt. Outstanding interest they have to pay what rate? 10%. And they wishes to 40 lakhs they need for expansion. They have alternative 1, alternative 2, alternative 3. In 3 alternatives, they are going to company presently they have how much? 6 lakh equity shares. And 50%, here it is, the tax bracket is how much? 50%. It earns profit before depreciation presently how much? 18 lakhs. Basing on this, they are asking, calculate earning per share, calculate market price by considering PE ratio 10, 15, 20 and calculate what is it? Financial break-even point, calculate indifference point. How many points covered in this problem? Earning per share covered, market price covered, financial break-even point covered, indifference point is covered. Now, if you check the solution, first you have to calculate earning per share. What is the procedure you can calculate earning per share? So here it is, debt is there, preference is there, equity is there. What you will take? EBIT less interest. Interest indicates old plus new. You will get the EBT less tax you will deduct. you will get what is it? EAT less what you will pay? Preference dividend. You will get earning for equity shareholders. Then you take number of equity shares. Then you will get what is it? EPS. Which financial plan providing highest EPS? Plan 3. So this is what analysis? EBIT to EPS analysis we completed. This format is very, very important for that. And then you have to calculate market price. How do you calculate market price, ma? EPS into PE ratio. Here the EPS is given here. Plan 1, plan 2, plan 3. PE ratio given. Plan 1, plan 2, plan 3. Market price equal to EPS into PE ratio. As per this, which plan market price is highest? Yeah. Thereafter, you are going for financial break-even point. Financial break-even point means it is a level of EBIT at which EPS is 0. If the plan 1, if you gone with, in each and every financial plan, what is there? Interest is there, no ma? Plan 1 also interest is there because existing interest is there, no? Hello? So that's why if you choose plan 1, plan financial break-even point, where is the plan 1? Yeah. Financial break-even point where company moves with what? First one, debt. It consists of 2 interest. What are they? Old interest plus new interest. If you able to earn this much of interest, then only this plan looks better to you. Whereas in financial break-even point 2, if you go with this, you have to earn what is it? Old interest plus preference dividend you have to pay. On the preference dividend, you have to consider the tax advantage. That is the reason you supposed to make 15,60,000. And financial break-even point under third alternative, that is nothing but equity. Just you have to make 6 lakhs. This is the financial break-even point of the concerned plans. Coming to indifference point, it indicates indifference point. It represents it is the level of EBIT at which EPS remain same. But here they asked indifference point between the 2 things. What are they? Then what is the debt plus equity they asked. By resolving this equation, you will get the EBIT. How much it is? 22 lakhs. Can you explain what is meaning of this? 22 lakhs is the indifference point. What it indicates? If you want to choose either debt based or equity based means, if you are able to earn 22 lakhs, right? Between these 2 financial plan, any of the plan can be chosen. But if the company earns more than 22 lakhs, then more than 22 lakhs means which plan has a highest risk capital? That is nothing but which one? Debt. Debt is preferable. Why, sir? Hello. Listen, man. For debentures, you are paying interest, right? If you make more profit, you will pay the same interest. If you earn less also, you will pay the same interest. In such a case, when you are capable to earn more than what the cost you supposed to pay to them, in such a case, which is best? Debt is best. When you are not able to earn what you supposed to pay to them, it is a better to don't take risk. So in the problem, 22 lakhs if you earn any of the plan you can choose. More than 22 lakhs, better to choose debt. Less than 22 lakhs, better to choose what? Equity. So this is the advice we supposed to give it for concern, right? With this 4 analysis we completed. One is the EBIT EPS analysis. According to EBIT EPS analysis, can you tell me in 30 seconds what is EBIT EPS analysis? Sir, it is the one of the analysis where we will select optimum capital structure by computing EPS from EBIT. Which financial plan gives you highest EPS? We will recommend it. Can you tell me EBIT market price analysis in 30 seconds? Sir, it is the analysis where we will find it out market price, but with support of EPS and with knowledge of PE ratio. So where market price equal to EPS into PE ratio, which financial plan has highest market price, we will recommend that one. Can you tell me within a 30 seconds financial break-even point? It is the level of EBIT at which EPS remain same. It indirectly conveys whatever the EBIT EPS by observing, looking, attracting. If you want to choose that concern plan, please commit to commitments of the concern plan. Because in that plan, interest is there. To the extent of interest, you have to make. Otherwise, don't touch it. Don't take the plan by considering its EPS market price. Check their commitment also is there. So that's why it is the level of EBIT at which EPS is 0. Indifference point arises between 3 plans. No 3 plans, no 1 plan. It arises between to financial plan. Indifference point formula. EBIT minus interest into 1 minus tax minus preference dividend divided by number of equity shares. EBIT indifference point is 40 lakhs. What do you mean of this? Between the two financial plan, which plan want to be selected means if you 40 lakhs is the indifference point. It indirectly conveys that if you are able to earn more than 40 lakhs, then better to take a risky plan. If you are not able to earn and less, making less than that one, better to take low risky. If you are earning same, any of the plan you can go with. So next after lunch, I will continue this theory part and hardly, what is the time, sir? Next schedule? After the schedule, within the theory part, we will discuss examination point of view, which been asking. अरे अभी तो इन्वेस्टिगेशन किया रे. Which analysis? Net income approach net operating traditional no MM theory with the tax. बहुत साल हो गया पूछने के बाद. Well, good afternoon, dear students. Yeah, so morning session we discussed EBIT EPS analysis, EBIT market price analysis, indifference point analysis, financial break-even point analysis. And even we discussed within 30 seconds what is the concept is. EBIT EPS analysis. Just to calculate EPS from EBIT, which financial plan is highest EPS it submits, right? You have to consider that one. Do you know how to find it out? EBIT to EPS, EBIT less interest, EBT less tax, EAT. If at all preference shares are there deducted, then you will get it number of equity shares divided by with number of equity shares you will get it. You will get what? EPS. But sir, is it important? Yes, only method been asking several times. Okay. Thereafter, market price analysis. To identify market price analysis, you must be very good at PE ratio. And you must be good at debt equity ratio. And you must be very careful with respect to what is the relationship between EPS and market price. Okay. Right. That we calculated. Financial break-even point means what? It is the level of EBIT at which EPS remain 0, right? If you choose a plan, you have to identify that what are the commitments of the concerned plan, so that what happens, then only that plan suits to company. That is coming to here, capital structure theories. Certainly there is a one question for theory part. What is it? They will ask you the different questions. What is a theory? What is a theory? Theory. Yes, that is a theory. This is so the theory, okay? What is the theory? Theory is nothing but a statement of fact based on certain assumptions and conditions. That is a theory. But each and every theory, Archimedes, different theories are there. In capital structure theories is nothing but these are the theories which provide certain guidelines, fundamental guidelines or statements which support us to find it out easily. What is the capital structure theories? 1 minute. Before learning capital structure theories, you must understand what is a theory. You see how Balu sir beautifully done. What is a theory? Theory is nothing but it is a fact, but based on certain assumption and condition. So then what is a capital structure theory, sir? Capital structure theories are certain statements which gradually support us, are guidelines which support us to find it out which one. Construct or select which capital structure? Optimum capital structure. Hello. So far, to determine an optimum capital structure, you must have to make 4 analysis. What analysis? EBIT, EPS analysis, EBIT, market price analysis, indifference point analysis, financial break-even point analysis. So what, sir? Without learning all these things, simply you can find it out capital structure in easy manner. How, sir? That is the theory will suggest you. If you learn these theories, you can easily either construct or select an optimum capital structure. See, Mahatma Gandhi also projected a theory with respect to life. Abdul Kalam also projected his life, right? But the theory is, their opinion is different from person to person. Hello? Here, how many theories are there? Number 1, net income theory, net operating income theory, traditional theory. Number 4, okay? Right, Modigliani-Miller theory. You see, this capital theory is again classified into 2 types. Relevant theories. What is it? And another one is irrelevant theory. MCQ you can expect. Balu sir, what is a relevant theory, sir? Relevant theory indicates by designing an optimum capital structure, one can either increase its market value or decrease its market value. Okay, that may be possible. Because of your capital structure, right, you can influence your market price. If it is say yes, that is what theory? Relevant theory. Irrelevant theories mean, hello, capital structure theories and market value does not have any relationship. Such an argument is, what is that? Irrelevance theory. In relevance theory, you have net income theory, traditional theory. In irrelevance theory, you have net operating income theory, theory. Along with this, other theories which will covers in theory part. One is the trade-off theory, another one is pecking order theory. Okay, tell me what is the classification? Relevant, irrelevant, other. Relevant. If you learn capital structure, you will possess a skill to increase market value. That is relevance. Irrelevance, array, no need here. Capital structure, nowhere concerned to market value of firm. Which one? Irrelevance theory. Along with this, you have other theories. What is it? Trade-off theory and pecking order theory. What are they? Already I told you, each and every theory is based on certain assumptions. You have to assume assumption. What are the assumptions means? Number one, there are only two sources of funds. What are they? Either equity or debenture. Only two sources of funds. And at the same time, there is a guarantee of EBIT. If you try to understand, there are two sources of funds. If you go to the market, you will find these two sources. If you raise the funds, if you do business, certainly you will get what? EBIT. And at the same time, your capital employed remain constant. Debt is less than equity. Business risk remain constant. All companies follows 100% dividend payout ratio. There was no tax. Company has, what is it? Perpetual life. So this is the theory of all the theories. You see, general assumptions of all the theories. Once again, tell me, you can think like a situation, an incident. You are going market to raise the funds, right? You see, I estimated how much capital is needed. That means simple thing is capital employed remain constant. For the capital, I went to market. How many sources I find? Two sources. What are they? Debt and equity. Cost of debt is less than cost of equity. Are you getting? If you do business with this capital, will you get a profit or loss? There is a guarantee of EBIT. If it is loss, means nobody will do business. There is a guarantee of business. In the profit, if I get, will I pay tax? No tax. Is there any flotation cost? No flotation cost. Okay. Only I will get 1 year? No. Forever you will get it. Are you getting? That is a perpetual existence. Business risk remain constant. This is the common assumption. Keep it in mind. 4 marks they will ask you. 4 marks theory. There was a story behind this. They were already asked. And here they will ask you, what is a capital structure theory? There is a 2 marks chances are there. What is a capital structure theory? Simply, what is a capital structure theory? Balu sir, theory means a statement of facts. Capital structure theories are those fundamental lines or guidelines, subject lines, which advise us, which guide us, which support to identify an optimum capital structure. Are you getting? That's okay. Then, Balu sir, what is a net income theory? Net income theory, yeah? Net income theory was suggested by one person. His name is David Durant. In your material, his name is not missed. I gave a title line. What is that? David, what is his name? Durant. Array, MCQ they will ask you. Net income theory is David Durant. This theory argues that, you see, under net income approach, the value of firm will maximum. Market value, see, market value of firm will maximum, where weighted average cost would be minimum. Now tell me, simple logic, market value would be maximum, weighted average cost should be least. In market, what are the sources are available? Debt and equity. Which cost source is very, very low? There are only two sources of funds. Cost of debt is less than cost of equity. When I need a capital, if I go on market, if I want to raise the funds means, I know that if I want to increase my market value means I have to reduce my cost. In such a case, what happened? Tell me, through which source I will raise more funds? Debt or equity? Debt. If I raise more debt, what will happen? Hello. If you raise more debt, you know, your KO decreases. When your KO decreases, your market value increases. What is your ultimate objective? To increase your market value, you know, to increase market value of your, if you want to increase your market value of firm, first you reduce your overall cost of capital. To reduce your overall cost of capital, increase least cost fund. Which is least cost fund is debt. That is the theory. So according to this theory was suggested by David Durant. David Durant argument is this. A company can reduce KO, can increase its market value of firm by employing least cost fund called what? Debt. Sir, I have doubt. What? Sir, if you rising more debt means certainly there would be risk to equity shareholders. No risk. Why? Balasubramaniam, return on capital employed is greater than cost of debt to be paid. A company generates 20% return, but I raised funds at 10%. 10% funds are rising. I investing at 20% and generating 20% means you try to understand in such a situation, rising more debt is riskier. No, since what David Durant argument is return on capital employed is greater than cost of debt, there is no risk to debenture holders, there is no risk to equity shareholders. Then since risk element of equity shareholders, debenture holders remain constant because of employing least cost, the company market value will increase. Thus he identified debt is the best because it is cheapest. Debt is best because it is cheapest. So that is the theory of which one? David Durant net operating income theory. Net operating income theory. This theory was suggested by David Durant. Here to prove this one, you have to understand certain formulas. Market value of debt. Market value of debt equal to interest divided by KD. Market value of equity. Market value of equity equal to earning availability to equity shareholders. Sir, earning availability equity shareholders, you are writing just EBIT minus interest. My dear, no preference shares. My dear, no tax. Hello? In such a case, EBIT minus interest equal to earning availability to equity shareholders divided by KE. Then market value of firm equal to market value of debt plus market value of equity. Then KO equal to EBIT divided by market value of firm. Okay? So market value is nothing but present value. Perpetual income, forever interest comes means you better to bring it into present by taking debenture holders expected rate. Similar to equity. Similar to market value of firm also. So you can find it out. Now tell me, market value of debt equal to interest divided by KD. Market value of equity equal to EBIT minus interest. EBIT minus interest, or you can say earning availability equity shareholders divided by KE. Market value of firm, market value of debt plus market value of equity. KO equal to Balu sir, small doubt sir. What we have to prove in net income theory, sir? Nothing but man, you have 2 lakhs debt, 2 lakhs equity. What is that? 2 lakh debt, 2 lakhs equity. If from 2 lakhs to, if you make a 3 lakhs debt, 1 lakh equity, what will happen? You are increasing what portion? Debt portion increasing. With effect KO, what happened? Decreases. With effect market value of firm increases. Balu sir, one doubt. If you done 1 lakh debt, sir, 3 lakhs equity, what will happen, sir? You are increasing KE more, In such a case, what happened? KO increases, market value of firm decreases. This is verification to prove that, yeah, this will happen. Okay, Balu sir, tell me, if 3 plans are given, which plan would be the best? How should I identify within a second? I will tell you the secret. If you 3 plans are given, right? You just observe plan 1, plan 2, plan 3. In which financial plan debt is more, you select that one. How do you say? High debt is there means least cost is more. Least cost more means KO will be low. KO low means automatically market value will increase. This is the point what they want to convey to you. Are you getting ma? So this is the theory of which one? Modigliani Miller theory. David Durant first theory. You see here the diagram representation also I projected here. This is the theory here. The diagram representation, it indicates KE is there in a market 20%. When company moves 100% equity, in such a case, KE equal to KO, right? In such a case, if the funds are available at a KD is available at 10%. But KE it is at 20%. Now what the financial manager thinks, to reduce the market value of firm, to increase the market value of firm, he has to reduce the KO, right? For that purpose, what happens? Gradually, he will employ which one? Debt. Once debt employs, equity gets redeemed because total capital employed remain constant. When you are going to employ KO, your KD in the market, automatically your KO gradually decreases. But it never touches 100%. No company will run with what? 100% debt. So this is his argument. Basing on this, he is a Vijay Mallya ji. He has taken several companies loan. Last marathon class also I showed this one. Because I want to tell that this is a wonderful case. Wherever it may be, right? You have to identify. If I go on Ooty, I will ask a tea, the tea stall gives a tea, then I should not shout, hey, seems to be Bradipeta tea only. I came where? Ooty tea should be wherever it may be tea only. Okay, which marathon is maybe net income theory is net income theory only. Law of diminishing marginal utility. We used to take only apple. No, we should not try watermelon. Okay, ma. So here this much of loan he has taken. This is the loan he has taken means you try to understand this man is very, very favorable for debt. There is one more MCQ question. Why debt is cheaper than equity? Right. Yep. No. Why debt is less? Because generally debenture holders ask a low rate of interest. Because his risk element is very, very less. And another one is we used to get what? Tax advantage. And number two, to issue equity, you have to spend more cost comparing to debenture. Yes or no? So that's why low flotation cost, tax advantage, and it generally interest rate is low. That would be cost of debt is less than cost of equity. Right. So there is a problem is given in your material. You take our material. You see what our material is confesses here. See, this is the net income theory. Very simple question, but there would be a chance to ask what is that? 2 marks. See, Rupa Limited, EBIT is how much? 5 lakhs. Whereas a debt is 10%. 10%, 20 lakh debenture is. KE is how much? 16%. So, dear student, what is given to you? KE given a? Whereas 10% KD also given. Now, you are required to calculate what is that? Market value of equity, market value of firm, overall cost of capital. Okay? And at the same time, they are asking what would be the impact of value of firm if the company wants to rise. How much? 10 lakhs. In such a situation, what we have to do? Now tell me market value of what we need. What we need? Market value of Rupa Limited, right? Here it is Rupa Limited. Same problem only. So here I want to find it out. What is that? EBIT. First I have to calculate market value of equity. Here you see market value of equity equal to, how do you calculate? In the problem KE remain constant, KD remain constant. So what we do, EBIT you take, less what you deduct, interest you deduct, right? So interest, from the interest what you will get? This is only, right? Here, what is the answer given? So here you see market value of equity. How do you calculate market value of equity? Tell me. No need of solution also, very simple. So EBIT you take minus interest you deduct divided by KE karo. Tell me, take a calculator, can you solve it? EBIT 5 lakhs minus debt is 20 lakhs into 10% divided by KE kitna maji? 16%. How much ma? 18 lakh 75,000 you got it. Whereas the debt already given, how much? 20 lakhs. So market value of equity 38 lakh 75,000. Hello? This is the situation. Now tell me, if debt increases means what happens? What would be the impact if the company wants to raise debt? In such a case, what will happen? Guess it? Yeah. Now your debt increasing, KE decreasing with effect least cost fund employing in your company more, with effect KO decreases, market value increases. Okay. Shall I ask you some MCQ questions? David Durand is favorable about equity, preference, debenture, all. Only debenture. He always believes that the debt is best because of no tax because of tax advantage. Yes or no? No, sir. In that theory, what is not there? Tax is not there. That may be practically possible current scenario, but it is not possible at the time, because at the time what is not there? Tax is not there. Debt is favorable because of least cost. One more question. Net income theory is relevant theory or irrelevant theory? Net income theory suggested by who? Why there is no risk to equity shareholders when company raises more debt? Because company able to generate more return comparing to what the company is supposed to pay. Then is there no risk to debenture holders also? Yes, absolutely no risk. Because whatever that cost debenture holders expects, company is earning more than that. Right? This is what theory? Net income theory, David Durant first theory. Next theory is nothing but we will move to another theory is net operating income theory. This net operating income theory also suggested by our hero. Who is that? David Durant. Also suggested. You use the word also. David Durant. See, according to this theory, what it indicates, overall cost of capital remain constant irrespective of all debt equity mix. What this theory argues that this theory makes a shouting. That is nothing but he shout. Who told you that? Evarra cheppindantaru. Sir, what sir? What do you want, sir? Who told you that there is no risk to whom? Equity shareholders. So simply, I will tell you what is the net operating income theory. Point number one. Keep it in mind. Net operating income theory also suggested by who? David Durant. This theory argues that a company employs a debt. Yes or no? If a company employs a debt, our company debt equity mix it changes, right? So because of employing a debt, there is a risk element to equity shareholders. How much advantage you supposed to get from the debt? Same proportionate of risk increases where? In equity. With effect advantage of debt, disadvantages equity gets set off with effect. KO remain constant, market value of firm remain constant. He argument is debt is not a best, debt is not a worst, debt is just a source of finance. He projected same thing. In second version also we can say debt equity mix of the company does not change KO and market value of firm. Sir, why? Because set off effect takes place. What is it? Set off effect. Set off effect means how much advantages here, the same thing will set off what? In equity. With effect KO remain constant. When KO remain constant, market value of firm. Balu sir, can I increase market value? No. Can I decrease market value? No. Your market value not depends upon your financial structure. Your market value depends upon your earning capacity. What is that? Earning capacity. So that is the point is this theory. In simple line, what is argument is? According to this theory, debt equity mix of the company does not change KO and market value of firm. Because the advantage of debt would be set off with what? Risk element of equity shareholder. So in this theory, what we can learn means KO remain constant kada. That's the reason you have to learn the formulas. Market value of firm equal to, previously we calculated KO. KO equal to EBIT divided by market value of firm we done. Here just to change. EBIT divided by KO equal to market value of firm. Because KO equal to EBIT divided by market value of firm. Where KE equal to earning availability equity shareholders divided by market value of equity. So earning availability equity shareholders, how do you get it? EBIT minus interest. Finally, market value of equity equal to market value of firm minus market value of debt. Balu sir, little bit confusion. Could you please tell me the procedure? What I would like to say, a company is there. In the company, debt to equity is there. If you increase the debt, decrease the debt, does not make any change. What happened, when KD is decreasing, KE increases. Okay, for example, this is available at a 10, it is available at 15. If you reduce this one, right? Okay, if you get more debt, automatically your KO starts to decrease. That is your point. What happened when you debt increases, automatically KE increases. Advantage of this would be exactly set off with risk element. With effect, KO will remain constant. So what you have to prove in net income theory? Net income theory, what I have to prove? KO decreases, I have to prove. Which theory? Net income theory. Market value of firm, I have to increase. What about net operating income theory? What you have to prove? What I have to prove means debt is not best, I have to prove, right? How should I prove? If you increase the debt, market value of firm will remain constant. Market value of firm remain, when it will constant, KO remain constant. When KO remain constant even after raising a debt, when KE starts to increase. That's why you must learn formula with respect to KE. KE formula is earning availability to equity shareholders divided by market value of equity. Earning availability equity shareholders, how do you get? EBIT minus interest. Okay. Market value of equity, how should I get? Market value of firm minus market value of debt. Market value of firm, how should I get? Already KO remain constant, you know. What man? EBIT divided by, if you take KO, you will get the market value of firm. Market value of firm minus market value of debt karo, market value of equity. Hello? Earning availability equity shareholders divided by market value of equity, see, KE will increase. Simply, dear students, when debt will increase, you know, when KE increases, advantage of debt would be exactly set off with risk element of equity. Thus, KO remain constant, market value of firm remain constant, right? Then, another theory, this is the observation. This theory argument is what? Debt is not best, not worst. Debt is what? Just to finance. Is there any optimum capital structure? No optimum capital structure, because every capital structure is optimum. Here also we have a small problem. This is from our mastermind, come CA Institute material. See, Amita Limited EBIT is 5 lakhs. The firm cost of debt is 10%. Currently employee how much of debt? 15 lakhs. Overall cost of capital is how much? 15%. You are required to calculate total value of firm. Value of firm, how should we calculate? EBIT divided by KO karo. EBIT how much ma? 5 lakhs divided by 15%. Calculator. How much ma? 30. Very good. You are all pass in FM. Intlo will cheppesadu ante. Then how do you calculate market value of equity? Market value of equity, sir. Market value of firm minus market value of debt karo. You will get what? Market value of equity. Okay. Sir, how do you get the earning of KE? KE, yeah? EBIT minus interest divided by market value of equity, right? With effect, what happen? KE increases as debt increases. From present debt is how much ma? Present debt is 15 lakhs. If debt from 15 lakhs to 22 lakhs goes, from 15 lakhs to reduces to 15 lakhs. Can you tell me what is a KE? KE what happened? From 15 lakhs to 22.5 lakhs it went, means KE increase or decrease? KE increases. But KO will remain constant. Whereas if debt decreases, automatically KE decreases. With effect, KO remain constant. So, with this concept, what is that? If debt increases from current to 15 to 22.5 lakhs or 15 to 17 lakhs, okay, KO remain constant. KO remain constant, market value of firm will remain constant. With this, debt is not a best, debt is not a worst, debt is just to finance. When this David Durant projected, then one more theory came into the picture. That theory was suggested by Isra Solomon. Isra Solomon. His name is also not there in your materials. Means not even CA Institute also. That theory is suggested by who? Isra Solomon. That theory is called traditional theory. What is that? Traditional theory. This traditional theory is a hybrid form of two theories. What are they? See, traditional theory suggested by Isra Solomon. According to this theory, the simple argument is this. If a company employs a debt, cost KO, overall cost of capital, what happened? Decreases, and market value of firm increases up to certain level. What is that? Up to certain level. A company may decrease its KO, increase its market value of firm by employing least cost fund called debt up to certain level. Beyond that level, if company starts to employ what? Debt, automatically risk element of equity shareholders increases. Risk element of debenture holders also increases because of increasing KE, because of increasing KD, KO increases. When KO increases, market value of firm decreases. So debt would be best up to certain level. Thereafter it will turns riskiest, costliest, finally become worst. That's why raise the debt up to certain level. Okay, that is the theory. This theory was suggested by Isra Solomon. Isra Solomon could not provided any formula because he could not convey any new formula, because the formulas what you know in net income theory, net operating income theory, that is damn important to find it out. This one we can take this problem May 2021 MTB they given, right? Let us check whether this is provided or not. You see here traditional theory, same problem. In given theory, this is the question they given, right? So debt composition, a company may run with what? 0% debt means 100% equity anama. When debt is 20 means 80, 40 means 60, 60 means 40, 80 means 20. If it is a situation, you see KE gradually what happened? Increasing. What about the KD also gradually increasing? At what composition debt equity mix composition is the best? We have to find it out. For that purpose, we have to calculate weighted average cost of capital, because KD is there, KE is there, debt amount, equity is there. At 0% it would be 15% because 100% equity, right? Whereas 20%, 14%, 40, 13.33, 60, 15.2, 80, 19%. That which combination would be the best means? 20, no, not 20. 40 and 60. Going with 100% equity is not good thing. At the same time, going more debt also not good thing. The combination is 40 and 60 would be the best ever. Clear? So this is the net operating income theory. Sorry, traditional theory. Which theory is favorable about debt? Which theory is not at all favorable to any source? Net operating income. Which theory is favorable to debt? Debt up to certain level. Which theory? Traditional theory. Next, Modigliani-Miller theory. Modigliani-Miller theory was suggested by Modigliani and Miller. Surprising. Modigliani-Miller theory was suggested by Modigliani-Miller. See, this MM theory was suggested by Modigliani-Miller. What the Modigliani-Miller argument is, Modigliani-Miller practically proved which theory? Net operating income theory. Understand? MM theory little bit. Because 5 years before I think I showed the analysis. So it took 2018, I think 19 they asked a question. From thereafter, not at all asked. EBIT, EPS analysis they've been asking. Okay, for this attempt, either we may ask indifference point or financial break-even point, or else MM theory. What Maji? Point number 1. MM theory was suggested by Modigliani and Miller. This theory argument is this. You see. This is the theory. Modigliani-Miller theory. He is the heroes. Franklin Modigliani, Merton H. Miller, they proposed this theory. What this theory argument is this? This theory is favorable to, not favorable. This theory practically proved which theory? Net operating income theory. Its argument is this. So net operating income theory conceptual, but it could not consider behavior of whom? Equity shareholders behavior. Okay, equity shareholders. It ignored behavioral aspects of whom? Equity shareholders. It ignored behavioral aspect. Just it is a conceptual. He practically proved which theory? He practically proved net operating income theory with concept called arbitrage. What is it? Arbitrage. Here he took certain assumptions. Exclusive assumption for which theory? Net operate Modigliani-Miller theory. What is the first assumption? KD is less than KE. Constant KD. Increase in KE. Constant weighted average cost of capital. That is a common concept. And he projected one concept is arbitrage process. What is first you should understand arbitrage? Arbitrage is a mechanism where an investor can buy a security at a low price and hold it for right time and sells it at a high market. This is mechanism is called arbitrage. When something goes wrong, I will tell you simple example. This is the, let us take SBI is a 200 rupees is there. Yes Bank is 200 is there. So both the companies are similar companies. What is that? Similar companies. You try to understand here 100% equity. It's the debt plus equity. As per net operating income approach, both the firms market value will remain same, here you see market value of firm will remain same. Why? Because what effect? Set off effect. So this theory was suggested in 1953, but this theory is a conceptual, it won't consider behavioral aspect of whom? Equity shareholders. This man proved that same that S Bank has made biggest scam ever in the market. So this is the S Bank founder Rana Kapoor arrested by ED. When news came, automatically what happened? This is Rana Kapoor, is a founder. How is he? Kotti తీసుకెళ్లారండి జైల్లో, తిహార్ జైల్లోకి. Then founder done this mistake and S Bank shareholders what they do? They will start to sell kada. Emma sell చేసినప్పుడు market value what will happen? Down. But what happened? Actually net income theory, net operating income argument is market value firm will remain constant. But here the people starting to sell. When market value what happened? Decreases. So you try to understand in such a situation, you see the market value. The market value gets captured because of this idiot. I have a right to say he's idiot because I'm an owner of the company. Who? Yes, timetable is a class chaptunara. I'm a owner of which company? Yes, bank, because I too have a shares. Any share rendu. Only 2 shares. But you say even 1 share also you will become what? Owner. Right. The thing is, if it is a situation, now try to understand the mechanism is, if the 200 rupees share price is there, it came to just 20 rupees. In such a case, what the investor will think? Dance or thinka? What dance is not? 200 rupees share price suddenly came to 20. Why? You don't know? I don't know. You know? I know. What do you know? Rana Kapoor, he made a scam. Total at Tihar jail. Okay, then 200 rupees share price is available at 20 rupees. Then what tempts an investor to buy? 1 minute, can I buy that shares at 20? Hello, 200 rupees came to 20, man. I know 20, but a 20 rupees share turns to 40, 100% return. Bhaiya, when 20 came to 200 came to 20, 20 may become 2 rupees also. I am ready to take risk. Now tell me, I am ready to take risk. If investor by analyzing all the things, by making thinking, yes or no? Thinking come calculating. Calculator undi akkada pakkana chudandi. He made, ఇప్పుడు అది క్యాలిక్యులేటర్ అని కావాలమ్మా, ఊరికే ఫ్లోలో చెప్పానమ్మా. అది మౌస్ అనే విషయం నాకు కూడా అర్థమవుతుంది. అది మౌస్లా ఎస్ ఐ థింక్ ఫోన్ లాంటి మౌస్ ఏమో. Now what happened? If 200 came to 20 rupees, what will happen? Then people start to buy, right? When these people start to buy this security at lowest price, what happened? Then the share value, lowest value will increase, highest value decrease at one point of time. Both will reaches same. But to buy the security at lowest price, what you will think? Same investment, more profit. Another alternative, less investment, same profit. So because of this 2 alternative, he will purchase the shares at low price, he will sell at a high price. With effect what happened? Lowest market value will increase, highest market value decrease. At one point of time, both will reach us to equal. See, this Harshad, that Rana Kapoor scam is what happened, at the time approximately 420 rupees share price went to 5 rupees. That 5 rupees share now it is came to around 28 to 30 rupees approximately. Are you getting? This is the behavior of, because of equity shareholders behavior, the 2 firms market value at one point of time what happened? Will reach equally, not because of set off effect. Now tell me, market value of firm will remain same according to net operating income, according to approach. You tell me, as per net operating income theory, because of set off effect, KO remain constant, market value of firm will remain constant. Who told this? David Durant. But Modigliani Miller argument is this: no, it should not happen. When there is a market value is not equal, investor undertakes what? Arbitrage. Because of this arbitrage, lowest market value increases, highest market value decreases. At one point, both firms will reach equilibrium. This is the argument. Coming to examination point of view, how do you calculate market value of firm? Already I told you, market value of firm according to whom? Ready? Very, very important model. This model they will ask you hardly for 5 marks. How to calculate market value of firm according to Sir, very simple. How? Sir, market value of debt plus market value of equity. You will get the market value of firm. Champa baguluddi. Okay. Sir, shall I go with like this? EBIT divided by KO? No. Sir, then what should we do? Modigliani Miller conveyed in a different theory. What is conveyed? You have to calculate. This is the logic. You try to understand. You see, estimation of market value of firm according to Modigliani Miller. According to Modigliani Miller. So first what you do, you have to calculate in the absence of tax. I'm explaining in the absence of tax, in the presence of tax. In the absence of tax, in the presence of tax. First, in the absence of tax, unlevered firm. First MCQ question. What is unlevered firm? No risk, not, no debt. What is that? No debt. Levered firm, unlevered firm. First you have to calculate market value of which firm? Levered firm. Levered firm equal to earning availability equity shareholders divided by KE. What is a levered firm? Levered firm you have to calculate market value of equity plus market value of debt. Market value of equity plus market value of debt. Whereas this is what? Estimation of market value. This is with respect to in the absence of tax. In the presence of tax, what will happen? Same theory will apply, but here earning availability equity shareholders means it considers which one? Tax. It considers tax. So here what happened, earning availability equity shareholders you can take because EBIT interest is not there means 0, right? That is nothing but this is earning availability equity shareholders. Here it does not work. Why? Because EBIT, of course interest is 0, but 1 minus tax is there, no? Because in the presence what is there? Are you getting? In the presence of tax, EBIT minus interest is not there. Why? Because it is what firm? Unlevered firm. But the tax you have to pay, right? So that's why EBIT minus interest 0 into 1 minus tax. Okay? Divided by KE if you do market value of which firm? Unlevered firm you will get it. Then market value of levered firm you have to calculate. You have to follow the rule. What you do means market value of unlevered firm plus, I repeat, market value of unlevered firm plus market value of tax shield on debt. Remember this, theory in the presence of tax you should not calculate. First you have to do calculate one, adjust another one. See a rule. What is that? Calculate one. What to calculate? Unlevered firm you calculate. Levered firm you have to adjust with the tax advantage. How do you calculate market value of tax shield means take a debt into multiply with what? Tax rate. So market value of unlevered firm equal to market value of tax shield on debt. Market value of tax shield on debt equal to debt into tax rate. Are you getting ma? So what you have to do means according to in the presence of tax is there. First you have to calculate market value of unlevered firm only. For levered firm what you do? Don't calculate. Just adjust the tax advantage. You will get the market value of levered firm. So that is an important point. I will tell you a small question. Here you see there are two firms P and Q which has identical except it does not use any debt. So here you see here Q has how much of debt? 8 lakh 9% capital. Okay, before the firm earning before interest and tax. You see here it is. So 8 lakhs and earning before interest and tax is 2,50,000. Equity capitalization rate is 10%. Assuming corporate tax rate is 30%. Calculate the firm according to There are two firms, what are they? P and Q. P does not use any debt. That means P is called unlevered firm. Unlevered firm, how do you calculate? You see, unlevered firm, how do you calculate? Means here, see, given information, there is not a clarity, that's why I typed here. P is what? Which company? Unlevered. Q is levered company. Debenture, how much is there? 8 lakhs 9%. EBIT, how much? 2,60,000. K is 10%. Estimation of market value of firm according to in the presence of tax. First, what you have to calculate? Market value of unlevered firm. Market value of unlevered firm means which moves 100% equity. That's why market value of P equal to earning availability equity shares divided by KE. Thus 2,60,000 minus 0 into 1 minus 0.30, 10% means how much it is? 18,20,000. Whereas levered firm, you should not calculate like this. Market value of levered firm equal to market value of unlevered firm plus market value of tax shield on debt. Market value of tax shield on debt formula, what I told you? Debt into tax rate. Debt into tax rate, if you multiply, you will get it comfortably, dear students. Then you can comfortably solve this issue. So debt into tax rate. Here, this is the debt into tax rate. How much you got it? 20 lakhs, 60,000 rupees. So this is the way you have to identify. Along with this, instead of problematic, several times the question asked in theory part also. These are certain observations from the theory part. They asked it questions. What do you understand by capital structure? It is a mix of long-term funds or short-term funds? Long-term funds. Another source. What is a financial structure? Sir, financial structure. You see 2 marks the question asked. A combination of long-term funds is capital structure. Both combination of long-term cum short-term funds is financial structure. What is a financial break-even point? I explained several times. It is a level of EBIT at which EPS remain 0. What is indifference level of analysis? It is a level of EBIT at which EPS remain same. What are the fundamental principles you should follow? Low cost, control should be safe, it should be flexible, government control would be in our hand, yes or no, easy to comfortable, risk would be very, very low. I showed a slide where investor used to check risk, cost, control and everything. Sir, what is this overcapitalization, sir? Once you don't know capital structure, then you will raise the funds in your own way. In such a case, you may have more than required. That is called overcapitalization. Undercapitalization means less than required, right? Capital structure. These are the certain concepts, ma. Okay. Major concept you concentrate these questions also. Overcapitalization, undercapitalization. Okay. And another one is a principle should be followed in designing optimum capital structure. Cost should be low, risk should be low, control should be in our control, low flotation cost, tax advantage, flexible in nature, yes or no? And at the same time, risk element would be very, very less. Considering all these things, company has to raise funds. So this is the one of the important chapters. But theory part, theory is very, very important. Right. Next one is, we will move to leverage analysis. Leverage is a very, very small simple chapters. Leverage. See, coming to leverage, let's make an analysis. From past 10 years, 2018 to what, Maji? Up to now, is there any point they have been asking? See, they are asking only one area, where margin of safety, that is nothing but missing value, comprehensive problem they have been asking. So basic model they are not at all covering, right? First of all, you should understand what is leverage. What is leverage? Immediately this, I will start working capital. Okay. Leverage is nothing but represent a power or influence. In a financial analysis, if one factor changes, what would be the impact of another factor? That could be we learn with the leverage. Or we can say leverage is a risk associated with the company having fixed financial commitments. What is it? Fixed financial commitment. What, this pen is not working? What, ma? Indulona? Okay, it's working now. Right. Leverage represents, it is a risk associated with the company having fixed financial commitments. You see, leverage. Leverage is nothing but is an influence or power. So what happened? A company is there, ma. If the sales are there, approximately 40 lakhs, okay? 40 lakh sales. Whereas variable cost ratio at 60% means how much? Take a calculator and tell me. 24 lakhs. If 24 lakhs is there, then what I will get it is a contribution, right? Contribution is 16 lakhs. Now try to understand, if I have a fixed cost, 15 lakhs rupees, let us assume. What is my EBIT? EBIT would be 1 lakh. Hello? This is my EBIT. Now because of having this fixed cost, I should find it out what is risk associated with the company. I have to find it out. So here, because of this fixed cost, how much risk the company is going to generate? If the sales increases, right? Sales increases at least by 40 lakhs. Suppose 20% sales increases means, now try to understand 40 lakhs into 120%, how much? 120%. 48 lakhs. 48 lakhs sales increases means variable cost also increases by 120%. How much then? 24 lakhs into 120%. 28 lakh. 28 lakh 80,000. Yeah, 80,000 if you deduct, you will get 19 lakhs 20,000. Still fixed cost will remain constant. In such a case, 4 lakh 20,000. You try to understand how much it is increased. It is a drastic increase in, just it is increased by how much? 20, but here it would be more than double. So it is just because of what advantage? Fixed cost advantage. If the sales decreases, everything decreases, but fixed cost will remain constant. Because of constant in fixed cost, the company income gradually what happened? Decreases. So this is the risk associated with the company having fixed cost. But the point is, if you study an income statement of the company, you will find not only fixed cost, but also interest. What is that? Interest. So here come to leverages. Yeah, leverages, if you come to, this is already a routine concept. See, if you want to move this biggest stone, you need a small thing, right? With this stone, you can make a move to a biggest stone. Hello? This small would be called, what is that? Leverage. Right? Leverage ante em ledu. Ijudu. This is regularly I showed in classroom also. This is this small life. This is making a movement of this cap with support of this stone. This stone is called, what is it? Leverage. Chota hai lekin jyada hai. This is the old lady. See, if she want to dig the water, there is a wheel, right? This wheel is called, what is it? Leverage. Even if you can lift a car by using, what is it? This jockey, it is a leverage. Small thing, but it can do lot of benefit. Fixed cost also small thing. Interest also small thing. But if sales increases, it tremendously increase the profit. But sales decrease, takes out. Amazon forest anaconda, it will. Not eating, swallow. Okay? But this concept we are applying to this company. This is the company where we have to study what is the risk associated of this company. For that purpose, you have to understand cost of the company. Any company cost being two types. What cost? Fixed cost, variable cost. What is the variable cost? What is the fixed cost? Variable cost varies. Fixed cost will remain constant. Whether you produce, not to produce, sell, not to sell, certain fixed cost will remain constant. Because of fixed cost, company faces a risk. So because of fixed cost, how much risk the company faces is called business risk. For example, fixed cost associated business operation, rent, salaries, and all these things comes under this category. Whereas along with that, if company makes a financial decision, it may raise funds from in the form of debenture. If the company issues a debenture and raises interest and preference dividend, hello, this interest and preference dividend also called what? Fixed cost only, no? Are you getting my point, ma? So already you are running a company with what? Huge fixed cost. Along with that, what happened? You are raising funds by issuing equity. Not equity is not. Debt and preference. In such a case, you have to pay interest and preference. You try to understand in such a situation, there is a, because of fixed cost, there is a risk called what risk? Operating risk. Because of fixed financial cost, there is a one more risk. What is that? Financial risk. If you sum it up both, you will find what risk? Combined leverage. This can be, we can observe by seeing the income statement of the company. For example, if you see the income statement here, You see the income statement of the company. I'm studying income statement of company. I came to know that this would be G. Yes, ma. By seeing income statement of concerned company, this is the company. By seeing this company's income statement, we can assess what is the risk associated with the company. You see, in this company, what is there? Fixed cost is there. Fixed cost means irrespective of either sales may increase or decrease, this fixed cost will remain constant. Thus, risk is there, Along with that, the company has what? Interest. Along with that, the company has what? Preference dividend. Because this interest and preference, they might have raised a debt plus preference. Hello? These two things are called financing decision. What is that? Financing decision. Because of the financing decision, there is a two fixed cost. That is a debenture interest and preference dividend. So this is what risk? Financial risk. What is the fixed cost you supposed to pay? This is called operating risk. If you add both, you will get what is that? Combined leverage. So this is the concept you can identify. There are certain big film theaters. This is Prabha's film theater in Sulrupet. When he maintained this one, Corona came, but he maintained from his own pocket money. If he is the Prabhas only maintained, otherwise somebody means gone. Whereas the Kingfisher Airlines collapse means because of the leverage impact only. Yeah, coming to here, how many types of simple logic I will tell you. Leverage indicates risk associated with the company having fixed operating cost, fixed financing cost. Fixed financing cost means interest, preference dividend. Right? Types of, here one more concept, MCQ question. What is a business risk? What is a financial risk? It refers to risk associated with the company's operation, particularly because of the fixed cost. Whatever the risk associated with the company is there, that is called what risk? Business risk or operational risk. It arises because of cost structure. What is that? Cost structure. Financial risk arises because of financial structure. What is that? Financial structure. How many types of risk? One is operating risk. Because of fixed cost, whatever the risk associated with the company is called operating risk or business risk. Because of financial decision, whatever the risk arises, it is called what is that? Financial risk. If you combine these three in the leverage form, you can say leverage has been two types only. One is operating leverage, financial leverage. If you add both and if you want to reflect one more, you will find what is that? Combined leverage. So here to find the combined leverage, you have to understand income statement very, very well manner. Sales minus variable cost, you will get the contribution. Less fixed cost, you will get the EBIT. So how much operating risk is there because of what is it? Fixed cost can be learned with the operating leverage. From the EBIT, if you deduct interest you will get the financial risk. EBT will get it. Because of interest, how much risk is generates is called what is it? Financial leverage. If you combine this both, you will get what leverage? Combined leverage, right? So any company's business situation may happen like this. What is the formula of operating leverage? Simple theory, you try to understand. Operating leverage, also called degree of operating leverage. This is the risk arises because of what cost? Fixed cost. What it conveys? Operating leverage indicates that at any cost, 1% change in sales, 1% change in sales, how much of percentage EBIT gets changed because of what cost? Fixed cost is called what leverage? Operating leverage. It shows the relationship between two things. What are they? Sales and EBIT. Sales and EBIT because of what cost? Fixed cost. Whereas operating leverage can be calculated like this: contribution divided by EBIT, or if one income statement is given, you can go with this contribution divided by EBIT. Two income statement is given, in such a case, percentage of change in EBIT divided by percentage of change in sales. Whereas financial leverage arises because of financial decision taken by the company. It is the risk associated with the company having fixed financing cost, particularly interest. Another one is preference dividend. What it conveys? At any cost, 1% change in EBIT leads to how much percentage of change in shareholders' income, particularly shareholders' income, that may be EBT, EPS. Why EBT, EPS? How it is means? See, you make EBIT here. From the EBIT, what you have to deduct? EBIT is there. From the EBIT, you have to deduct interest. If you deduct interest means you will get what? EBT. So EBT is nothing but shareholders income. How, sir? From the EBT, what do you have to pay? Tax. But the tax is not a risk to you. Yes or no? Once you make a profit, you will pay tax. Once you don't make a profit, then no need to pay tax. So that is the reason EBT turns to EAT. Since there is no preference dividend practically in the market, in such a case, that would be called earning availability to equity shareholders. If you divide it by the number of equity shares, specific form, it is nothing but EPS. Aggregate form, it is nothing but EBT. Okay, that is the financial leverage. Financial leverage can be calculated percentage of change in EPS divided by percentage of change in EBIT, or one more formula also you can use it. What is it? EBIT divided by EBT. But here another thing is nothing but, what is it? Combined leverage. Combined leverage also called degree of combined leverage. It is the risk associated with the company having fixed operating and fixed financing cost, particularly fixed cost, interest, preference dividend. Okay, operating leverage, combined leverage, what it indicates? At any cost, 1% change in sales leads to how much percentage change in EBT, EPS, because of what cost? Fixed cost and financing cost can be identified. So combined leverage can be calculated with the given formula. What is that? Percentage of change in EPS divided by percentage of change in sales, or else contribution divided by EBIT. Once if you find it out, all these things, once you have the income statement analysis, you can comfortably calculate all the leverages. Okay. Now let's move it. Once again, tell the formulas and we can move it. Operating leverage formula. Operating leverage arises because of fixed cost. High fixed cost leads to high operating high fixed cost leads to high operating leverage. Low fixed cost leads to low operating leverage. No fixed cost leads to no operating leverage. But practically it is highly impossible to say no fixed cost. But there is a chance to say that there is no interest also. Okay. What is operating leverage? Another name. You can say it is a business risk. What is that? You can say it is a business risk also. You can project a business risk. Somebody Telugu need. Yes. Are you following, right? Okay. I don't think what is the problem. So yeah, operating leverage arises because of fixed cost. Financial leverage arises because of financial decision, right? Which leverage arises because of cost structure? Operating leverage. Which leverage arises because of financial structure? Financial leverage. Okay. Combined leverage formula. Operating leverage into financial leverage, or else combined leverage formula, contribution divided by EBIT. Got it, ma? Sorry. Operating leverage equal to contribution divided by EBIT. Financial leverage formula, EBIT divided by EBT. Combined leverage formula, contribution divided by EBT. Okay. Now, basing on this, few problems we will check. And here it is the leverage. The first problem, you see, observation, my observation is this. My observation is BEP, this is the first model they've been asking. Maximum missing value they're asking. Comprehensive problems repeated. Now, can you tell sales 10 lakhs, variable cost ratio 40%, fixed cost is there 3 lakhs. Fixed cost is there means what leverage is there? Operating leverage. We have to calculate operating leverage. And what is the percentage of EBIT if sales increases by 20%? Now you come to here. To calculate operating leverage, what do you want? Contribution divided by EBIT. How do you find it out? Very simple. Take sales. From sales, what do you have to do? You have to deduct what is that? Contribution. Yes or no? If you variable cost you will deduct, you will get the contribution less what is it? Fixed cost. Then you will get what is it? EBIT. Well, here it is. Operating leverage equal to contribution divided by EBIT. Yeah? Roughly you take calculator and tell me 6 lakhs divided by 3 lakhs. 2 times. Can you interpret the answer? What is the 2 times means? For every 1% change in sales leads to 2% change in EBIT. If sales increases by 10%, 20%, right? If the percentage change increases by, what is it? There is a 20% means simply you can say for every 1% it is 1%, 1 to 2 means 20% it would be 40%. So operating leverage arises because of fixed cost. What is the financial leverage formula? Yeah, now in the problem what the given is, so sales are given 40 lakhs, less variable cost is 25, fixed cost is 6 lakhs. So fixed cost 6 lakhs is there, thus financial leverage is there, you know? Fixed cost financial leverage is there, 40 lakhs is the sales revenue, variable cost is 25 lakhs, fixed cost is 6, 10% debenture 3 lakhs, equity share capital 10 lakhs. And 10 lakhs each, 50 lakhs. Tax rate is 30%. Now tell me, calculate operating leverage, financial leverage. How do you calculate operating leverage? Array, sales 40 ra, minus variable cost deduct karo. Sales 40 lakhs, less what is that? Variable cost. Then you will get what is that? Contribution. From this fixed cost you deduct. You will get the EBIT, less interest, 3 lakhs. You will get the PBT, less tax, EAT, number of equity shares which are given. Okay, next EPS you take it. EPS would be 0.84. What they asked to calculate? Operating leverage. Operating leverage formula? Contribution divided by EBIT. Contribution divided by EBIT. So this is 1.667 times. Financial leverage formula? EBIT divided by EBT. 1.5 times. Percentage of change in EPS. What they asked, another one is, what will happen? Percentage of change in EPS if EBIT increases by 10%. Which leverage shows relationship between EPS and EBIT? Financial leverage. Once you calculated financial leverage is how much? 1.5. For 1%, 1.5 means for 10% how much it is? 15%. So combined leverage. What is another name of combined leverage? Total leverage. What is that? Total leverage. It considers two leverages. What are they? Operating leverage, financial leverage. A firm's under sales is 24 lakhs. Less variable cost is 50. From sales you deduct a variable cost. You will find what cost? Fixed cost. Hello? What Maji? From variable cost. Fixed cost is there. So what leverage? Financial leverage, right? Very good. Fixed cost ki financial leverage nowhere concern. Okay? But debenture, company has a borrowed how much? 10 lakhs. For 10 lakhs they have to pay interest, right? In such a case what leverage is there? Financial leverage. So only financial leverage and operating leverage is there. No combined leverage. Yes or no? No kada? No combined leverage kada? No. Ekkadunda akkada? Maji, when financial leverage is there, when combined leverage is there, automatically what leverage? Combined leverage. If you prepare income statement, what is that? Sales are less variable cost, contribution less fixed cost, EBIT less interest, you will get what is that? EBT less tax how much? 50. Then you will get what is that? PAT. Number of equity shares 10,000. You will find what is that? EPS. But EPS nowhere concerned here. So operating leverage, contribution divided by EBIT 5 times. Financial leverage, EBIT divided by EBT 2 times. Combined leverage, operating leverage and financial leverage. Then percentage of change in EPS. Percentage of change in EPS, if you want to find it out, which leverage shows the relationship? Tell me. Here what they asked, we find it out operating leverage, financial leverage. Can you determine what is the percentage of change in EPS if sales increases by 10%? Which leverage? Combined leverage. Already we calculated combined leverage here. How much combined leverage? 12 times. For 1 is nothing but 12 means for 10 is nothing but 120%. And one more question he asked here. How do you calculate return on investment, return on equity? What is it? Return on investment is nothing but total capital employed. Return on equity is nothing but exclusively equity shareholders. You see, return on investment, or you can say return on capital employed, that is nothing but EBIT divided by capital employed. 2 lakhs is EBIT, capital employed is 20 lakhs. You will get the 10%. Whereas return on equity is nothing but only earning availability to equity shareholder divided by equity share capital. 10 lakhs means you will find how much percentage? 5%. Okay. Then, so this is the observation. There is a one more problem you can see, that missing model problem. They are repeated mode they have been asking. Hello. That's why here we can discuss one more problem. In the problem, this is the problem from, you see how many times they asked this problem, right? Kya? Several times they've been asking this model. So that's why you pay attention here. How should we solve? The following is the balance sheet of 31st March. So fixed, see, equity share capital. Is there financial leverage? Equity share capital. Balu sir, equity share capital funds belongs to whom? Equity shareholders. Is there any risk? No. So that's why no risk. Reserves? No risk, because reserves belongs to whom? Equity shareholders. What about debenture? Hey, debenture is there. What leverage? Financial leverage. Sir, won't you consider current liability? No man, for the sake of capital, we never raise funds from current liability. Only long-term liability we will raise. Then fixed assets. Fixed operating leverage is there. Yes or no? Yes, sir. Fixed, I stressed on fixed. When I stressed means automatically we will come to conclusion that fixed cost. It's not a fixed cost. What is this? Fixed asset. Fixed asset nowhere concerned. Current assets nowhere concerned. But from this, what is there? Financial leverage is there. Now from the detailed information, they identified break-even point. You know, break-even point is nothing but no profit, no loss. At the break-even sales, total revenue equal to fixed cost plus variable cost. At the break-even sales, no profit and no loss. At the break-even sales revenue equal to total cost. What, Maji? That break-even sales revenue equal to fixed cost plus variable cost. Hello? Then how should you find a fixed cost? Break-even sales equal to variable cost plus fixed cost, Maji. If variable cost crosses the equal to, if it comes means sales minus variable cost equal to fixed cost. That means break-even contribution equal to fixed cost. Once again, getting confusion? So listen, break-even sales. What is a break-even sales? No profit, no loss. Go in depth. What do you mean by no profit, no loss? Is there no revenue? No. Revenue is there. That revenue is just sufficient to cost. Cost means what cost? Variable cost and fixed cost. Thus it means, Balu sir, sales revenue, break-even sales revenue equal to, what is that? Break-even sales revenue equal to variable cost plus fixed cost. In such a case, break-even contribution equal to fixed cost. It means that in the problem, if you want to find it out, fixed cost, you can use break-even contribution. Are you getting my point, ma? Yeah, that is the point. So variable operating cost is 16%. Total asset turnover ratio. What is asset turnover ratio? Asset turnover ratio is the ratio which shows the relationship between turnover and total assets. So it conveys that how many times the company can increase its sales by investing from its assets. For example, asset turnover ratio is 20. That means if you invest 1 rupee on asset, the 1 rupee asset can turn sales into 20 times. Is it favorable or unfavorable? Favorable. Okay. Asset turnover ratio. When I was discussing asset turnover ratio, I told Adi Parasikti. Why she told Adi Parasikti? She has a 10 hands, right? No, she don't have a 10 hands. She has only 2 hands. But the 2 hands she will use as she has 10 hands. That's why she used to say Adi Parasikti. It does not mean that she has a 10 hands. But she will use that a powerful way. That is a turnover. Income tax rate is 30%. Is there any key relationship between tax and leverage? No. Because tax nowhere concerned to leverage. Right. Now from the data, you have to calculate operating leverage, financial leverage, combined leverage, return on investment. Does it has favorable financial leverage or not? Now to do so, what you have to do is, you have to prepare, you see, fixed cost you have to calculate. Yes or no? Fixed cost. Break even point, fixed cost, break even point equal to fixed cost divided by PV ratio, or fixed cost equal to BEP sales into PV ratio. PV ratio another name? Contribution ratio. So when BEP sales are multiplied with the contribution, you will get the BEP contribution, right? BEP contribution equal to fixed cost. Are you getting? So basing on BEP's point, you have to calculate fixed cost. Number 2, total assets, asset turnover ratio is given. Total assets is 20, and whereas asset turnover ratio is a 2.5. Basing on asset turnover ratio, you calculate what is it? Total sales. So once you got the total sales, once you have a fixed asset, you can prepare income statement. Sales, you got the 50 less variable cost ratio, which is a given. Find it out. Deduct a contribution less fixed cost, you deduct. You will find the EBIT less interest on debenture 1.5. Next you will get the EBT less tax EAT. You will find the EAT, you will get it. Now basing on this, you can calculate operating leverage. Operating leverage equal to contribution divided by EBIT. Financial leverage equal to EBIT divided by EBT. 1.25 times, 1.12 times. Combined leverage, operating leverage into financial leverage. Then return on investment equal to EBIT divided by capital employed. That means 14 crores divided by 16 crores. That is into 100 means approximately 87.5%. Right? Here one more point is asked. Sir, whether the financial leverage is favorable or unfavorable. Now dear students, now tell me, return on investment is how much? That means for every 100 rupees, if they invest in business, they will to get 7.87.5%. Hello? Whereas the coupon rate of interest, what they are getting is how much? Coupon rate of interest. Here, Maji, rate of interest, they been rising funds at what percentage? 15%. You try to understand, 100 rupees they are rising from debenture holders by promising to pay. After all, 15%. But the rising funds and investing and generating how much percentage? 87%. Now tell me, debt is favorable or unfavorable? Favorable. Okay. So this is the way leverage, right? Even the next, this problem is very, very core comparing to any other problems, because this problem we covered, what is it? Leverages. Operating leverage, financial leverage, combined leverage, return on investment, break even point, variable cost ratio, asset turnover ratio. Does financial leverage is favorable or unfavorable? Only one problem, standard problem, which covers the entire concept. Right? You better to go with this observation, and it would be supports you a lot. This is the leverage problems, all the problems I considered. Here I made it some. These are the points you can understand. Sometimes from the MCQs, they may ask you, how do you calculate EBIT? How do you calculate EBIT, sir? Top to bottom, bottom to top. Top to bottom kya? Sales minus variable cost, contribution, less fixed cost equal to EBIT. EBIT minus interest, you will get the EBT. Yeah? Bottom to top also, you can able to find it out. Then EPS, earning availability equity shares divided by number of equity share. PE ratio, market price divided by EPS. Asset turnover ratio, turnover divided by total asset. Contribution ratio, another name. Variable cost ratio, variable cost divided by sales. Variable cost also called direct cost. Sir, direct cost, why you are telling here, sir? That building, you know. That building only I told morning. So since we shifted, right? Gone, right? Break even sales equal to total cost. Where break even contribution equal to fixed cost, right? Margin of safety from the given sales, if you cover your BEP sales, what is the left to you is called, what is that? Margin of safety. Operating leverage, contribution divided by EBIT. Financial leverage, EBIT divided by EBT. Combined leverage. Yeah. Why it is called, there is a certain points you can find it out. So interest you can find it out with the what? EBIT, EBT. What, Maji? Thereafter, what is a double-edged sword? Double-edged sword means what? Double-edged means a knife which has two sides, right? If you use this knife to kill other person, it would be killed. With a glory, by saying I killed another person, if you hold that knife on your shoulder, it takes your hand. That's why be careful with respect to what? Be careful with respect to fixed cost. Because of this, it's an advantage only, and sometimes it may create disadvantage. That is a double-edged sword. What is the difference between business risk, financial risk? Business risk arises because of operating, how you are operating, particularly fixed cost. Financial risk arises because of what is the return on asset? Return on asset, return on investment, return on capital employed. EBIT divided by capital employed. Return on equity, earning availability, equity shareholders divided by equity share capital. Then sometimes you must able to analyze income statement from top to bottom, bottom to top. Earning yield ratio, PE ratio formula, market price divided by EPS. Exactly opposite this. Earning yield ratio equal to EPS divided by market price into 100. Maximum, if you want to design one question paper, means beyond the border of this fence you never cross. If you are good at this class with the given formula, pakka. Okay, ma? Hello? Following right? Yeah. Because you know all the remaining problem, I cannot run behind all the problems because time is bahut kam hai. With this, next concept, what is this? Working capital management. Exactly, it will take one and a half hours. What is time now? Break 5, sir. Break any sir? I don't have a break, man. I have a lot of power to use. I never tired myself, right? You people haven't had a lunch, sound lunch, right? Now, if you take a break, you know, outside you see sunset. Okay? Nothing is there. Just if you wait for exactly 20 minutes, you will have a good cup of coffee. Okay? With the snacks. Sir, coffee snacks arranged, sir. Okay? It's highly impossible because just now we discussed one chapter. What is that? Not leverage. Working capital will go somewhere. Yes. Now, this chapter is a very, very important. Damn sure 10 marks question. But, you know, maximum, how many problems you know? Mahabharat. But if you solve one problem, we used to take 2 days for one problem. But this 1 hour, I have to explain the core concept. But maximum, I will give you the best. Right. First of all, what is a working capital? Working capital, if you split the word into 2 parts, you will find working, another one is a capital. Simple lines, dear students, already I told several times, whenever company need to estimate the capital, the company classifies capital into 2 parts. What are they? Fixed capital, working capital. Fixed capital means it is to make investment on what assets? Fixed asset. Working capital means it is to spend on current assets. Okay. If you invest on fixed asset, but you properly won't invest what? Current assets, automatically fixed asset won't work perfectly. That is the reason you have to understand. But you know, sometimes certain organizations, this is already, last time also I showed this, Air India from Srinagar delayed rat find on the plane. Rat. So this is the biggest flight, Air India flight, and this Air India flight from engine se rat aaya tha. If passengers are went inside, right, they were entering into the one, rat came. 2, 3, 4 rats are coming. What they have done? They asked, people asked, hey, kidhar se aa rahe? They said, sir, don't worry, we couldn't do anything. Well, if vimanan choose ichcha ani cheppe ratlu. If flight take off, you know, what will happen? If, you know, rats enter into our birva, what happens to our clothes? If your ear if come outside, you know. So basing on laughing of others, you will understand what will happen. Okay, here you try to understand how poor management, yes or no? If a company fixed asset is good, working capital is worst means the company never runs properly. So what is a working capital? Simple logic. Working capital is amount of capital required for smooth running of any business is called, what is that? Working capital. Tell me, what is a working capital? It is the amount of capital required for smooth running of business is called, what is that? Working capital. See, in this model, in working capital, before going to this, for every chapter I've been giving my opinion. Now do you tell me, we make some research. From 2018 to 2023, what are the major concepts they asked? Only they asked what is that working capital estimation, particularly on what based? Cash cost basis. Okay. Second one, they've been concentrating working capital for, this is existing firm, 1 point, right ma? Padma ji. Another one is new firm. Existing firm, new firm, 2 problems. And another one is management of receivables. Receivables only this. Another one is they asked one more problem, that is nothing but factoring. Only these 4 areas they've been asking. In coming exam also, which method would be they asked? 2023. क्या पूछा रे? Working capital estimation पूछा. What Maji? 2023 they asked what is this? Working capital estimation. But what firm? New firm. This time maybe existing firm or else working capital estimation he asked. But whereas receivables management not at all asked. Whereas factoring far away. So now which priority, which technique we can assume? Which technique or which model may appear in coming exam? As per the data, new firm is asked means maybe existing firm. If not so, factoring. Yes or no? Not no. Receivables they may ask. Hello? They are not so factoring. But comparing to any other sources, operating cycle it took long time. Now make your own strategy. First one, new firm or existing firm? Array, new firm just only asked ra. Existing firm, he may not be asked. Why? Because already he asked new firm, existing firm, both are same. In such a situation, he will go over operating cycle. Next priority, factoring. Next priority, operating cycle. Manu ila anukuntunnam vaala anukunte. Yes, what we been thinking in Bradipet, he may discuss it Mumbai. So okay, yeah. This is the strategy. And cash budget also they asked this. Cash budget. Yeah, coming to what is the operating? Working capital. What is the working capital? Amount required to run, what is it? Smooth running of business is working capital. Working capital equal to current assets minus current liability. To calculate working capital, we need to prepare the statement showing working capital. Where is current assets? Current assets you have to calculate. Current liability you have to calculate. For this purpose, you should understand 8 steps you have to follow to find working capital estimation. Working capital estimation, 8 steps. For here working capital, this is working capital estimation. What you have to understand here it is. These are the working capital estimation. First you have to analyze what is it? Inventory norms. What is that? Inventory norms. Inventory norms means various holding period. Can you tell me various holding period? Raw material holding period, work in progress holding period, finished goods holding period, debtors collection period, creditor payment period and time lag. Then you have to understand cost structure. Raw material consumption plus opening stock plus purchases minus closing stock equal to raw material consumption. For this, what is it? Direct cost, direct wages, direct expenses. You will get the gross work cost. For this purpose, opening stock of work in progress, closing stock of work in progress. If you do so, cost of production you will get it. Opening stock of finished goods add less closing stock of finished goods, you will get cost of goods sold. Yes or no? For that purpose, selling, distribution, office, administration expenses, if you add it, cost of sales. For that purpose, if you add profit, you will get what? Sales. Nothing is mentioned. It is what sales? Credit sales. Okay. Thereafter, you have to estimate individual current assets, individual current liability. Then you have to prepare statement of working capital. These are the various holding periods. What are they? Raw material, work in progress, finished goods, debtors collection period, creditor payment period, time lag. Whereas you have to find it out. Stock of raw material formula. Raw material consumed during the year divided by 12 months into raw material holding period. Coming to work in progress. Nothing mentioned in the problem. What is the conversion cost you will take? Raw material 100%, wages, overheads 50%. How do you calculate stock of raw material with respect to work in progress? Raw material consumed during the year divided by 12 months into raw material work in progress holding period into conversion cost of 100%. What about the wages? Wages incurred during the year divided by 12 months into work in progress holding period into 50%. Overheads incurred during the year divided by 12 into work in progress holding period into 50%. Stock of finished goods. Cost of production divided by 12 into finished goods holding period. Debtors. Credit sales divided by 12 months into debtors collection period. And cash you have to consider. What about the current liability? Trade creditors. Credit purchases divided by 12 months into creditor payment period. Wages incurred during the year divided by 365 into time lag. Overheads incurred during the year divided by 365 into time lag. If you add current assets and current liability, current assets minus current liability, you will get the net working capital. You can add what is that? Margin. Balu sir, okay. What about this holding period, sir? Raw material holding period means what, sir? See, raw material holding period means for the smooth running of the business, company purchases raw material and it will hold the given up to the given time period before sending it to factory. If you go and open the doors of the company, you will find raw material at least to run the company for at least 2 to 3 months. If the company maintains 2 months, that is called raw material holding period. Sir, then work in progress holding period, it is a time period required to the company to convert the raw material into finished product. Then finished goods holding period, sir. So when company produce a product, if immediately starts to sell in the market, automatically supply increases, demand gets collapsed. Hello? In order to hold regular demand and supply, company should not stop its production, whereas whatever the commodity it will produce, instead of making supply, it will hold it where? Go down. Are you getting? For example, you see that certain commodities, if you going on producing this product, if you start to supply in the market, if you start to sell in the market, supply what happen? Increases. In order to maintain a stability, what happen? They used to keep the products at a go down. And debtors collection period means, in order to make the more credit sales, company often provides a credit to whom? Debtors. That is called debtors collection period. Are you getting? Then creditor payment period indicates, sometimes we purchase a commodity from client, right? So client may provide you certain current credit period. That credit period decreases your current liability. That credit period decreases your current liability. So that is a favorable or unfavorable? Taking current liability from the clients is a favorable or unfavorable? Favorable. Because of this, your current liability increases, your working capital decreases. Are you getting ma? For example, I take loan from other friends. Some loans are my friends are being providing. In such a case, I don't have a problem with respect to working capital. Whenever I need a money, if I ask them, they will provide you current liability. If I don't have a current liability generating capacity, then there is a biggest problem to me with respect to working capital. Clear? Then time lag. What is a time lag, Balu sir? Delay payment of particularly wages, overheads. Sometimes we make a delay payment. So if we pay delay, so what is the actual time we supposed to pay? We pay delay. Because of that, we will save some income. This is what is that? Various time periods. After this is, you see, raw material holding period. You see, this is the go down, but they won't send. This is the take a time to send. What is that? Factory. This is called, what is that? Raw material holding period. What about the work in progress holding period? You see, here the factory raw material enters into the factory. To convert such a finished product, how much time it will take is called, what is that? Work in progress holding period. Thereafter, commodity produced, you should not sell directly into the market. You will hold in the factory, because to maintain stable supply, for that purpose you need finished goods holding period. Thereafter you make a credit sales. To make more sales, even though purchasing capacity is not there, you have to sell the commodity on credit basis. With effect, what happen? You may generate more sales, and sometimes supplier may provide you, what is that? Credit. Are you getting? Trade credit. But one of the point I would like to ask you, more important point, sir, while evaluating work in progress, conversion cost, how much we take, sir? If nothing mentioned in the problem, for raw material you take 100%, for wages, overhead. Okay, sir, while calculating stock of finished goods, should we consider depreciation or should we ignore depreciation, sir? See, for particularly stock of finished goods calculation, you need cost of production. For the cost of production valuation, you may ignore depreciation, you may consider depreciation. If you ignore depreciation, means you are doing on cash cost basis. You are considering depreciation, means you are considering total cost. Please read the problem carefully. If nothing is mentioned in the problem, take your own assumption. Don't skip the problem don't skip the answer without writing assumption. Okay. Balu sir, coming to stock of credit sales, while calculating debtors, should we calculate cost of credit sales or total sales? See, debtor should be evaluated in two ways. One is cost of credit sales on credit sales. What is that, ma? Cost of credit sales and credit sales. What is the difference between these two is profit. Sometimes you may ignore profit, and you see here, if you are ignoring profit means you are taking cost of sales. You are considering profit means you are taking credit sales, right? This is the way. Once you able to solve this one, this would be very good problem. You see, I selected a problem in our material. First we will go. See, in management of working capital, they considered the two problems. See, any of the problem we can take it, but here in this problem you try to understand. See, this is the PK Limited manufacturing. Sales are given. How much sales? You try to understand what is the core important point, because to solve this problem 1 hour it will take. You know this story. But just observe, sales are 1 crore 8 lakhs. Raw material consumed 27 lakhs. Labor paid is 21 lakh 60. Manufacturing overhead including depreciation. Including depreciation means if you take 32 lakh 40,000, you are valuating on what basis? Total cost. If you ignore depreciation, you are valuing cash cost basis. Administrative selling overheads are 10 lakh, right? Now here receivables are allowed for how many months? That means debtors collection period. Raw material supply extended 3 months. What is that? Creditor payment period. Where is lag in payment? Lag in payment is 1 month. Manufacturing overhead paid 1 month in arrears. Time lag, how much? 1 month. Administrative selling overhead paid in 1 month. This is an advance. Advance is nothing but current assets. Arrears is nothing but current liability. The inventory holding period, raw material, unfinished goods holding period is how much? 3 months. So raw material holding period how many months ma? 3 months. Whereas work in progress data is not given. But whereas finished goods is given how many months? 3 months. But here they given work in progress holding period will be how many? 1 month. But degree of completion is 75%, 50%, overhead is 40%. PK Limited sells at a cost plus 33.33%. And cash at bank balance expected to be 3 lakhs. Margin of safety is how much? 10%. What is the margin of safety? See, once you calculate current assets minus current liability, you will get the net working capital, right? For the sake of future uncertainty, what we'll do? We will add some margin to it. Okay, that is margin of safety. You are required to calculate working capital on what basis? Cash cost basis. Cash cost basis means this point is nowhere concerned to us. Why? Because this is a PK Limited sells cost plus. Hello? Cost plus. Actually what we need? Cost only needed. Now we have to prepare an income statement. You see, first of all we have to calculate stock of raw material. What is the formula of raw material? Raw material consumed during the year divided by 12 into raw material holding period. Work in progress. Raw material consumed divided by 12 months into work in progress holding period. 75%. Balu sir, you told 100% to be taken. But here given, that's why we have to take same. Thereafter wages. 21,60,000 divided by 12 into 1 into 50%. How much? 90,000. This is a administrative overheads. 28,80,000 divided by 12 into 1 into 40%. How much? 96. If you sum it up total, 3 lakhs. So are you clear with respect to conversion cost? Conversion cost should be taken into as per given. If not so, you can take 100%, 50%. Finished goods. Finished goods already they told to find it out what basis? Cash cost basis. In cash cost basis means should we consider depreciation or should we ignore? Ignore. Then how do you get this 77,40,000? Let's check. 77,40,000 means they have taken raw material, they added wages, manufacturing overhead. Balu sir, 32,80,000, you know why they have taken 3.6? Depreciation is ignored and they find it out 28,80,000. Now they got the factory cost. Indirectly it is called cash cost of production. For this add office and administration expenses they added 10,80,000. Then they find it out what is that? Cost of sales. What is that? Cost of sales or cost of total cost of production. It is not a cost of production. It's wrong, you know, because what Maji? Because what is added here? Selling distribution expenses adds means will it come cost of production? No. But you can say cost of sales you can say, but you should not say cost of production. 88,20,000. This would be the cash cost of production. Now you take it. 27 lakh stock of finished goods. How much ma? 77,40,000 divided by 12 into 3. How much? 93,35,000. 19 lakh, correct na? Okay. Thereafter debtors. Debtors they valued at on what basis? Cost of credit sales they have taken. Cost of credit sales 88,20,000 divided by 12 into 3 months. 22,05,000. Cash balance directly they taken. But advance they used to pay, you know, 1 month. So total administrative expenses 10,80,000 divided by 12 into 1. Hello? 1 month advance, right ma? Divided by 12 into 1 means how much you used to get? 5,40,000. Total current assets would be 60,09,760. Current liability, creditors, raw material consumed during the year divided by 12 months into raw material, creditor payment period. 3 months they provided means 6,70,000. Creditors for wages here it indicates not wages plus overheads also jointly added divided by 12 into 1 means 4,20,000. They got the total current liability and find it out working capital A minus B and they added what is that? Margin of safety. They find it out working capital. In this problem they identified what is the cash cost basis. Depreciation should not be considered. What is the difference between cost of production, cost of sales? Selling and distribution expenses is there. Raw material conversion cost should be taken 100%. Then why you have taken 75%? They are given, right? Okay. So debtor should be valuated on what basis? Cash cost basis they asked, right? That's why we have to take only cost. Okay. Margin of safety meaning what? Margin of safety. One current assets minus current liability is calculated. With that given amount, additionally we have to pay certain addition. Why? Because in future we don't know what might be the raw material price and cost and everything. It may increase. Why Polavaram still fighting? Because they could not manage what? Margin of safety. That is for maintenance. Working capital is maintenance. But the thing is, while they estimating working capital, not capital required, they should not consider all detailed of all aspects. That would be the reason. So with this respect to this problem is for new company or existing company? Existing company. After break, we will take working capital for new company, Untitled Limited. Well, so next one is we see new companies. Untitled Limited is a new firm. See the new firm, what is the observation I will tell you. Untitled Limited is a newly formed company, has applied to commercial bank first time for financing its working capital. The following information is available for the projections for the current year. Estimated units is 1,04,000 units. Complete production is 4,000. Total 1,04,000 plus 4,000 units. That is a work in progress. Raw material is 80 per unit. Direct wages 30. Whereas overheads excluding previous problem, including. But here 60 per unit. Total cost would be 170 per unit. Selling price is 200. Now here is raw material in stock. Average of 4 weeks consumption. That means what? Raw material holding period is 4 weeks. Work in progress is 50% completion in stage of respect of conversion cost. Material used at the starting of the project. Keep it in mind, whenever material used in the beginning means you always take raw material how much? 100%. Finished goods 8,000. Credit allowed by supplier is 4 weeks. Credit allowed by debtors is 8 weeks. Lag in payment of wages is 1.5 weeks. So the thing is, cash in bank is expected to be 25,000. Assume production is carried evenly throughout the year. Dear students, whenever we are estimating working capital means, we used to take an assumption that in future the business will run in a smooth way. 52 weeks and wages and overhead assume occurly. All sales on credit basis. You are required to calculate net working capital. The data what additionally given is investment on debtor should be valued at on what basis? Cost of sale. Stock of finished goods should be valued at factory cost. But this word is nowhere need because in the problem what is not there? Depreciation is not there. But this is the problem with respect to newly formed company. What we can do is you try to understand. Here you have stock of raw material. Hello? Stock of raw material should be estimated. Stock of raw material should be needed for two things. What are they? Raw material plus work in progress. Here it is. See, this is the Untitled Limited problem. Examiner wants to ask you the given questions. What is this? What is the difference between newly formed company and existing company? Do you know the difference? Newly formed company, existing company has what stock? Opening stock. What are? For opening stock means automatically purchases equation comes like this. Raw material consumed plus closing stock minus what is that? opening stock of finished goods. Whereas new company, no opening stock. No opening stock means purchases equal to raw material consumed plus closing stock. Because of what is not there? No opening stock. So in this problem, instead of holding period, what is the given? Units also given. Work in progress holding period is not given, but work in progress units are given. So this is the important point. If you observe the problem once again, raw material holding period 8 weeks, work in progress units are given. How many? 4 weeks. Finished goods holding period 8 weeks. Debtors collection period 8 weeks. Creditor payment period 4 weeks. Time lag 1.5 weeks. Now what we do is you have to calculate first of all stock of raw material. You see, stock of raw material formula is raw material consumed during the year divided by 52 weeks into raw material holding period. How do you get the raw material? You see, raw material, stock of raw material equal to raw material consumed divided by 52 weeks into raw material holding period. 86,40,000, how do we got it? Raw material consumed for finished goods 1,04,000 into 80 rupees, 83,20,000. Raw material consumed for work in progress, how much it is? 4,000 into 80, 3,20,000. If you sum it up, 86,40,000 you will get it. So that is the reason we have taken 86,40,000 divided by 52 weeks into 4. How much? 6,64,615. Work in progress 5 lakhs. How we get the work in progress? I will tell you. Here it is a work in progress. Raw material 4 lakhs into 80 rupees. How much percentage? 100%. 3,20,000. Wages 4 lakhs into 30 into 50%. 60,000. Overheads 4 lakh into 60 into 4,000 into 60 into 50%. How much ma? 1,20,000. If you sum it up total, it would be, what is that? 5 lakhs. Because here units are given directly. So that is the reason we have taken work in progress is 5,000. Coming to stock of finished goods, he told that 8,000 is going to keep. So 8,000 into 170, 13 lakh 60,000. Debtors asked on the basis of cost of sales 96 lakhs. How 96,000 into 170, 52. Why did he got the 96,000 total? You produced 1,04,000 units. Out of that you have how many units? 8,000. 1,04,000 minus 8,000. 96 is there. 96,000 cost is per unit is how much? 170 divided by 52 weeks into 8. It would be 25,10,769. So cash would be 25,000. So total current assets 50 lakhs 60,000. Yeah, coming to current liability, trade creditors. What is the formula of trade creditors? Credit purchases, yes or no? Divided by 52 weeks into creditor payment period. Dear student, tell me, it is a newly formed company. Credit purchases means what will come here? Raw material consumption plus closing stock. Raw material consumption plus closing stock. That's the reason trade creditors equal to credit purchases during the year divided by 52 weeks into creditor payment period. That means 93,04,615 divided by 52 weeks into 4 weeks. How much? 7,04,000. Here credit purchases 7,15,740. Credit purchases, how much you got it? Credit purchase equal to raw material consumed plus closing stock. Why closing stock to be added, sir? Because only highlight point in this entire problem is this. Because since the company is a newly commenced, so how much raw material it might be purchased, it depends upon two things. One is how much it consumed, and for the sake of next year, how much closing stock it been maintaining. That is an important point. That's why new company you have to take which one? Closing stock also. Credit purchase formula. What is the credit purchase formula? Tell me. I showed this equation before coming its use. New company, no opening stock. Generally purchase formula, what is it? Raw material consumed, closing stock minus opening stock. But in the problem, what is not there? No opening stock. In such a case, purchase equal to raw material consumed plus closing stock. Right. Thereafter, we have taken, what is this? Work in progress. Trade creditors is there, no? Purchase or finished. Yeah, wages. Wages you have to consider, what is it? Wages incurred during the year divided by 52 weeks into time lag. What is the wages incurred? You have a two types of products, complete produced products plus work in progress. For complete produced product you have to take 100%. For work in progress you have to take 50%. So what you have to take? Here you see. For wages incurred during the year divided by 52 weeks into time lag. So 31,80,000 divided by 52 into 1.5. How much it is? 91,730. Sir, how do you get this 31,80,000 means? You see, for finished goods you need how much? 1,04,000 into 30 into 100%. 31,20,000. Whereas work in progress 4,000 into 30 into 50%. How much? 60,000. Because for work in progress no need to take 100%. You take only 50%. For finished goods you must take 100%. So total 31,80,000. Thus 31,80,000. Here it is. 31,80,000 divided by how much ma? 52 into 1.5. You will get it 91,730. Whereas with this current liability 8,07,470, net working capital 42,52,914. What is the highlight of this problem? Whenever you are estimating working capital for newly formed company, credit purchase is crucial calculation element. Why? Because here generally you used to consider only consumption. But along with consumption, what you have to consider? Closing stock of material also must be consumed. Certainly considered. But many of the students, they used to ignore this one, but be attentive. That is the reason, even though time is getting delay, but I took this problem. Right, ma? Yeah. The next one is, another most important point is, from the examination point of view, we made a research, right? What the research? In the research, what we find it out? Operating cycle plays very, very important. What is operating cycle period? Operating cycle period is the time period in which raw materials are converted into finished goods. Operating cycle. You check it in your model. What Maji? What we analyzed it. See, this two models we covered. Total cost also covered, but there is a one point is, what is it? Operating cycle. So operating cycle, what is the operating cycle? How it to be calculated? So everything we are going to discuss now. Yeah, operating cycle, it indicates, see, this is the operating cycle. What is the operating cycle? Operating cycle is the, what is that? Operating cycle is the time period in which raw materials are converted into cash, right? So operating cycle includes various holding period. What are they? Raw material holding period, work in progress, finished goods, debtors, collection period, creditor payment period. What is operating cycle period means? It is the length or time taken by the company to convert the raw material into cash. Thus, this cycle also called, what is that? Cash cycle. What is that? Cash cycle. Once this cycle gets completed, then automatically more cash cycles will get it. CA Inter so far 1 year 2 attempts, right? In coming years they are going to give 3. In such a case, is it favorable to us or unfavorable? Favorable. Why? Because more number of times batch will come, gets completed, get the money, get completed, get the money, get completed, get the money. What ra? If 1 year 1 batch means Gaya. Okay, that's why more cash cycle is identifies. It's a time period in which raw materials are converted into cash. Suppose a company operating cycle period is 240 days means what is logic? Tell me. It takes 240 days to convert the raw material into cash. That means in a year how many cycles they can generate? 1. If it is 100 days means 3. If it is a 50 days means 6 cycle. If it is a 1 day means 360 days. There is one Hyderabad lady. She is selling, right? Food ma. Who is she? Huh? See how very close it. He may forget his own auntie. But you know, Kumari auntie name to yaad hai. Because she is making that much of income. Because her operating cycle how many days ra? 1 day. Kidhar ma morning prepare karta. इवनिंग को सेल करता, शाम को डबल काउंट करता. 1 day. My operating cycle 1 month. Are you getting? See, compare. She's making such a fastest. Our income generation is fast, too much fast. Okay, that is operating cycle. What is the operating cycle formula? You know, operating cycle is a full exact name is net operating cycle period. Net operating cycle period is a consist of various holding periods. What are the various holding periods or operating cycle? Number 1, raw material holding period, work in progress holding period, finished goods holding period, debtors collection period, creditor payment period, and time lag. Here you have to understand to calculate net operating cycle period, raw material holding period, work in progress, finished goods, debtors collection period, minus what you do, creditor payment period. So net operating cycle period also be calculated like this, inventory conversion period. What is that? So in order to make you to confusion, sometimes examiner may use the word, what is that? Inventory conversion period. Dear students, be attentive. Inventory conversion period is the combination of raw material holding period, work in progress holding period, finished goods holding period. Sometimes along with inventory conversion period, he may give raw material holding period also. So don't fall into the hell designed for you. Be attentive, right? Then if you net operating cycle period is 40 days, means how many number of cycles they will generate? 360 divided by 40, you try to understand how many cycles. So that means number of cash cycles equal to 365 divided by net operating cycle period. Then working capital means what is the total cost they used to spend divided by number of cash cycles. Dear students, you have to understand operating cycle means it is working capital means it is not capital kept by the company to maintain 1 year. It is the capital kept by the company to maintain 1 cycle. Hello? Working capital is maintained for the sake of 1 cycle, not for 1 year. In a 1 year, if you run 1 cycle, working capital per cycle is nothing but working capital only. But you know, your cycle is 1 day, 1 month means for a total how much 1 year you spent divided by 12 you can take. You will get it. What is that? Working capital per cycle. Clear? Working capital per cycle, not working capital per year. So these are the formulas you must know. Whereas you also know raw material holding period. What is the raw material holding period? Average stock of raw material divided by raw material consumed during the year. This is just reverse to stock of raw material. Stock of raw material formula? Raw material consumed during the year divided by 12 months into raw material holding period. Raw material holding period here, reverse trend. Whatever the client holds on current asset, that would be the numerator. It associated per year consumption would be the denominator into 365. Now raw material holding period equal to average stock of raw material divided by raw material consumed during the year into 365. Work in progress, average stock of work in progress divided by cost of production into 365. Finished goods, average stock of finished goods divided by cost of goods sold. See, what is the difference between cost of production and cost of goods sold? Only with respect to, what is that? Selling and distribution expenses. Cost of production, not selling and distribution expenses. Opening and closing stock of finished goods. If no closing and opening stock of finished goods, cost of production, cost of sales both reflect same. And debtors, average debtors divided by credit sales into 360. And creditor payment period, average creditors divided by credit purchases. So these are the formulas. Basing on this, we can go with the problem in our material. What is there? Yeah, here it is. This is the problem. You see, in the problem, opening stock, closing stock is given. Raw material, balance sheet 31st. Opening stock, raw material, work in progress, finished goods, debtors, creditors given. Whereas creditors 7168, debtors is given. Annual credit purchase raw material, annual cost of production, annual cost of goods sold, annual operating cost, annual sales. Dear student, now tell me, when should you take annual purchases? Purchases we should use for what? Raw material consumption we can say. Yes or no? Then credit purchase also we can consider. Cost of production used for cost of production. Work in progress. Stock of finished goods. Work in progress is cost of production. Stock of finished goods purpose. Cost of goods sold. Annual operating cost is given, including depreciation is 25 lakhs. But that means if you want to consider excluding, make it a minus of 325. Annual sales, all are credit. Now they are asking net operating cycle period. Okay. Number of operating cycles. Amount working capital required on what basis? Cash cost basis. If the company is a market leader, no competition in the market, and it wants to discontinue the credit, in such a case, what would be the impact on working capital? This is the problem. In such a case, first what we do, we have to calculate working note. Raw material holding period. Raw material holding period. Average stock of raw material divided by raw material consumed during the year. Opening plus closing divided by 2 divided by 360. If you estimate how many days? 53 days. Work in progress formula. Average stock of work in progress. Opening plus closing divided by 2 divided by cost of production into 365. You got 35 days. Finished goods holding period formula. Average stock of finished goods divided by cost of goods sold. Yes or no ma? So 365. If you multiply 60 plus 70 divided by 2 divided by 525. How much? 45 days. Debtors collection period. Average creditors. Average debtors divided by credit sales. By estimating this formula 77. Creditor payment period used to get. So 63 days. Creditor payment period. What is that? Average creditors divided by credit purchases. Now if you calculate everything you have, net operating cycle period equal to raw material holding period, work in progress, finished goods, debtors, creditor, estimate, if you will get what? 147 days. Number of operating cycles, 147 days means 365 divided by 147. How much it would be? 2.55 cycles. Okay. Amount of working capital required means working capital per cycle you need it, right? So 325 divided by 2.5 into one cycle. How much? 130. So this is the, for if the amount working capital needed on cash cost basis means you should ignore what is that? Depreciation. Okay. If the market leader, it means that what you will say, one of the holding period is going to decrease, right? What is, if the market leader means, try to understand which holding period is going to disappear. Debtors is going to be disappeared. Hello? It will become a 0. In such a case, 53 plus 35 plus 45 minus 63. Huh? 70, yeah? 70 is the net operating cycle period. Huh? What, Maji? Net operating cycle. 70 means number of cycles? 5 cycles. 5 cycles you will get it, right? In such a case, working capital per cycle on cash cost basis, 325 minus 25 divided by 5. 60, right? Previously, how much you used to spend? Working capital, how much you used to spend? 120 used to spend. Now it is 60. How much amount you saved? 60 lakhs. So just by reducing how many days? 77 days, you saved how much? 60 lakhs. Okay. That is the very, very important point. You see, in Chennai, there is a company. It is a Mailapuram is there. There is a factory. Once it was here the main gate. So here labor used to move from here to here. Here to here. So you try to understand, but the factory here it would be. There is a one more gate also here. But factory moves here. Now all the people, they used to come here. Are you getting? From when they step in here to come up to reach the production place, they used to walk at least half kilometer. So approximately 20,000 people used to walk. Every day 20,000 people has to walk half kilometers to enter into the factory. That means they will come, they may come to in time, but the thing is, because of this internal process work delay, they used to lose. Then immediately they changed the entire procedure. What is that? They analyze that instead of coming here, they open the gate here. They close this, they came. Here if they come means immediately they will enter. With effect, working capital would be saved. But you know, then they had the biggest discussion. Why? Here again gate should be closed. Here gate should be opened. How much cost it is? Are idiot. 20,000 people. How much every day work delay, right? That delay delay, because of delay, how much opportunity cost loss we are getting, that could be saved if they construct road here itself. So that is we have to analyze what is a positive, what is a negative, right? With this important. And the last one used to get it, debtors management. Debtors management is another important point. What is a debtors management? Debtors management also called, what is it? Receivables management. This is debtors management, also called, what is it? Receivables management. Dear student, the simple thing is debtors management means whenever company wants to provide, what is it? Credit sales, right? And company wants to judge whether providing credit sales or credit sales is good or bad. So whether it is a providing 30 days credit is good or bad, or extending 30 days to 60 days is good or bad. This is the question. So debtors, when it will forms debtors, when company wants to make a credit sales, then debtor forms. Hello? Forming, when company wants to make a credit sales, when make a company credit sales, debtor forms. But this debtors, having more debtors is a good to company because company makes a more sales. But the thing is, there is a disadvantage also. Why? Because bad debts, collection cost, everything happens. So being a manager, what we have to do is, we have to consider both the things. Whether there is a benefit for offering credit period or not, you have to think very, very innovative manner. If you make a more credit sales, what happen? If you provide more credit period, your sales will increase. When your sales increases means your revenue may generate. But that revenue never turns to profit to you because you have to incur what cost? Variable cost. And you have to incur what cost? Fixed cost. Sometimes you have to spend, what is that? Bad debt. Sometimes you have to spend for what? Collection cost. Hello? And thereafter you have to spend for administration cost. After deducting all the costs, you will get the profit. That is PBT. Income tax people will come and ask, what is that? Tax. That is the reason your expression would be like this. Arey kya karna hai bhai? So for that purpose, we have to make evaluation. There is a benefit is there. Profit is the benefit. But you have to spend certain cost. What are the costs? Collection cost, administration cost, bad debts, cash discount, opportunity cost. Considering all these things, we have to evaluate. For the sake of evaluation, we have to make a format. What is that format? Evaluation of a credit policy. A company asking 30 days. From 30 days to it is expecting 60 days. What you have to do means, present 30 days, you calculate how much benefit you are getting. And at the same time, you have to consider even opportunity cost loss also. Because 30 days, your amount getting blocked, right? Getting ma? And thereafter, what is that? You have to find it out for 60 days also. What is your opportunity benefit? By comparing to this, what happened? You can estimate incremental benefit. From 30 days, how much benefit we are getting? 60 days, how much we are getting? So comparing to these two, yes, whether there is an incremental benefit or not. Are you getting? If 30 days I will provide, how much benefit? Okay. The client is expecting 60 days. 60 days are. Already 30 days I am providing kada. Sir, provide one more 30 days, sir, additionally 30 days. In such a case, present 30 days, in future 60 days. Now, you have to evaluate that because of providing 30 days credit period now, what is the benefit I am getting? If I extend 30 days additionally, what is the net benefit? Again, I am going to get it. If comparing to 30 days in future, my net benefit is increasing, then it is okay. If the same value is getting means, why man? Yes or no? If you are getting less than that means, it is ridiculous to provide what? Credit. So now for that purpose, you have to consider 3 points, A, B, C. A is nothing but expected profit. Sales you take, less variable cost, contribution, less fixed cost, bad debts, cash discount. You deduct a collection cost, you will get the PBT, less tax. You will get what is that? Profit after tax. From that, what do? You deduct opportunity cost. What are they? Opportunity cost can be calculated on sales based. Opportunity cost also calculated on cost basis. But nothing mentioned. You better to calculate what? Cost. For the purpose, total cost divided by 360 into debtors collection period into opportunity cost. Now you find it out. This is the cost. And you find it out. This is the profit. From profit after tax minus opportunity cost, you will get the net benefit. Like that in 30 days used to calculate, and in 60 days also used to calculate. Comparing to this, if incremental benefit is there, how much? 30 days. In such a case, it is better to provide additional how many days? 30 days. For example, in 60 days also you got 1,50,000. What to do? Is it worthable, sir? Sir, present 1,50,000, sir. Proposed also 1,50,000, sir. Is it worthable, sir? No. So that is the one more observation you have to understand. Present 1,50,000. In future, it is just 40,000. It is not. It is not at all worthable. You have to analyze this. Okay. Basing on this model, several times they asked a public exam questions. Here there is a problem in front of you. You see how many times this question is asked. Clear? Yeah, this is the several times this asked this question. You see this question. X corporation presently credit policy, it is evaluating current credit policy. It has a two proposed, you see. The question is this. X corporation is currently relaxing its present credit policy. Relaxing means extending a, reducing a. Relax, liberalize. That is nothing but what is that? Extending. Present relaxing its present policy. Process is evaluating two proposed policies. Currently annual sales is how much? 50 lakhs. And account receivable turnover is 4 times. What is account receivable turnover means? Company making a credit sales and collecting cash from the credit sales in a year 4 times. 4 times in a year they are collecting means how many months they have been providing? 3 months. 12 months is a per year, right? 4 times means 3 months they have been providing. That means current credit period is how many months here? 3 months. 3 times means 4 months. 2.5 months means 5 months. As credit period increases, your amount to be collected gradually what happen? Decreases. Are you getting? Okay. Sir, how do you get, sir? What is a receivable turnover ratio? Meaning what's a receivable turnover ratio? Receivable turnover ratio, it indicates it is the time period or number of times the company generating sales by making credit sales and collecting money from the client. In that situation, account receivable turnover is how many? 4 times. That means in a year 4 times means time period 3 months. That means currently the company providing credit period of how many months? 3 months. They are going to implement policy 1. Policy 1 means from 3 months to they want to increase 4 months. Policy 2, from 3 months to they want to increase 5 months. If you want to implement option 2, you have to go with the 2 months credit. For policy 1 it is just additionally 1 month, right ma? Here additionally 1 month. Here additionally how many months? 2 months. That is the reason for present how many months? 3 months. Here 4 months means additionally they are asking 1 more month. Here 2 months means additionally 2 months. 5 months actually. That means additionally here asking 2 months. So here my objection is to which policy would be the best. Just now I told you the format. What is that? Your entire debtor policy is depends upon A, B, C. A is what? Expected profit. B is what? Opportunity cost. C means net benefit. If C is positive, accept, otherwise reject. You see in the problem, actually what is the sales given? You take it here. Policy 1, policy 2. No, this is the present policy. This is the policy 1, policy 2. Expected profit. Credit sales, how much? 50, 60, 57 lakh, 67 lakh, 50,000. Now in this one, what do? You have to deduct total cost. Variable cost is given 35 lakhs, 42 lakhs, 47 lakh, 25. How they given variable cost? Because they clearly mention how much it is. 70% of variable cost. But in the problem they clearly mention where it is ma? 70% is the variable cost. So they deducted variable cost. Then they deducted bad debts. Bad debt directly given, I think so. Bad debts. Then they find it out expected profit. Is there any tax to be paid? No. So that is the point they directly taken into the consideration. Now they have to calculate opportunity cost. Opportunity cost means opportunity cost may be calculated on credit sales and total cost. Hello? Credit sales on total cost. Total cost means because of making this credit sales, how much cost we supposed to spend. That is the most important. Here you see what is the cost you incurred? 35 lakhs. Hello? 35 lakhs. 35 lakhs indicates that because of by providing credit to the company, 35 lakhs your amount is getting blocked. On this 35 lakhs, you are going to lose opportunity cost rate of how much? 25%. For that purpose, 35 lakh divided by 12 months into 3 months into 25%. How much? 2,18,750. Proposed policy 1. 42 lakh divided by 12. Here it is a cost is 42 lakhs. Here is cost is 47 lakh 25,000. So 42 lakh divided by 12 into 4 into 25%. 3 lakh 50,000. Proposed policy 2. 47 lakh 25,000 divided by 12 into 5 into 25%. 4 lakh 92,188. By taking this opportunity cost, we find it out net benefit. Present net benefit is how much? 11 lakh 31,250. Proposed policy is 11 lakh 50,000. That means additionally, how much we are getting? 18,750. But comparing to this policy, here getting negative, right? Present we are getting 11 lakh 31,250. But in last policy we are getting 10 lakh 82,812. In such a case, 48,038. Is it positive or negative? Now tell me, what is your advice? Will we provide credit period or no to Allah? No to Allah. No. First we can implement how much of credit period we can provide. Hardly it is a better to provide, what is it? 1 month. If you provide 2 months, right, it is not a good to the company because it is a loss. Okay. So this is the way to you have to analyze. Okay, ma? Now tell me, how to evaluate a credit policy means, first of all, you should design a format. Basing on that, you can identify. That depends upon 3. What is that? A, expected profit, opportunity cost. In profit, what is the procedure? Sales minus variable cost, contribution less fixed cost, less bad debts, less cash discount, less collection cost, and PBT less tax. Okay. Yeah, there is one more topic to be learned is nothing but factoring. Yeah, factoring, they asked for just one time, just that too, what is that? Basic identity. Okay, ma? But still, I am spending more than 1.5 hour only this chapter. Capital budgeting 1.5 hour, this one. Because I know what is important. This. Because, you know, dividend policy from past 10 years, just they asked only one time. But here several times I asked. So instead of providing all the subjects, my core important to at any cost you make to pass. Are you getting? So now factoring. What is the factoring? See, whenever company makes a credit sales, and company has to wait to collect the money. Sometimes what happen when company makes a credit sales, instead of collecting, if it concentrates only on how to collect the money, means it cannot concentrate a regular business operation. For that purpose, the company takes service of another person, is nothing but what? Factor. Factoring is agreement between the two parties, company and factor. Hello? Company and factor. Why company takes a factoring agreement? I will show you a small presentation. I made it. Here it is. Here you see. Factoring. Factoring, let us imagine a situation. Here, this is the company, right? Hello? Here is the company. This company made what sale? Credit sale. And from this money has to be collected by the concerned company. Now what he will do? He will go and he will take the service of whom? Factor. Arey man, I will pay you given commission. What do? You go and collect the money and hand over to me. If the person who provides a service is called what? Factor. The agreement between the company and him is called what? Factoring. Yes or no? So the company, here the situation is happens. You see, here is the firm. It makes a credit sales to customer. If the goods goes to customer and invoice document comes to firm, what this firm do? This firm approaches whom? Factor. That it will convey that I sold commodities to so and so X party. This is invoice document. You do one thing. You work like a agent. What is that? Work like a agent, as a recovery agent to me. So then factor enter into the agreement. This factor goes to the customer on due date and collects the money and hand over to firm. And during this agreement period, sometimes if the company need a money, he may take loan from whom? Factor also. Are you getting? Because factor with at any cost, he assures that he is going to collect the money and hand over. Are you getting, ma? That's why factoring is an agreement between the two parties. Who are there? Company and factor. What the job of factor? Go and collect money and hand over. Sometimes if the factor financially fit, then he may provide a temporary loan also. When he provides loan, when he collects money from customer, will he give total amount to company? No. What he do? He will take his commission. He will take his commission. He will take his interest also. By charging or taking commission plus interest, he will give you a remaining balance. So factoring advantage is what? Advantage to the company. Company may not worry about the bad debts. Bad debts, collection cost, administration cost, every cost would be saved. And at the same time, company may concentrate again to make more sales. More sales. If there is no factoring, company cannot identify this one. And advantage not only company but also to the customer. Why? Because if the company if the customer don't have a money, but the company has an idea about the factoring, means he may also convey, sir, you make a credit sale, sir, you take a factoring agreement and I will pay on the due date. Okay. And one more observation is factoring conveys one of the innovative financial service to the company. Sometimes if you want to take a loan, means you try to understand, you have to go to the bank, financial institution, and you have to spend a lot of money. But whereas you have to wait other charges and you have to wait for a long period. But whereas in factoring, what will happen, you take a factoring agreement, and once factoring agreement you have taken, means that it is a responsibility of factor to collect the money and pay in time. That is the reason factor may take what? When factoring agreement is there, means automatically company has one more financial resources available. So factoring service also conveys one of the source of finance to whom? Company. Now tell me, what are the advantages of factoring? Two. Number one is for effective collection of money. Another one is for the sake of source of finance. So that's why the 2 points we can take. Why the company takes an agreement, factoring agreement? Tell me the 2 reasons they will take. One is for effective collection of book debts. Another one is source of finance. Practical observation, I will tell you here. This is the Andhra Bank, one of the closest concept. Andhra Bank provided loans and advances to several people. But this Andhra Bank, when RBI got the idea that Andhra Bank is going to merge with which one? Union Bank. Then to collect all the funds, Andhra Bank took service from whom? Bajaj Finance. So Bajaj Finance collected total money of Andhra Bank and hand over. Now tell me, who is a customer, who is a company here? Andhra Bank is a company, Bajaj Finance is a factor. He collected money and he provided. If the Bajaj Finance has enough capital in their hands, right, he can provide, what is it? Temporary loan also. Okay, ma? So what are the advantages, disadvantages of factoring you have to consider? You see, well, whether to take factoring service or not, means what you have to do means take factoring benefits. What are the benefits of factoring? Tell me. Saving of bad debts, take. Saving of collection cost, take. Opportunity cost benefit. Opportunity cost benefit means sometimes factor may collect the money and hand over early. In such a case, you will get what? Opportunity cost benefit also. And the contribution benefit. Contribution benefit means sometimes factor says that, Balu sir, you make a credit sales, I will collect, sir. Because of his voice, if you make more sales, you will get one more benefit. What the benefit is? Contribution benefit. So you add all these things, find the total. Total is nothing but 2 lakhs you are getting. Whereas factoring cost, sometimes he is not our uncle kid. We have to pay what? Cost or fees to him. That is a cost you have to pay. And sometimes he will provide a loan, means on the loan we have to pay what? Interest. And another one is contribution loss. Contribution loss actually. Contribution loss means because of trusting factoring word, sometimes we may reduce sales. If the sales are reduced, then on the reduced sales we will lose contribution. That is also loss, right? Now you add this cost also. Then this cost is nothing but 50,000 total or 1 lakh. Now tell me, benefit you are getting how much? 2 lakhs. Benefit you are getting 2 lakhs. Cost is nothing but 1 lakh. After deducting cost, still you are getting how much? 1 lakh. So factoring service to be taken into the consideration. So these four parts are very, very crucial for examination purpose. Remaining is their minor concept, cash budget, a systematic estimation of availability of cash for a particular time period. For that purpose, we used to prepare cash budget. There is a concentration banking, logbox system is there. Maximum they will ask you MCQ, and maximum they will concentrate only 1-2 marks question. But here I know that Aneja Limited, that PQR Limited, that debtors management operating cycle, it will consumes maximum time, but in an examination point of view, very, very important. Okay, so you pay attention on this concept. But the theory part, they could not ask many in this area. They will ask only 2 times, approximately 4 marks they asked. But remaining everything, what is that? Past exam question paper, if you check it, they could not ask it. Yeah. Coming to, you can go with dividend decision, we will move. Open a dividend decision. Dividend decision chapter, where is our chapter dividend decision? Maji, you check it a dividend decision. What are the areas they've been asking? Number 1, they asked only Walter, only Walter. Next, Garden egg bar, dividend discount model 1 bar, Linters model 3, approach nothing. Okay, approach they could not identify. Which one? Miscellaneous approach they could not ask. But major, what is that? Walter, Gardens and dividend model. Okay, IPL match started. Okay, I do understand. But you know, our match is very important, right? Right. Now, Garden model. Coming to dividend decision. What is a dividend decision? Tell me. This is dividend decision. Financial management decisions being classified into how many types? 3 types. What are they? Financing decision, investment decision, dividend decision. Bottle undi, water లేదు. This is called working capital problem. Alright, now see, dividend decision. A company has a dividend decision, it indicates you should understand the basic identity. There are 2 types of decisions actually. What are decision? Financing decision, investment decision. Company has to raise funds at a low cost, right? And that company has to invest at high rate. When high return they used to get, from the return if you deduct the cost, you will get the profit to be get. But what to do with that profit? Whether the profit available should be given to shareholders or retained is what is called what decision? Dividend decision. If you get the loss, no chance of what decision? Dividend decision. So here, first theory is nothing but, there are certain theories, what they convey is that, some argument is there when company declares a dividend. Company declares a dividend, indirectly it conveys that I don't have reinvestment opportunities. When company declares a dividend, market value will decrease. But when company don't declare a dividend, again market value will decrease. So what the company has to do means, it has to analyze the market situation and basing on that, it has to declare. What to do? Should we declare a dividend or not to declare a dividend? For that purpose, different models came into the picture. That models being classified into 2 types. What are they? Relevant models, irrelevant models. Relevant model means dividend decision of the company. Dividend decision of the company will influence what? Market price. Irrelevance, what it indicates? Dividend decision of the company does not influence. So 2 models, relevant, irrelevant. Walter, Gordon, Graham Dodd, Linter. Who are they? Naluguru, these people. Tell me what are the names? Walter, Gordon, Linter, Graham Dodd. These 4 members identifies that dividend decision certainly influence market price. Whereas another one, Modigliani and Miller, he says that no, that is not at all right one, because dividend decision never influence, what is that? Market value. That is his opinion. Either a working capital, 1 minute, I will clear this documents. Why it is? This is a capital structure, right? This is a working capital. Where is dividend decision? This is here. Seema. Dividend decisions being how many types? Relevant models? Irrelevant. What is a relevant, irrelevant model? It affects, what is that? Share price is a relevant model. Irrelevant model? It does not affect, what is that? Share value. So here Walter, Gordon, Graham Dodd, Linter. There are 4 members actually. Here is Modigliani Miller. What is Walter theory? Walter theory argument is this. Here you see. But before going to understand this one, you must understand certain formulas. Dividend per share formula. Total equity dividend divided by number of equity shares. Dividend rate. Dividend per share divided by face value of share. Dividend yield. Dividend per share divided by market price per share. Dividend payout ratio means dividend per share divided by earning per share. Retaining ratio, morning class we discussed. 1 minus dividend payout ratio equal to retaining ratio. 1 minus retaining ratio equal to dividend payout ratio. Right. First of all, Walter model. What is the Walter model argument is? See, he simply identified 2 things. What are the things? Number 1. If a company made a profit, should we declare this profit or not? This depends upon 2 things. For example, a company made a profit. This is the profit. Should we give dividend or should we retain? This is the 2 concept. If I declare a dividend, you will invest this fund somewhere else. You will generate what is that return? Your return is 20%. If I retain, I will reinvest. If I retain, I will invest means hardly I will get 10%. How much I will get? 10%. If I declare dividend, 20% you will invest. You will generate. But if I retain, 10%. So what the company will generate is called R. What is it? R. Rate of return earned by the company is R. If company declares a dividend, equity shareholders will get a chance to invest. Okay, that is called KE. R is investor expected rate of return. Now tell me, Walter theory argument is the 2 points is. So this theory is influenced 2 things. What are they? Cost of equity, rate of return. Rate of return is called, what is that? IRR. This is the return earned by who? Your company. KE means investor. Value of the firm depends upon dividend policy. Dividend policy of the company depends upon 2 things. For example, here is the company. Here is the investor. Here if the company when earn how much? 20%. Investor earns how much? 10%. Now tell me. Company earns how much it is? 20%. Investor earns 10%. Now tell me, you are a financial manager. You work for himself. Hello? You work for himself. If you give dividend, he works for himself. Are you getting? You are a financial manager. You are all equity shareholders. If I retain, I work for yourself. But if I give dividend means you work for yourself. Okay. But between these 2, who is going to work effectively makes a matter. Makes a matter. If company R is greater than KE, what to do? R is greater than KE. Retain. When K is greater than R, dividend. Okay. But when R is greater than KE, tell me, my R is greater than KE, retain. K is greater than R, dividend given. R and KE both are same. It does not make any situation. Okay. KE and R remain same means dividend decision does not influence. Okay. This is the theory. Walter theory is based upon, what is that? There is a simple logic. Tell me, Walter theory is a relevant model or irrelevant model? Relevant model. According to Walter theory, whether to pay dividend or not to pay dividend depends upon the details of cost of equity and rate of return earned by the company. If the company IRR is greater than cost of equity, it is a better to declare a dividend because that man can utilize his funds and generate his wealth. If the company IRR is greater than cost, then instead of declaring dividend, it is better to retain. So you must know IRR and KE. How do you find it out? KE means there is a one ratio is there. What is the ratio? So KE equal to one of the formula, KE equal to EPS divided by market price. PE ratio formula, market price divided by EPS. That means KE can also be traced out 1 minus PE ratio. 1 minus PE ratio. 1 divided by PE ratio. But here certain assumptions are there. What the assumptions of Walter theory is? R and KE remain constant. R and KE remain constant. It should not change. And there is company moves with 100% equity only. Company moves with 100% equity. Company has two investment opportunity. Only thing is retaining profit. Sir, you give a dividend, you take a money from outside, you can raise a debt means what it says? No. Sir, if you give a dividend and you can raise, what is that? Debenture. No debenture, no additional equity. Investment opportunity should be utilized only when company has, what is that? Retained earnings. Okay. Finally, this theory. This theory was suggested by who? Walter. Walter theory is relevant or irrelevant? Walter theory depends upon two factors, R and KE. What is R? Earned by the company or earned by the investor? Earned by the company, not investor. Okay. So if R is greater than KE, what to do? Declare a dividend. Sorry. Retain. When KE is greater than R, dividend to be declared. When KE and R both are same. No. What are the assumptions associated with this theory? This theory argument is R and KE remain constant. Company has only equity. So that is the problem with respect to this. Let's take one of the standard problem. When you asked second problem only, no? We will take dividend decision. Time value. Yeah. Here you see Walter's model. The following information relating to Casio Limited. This is the problem, right, ma? You see, very, very important problem. You see how many times they asked this model. Only one problem. They asked several times. Okay, if you get the clarity about this problem, any of the problem from this model, comfortably you can handle it. Okay, let's take the following information related to total earnings of the company. How much? 2 lakhs. Number of equity shares? 20,000. Dividend paid? 1 lakh. PE ratio, price earning ratio, that is nothing but PE ratio given. How much, ma? 12.5 times. Now find it out applying what model? Walter model. Find out equity capitalization rate. How do you calculate KE? 1 divided by PE ratio, you can find it out. What is the rate of return? How do you calculate? Rate of return, you will calculate like this. See, total earnings are how much? 2 lakhs. Number of equity shares is 20,000. What is the share price? 100. 200 into 10. You will get the equity share capital. So EBIT divided by 200 into 100. You will get the rate. Let us check it. How do you calculate? KE equal to 1 divided by PE ratio. 1 divided by 12.5 times equal to 8%. What is the return on investment? Earning availability equity shareholders divided by equity. 2 lakhs divided by 20 equal to 10%. Well, here one more point what they asked is, here, analyze whether the company following optimal dividend payout ratio. Optimal dividend payout ratio means what? See, optimal dividend payout ratio of the company depends upon R and KE. Just now we discussed. When R is greater than KE, what the company has to do? Company has to retain. When KE is greater than R, company should be declared. But here what is going on? From the total earnings of 2 lakhs rupees, company paying dividend how much? 1 lakh 50. That means how much percentage? 1 lakh 50,000 divided by 2 lakhs into 100. 75% they are declaring dividend. So when should they declare a dividend? KE is greater than R. But in the problem, what is the KE? 8%. What is R? Actually, if intelligent financial manager, what he has to do? He should retain. But instead of retaining, what this idiot is doing? Now tell me, is the following optimum dividend policy? Yeah? No, worst optimum policy they are following. Right? What is the market price? And third bit, what is it? Find the value of share at the present dividend policy. Here, market price, according to this model, Walter model, market price or market value of equity can be calculated with a given formula. What is this? D plus E minus D into R divided by KE whole divided by KE. What is this logic behind this? See, market value is nothing but present value of future benefits. Market value is nothing but present value of future benefit. If the company makes a earning, it has to give a declared dividend. Then every year it gives a dividend. Okay. But first year, whatever the profit it will generate, whatever the dividend it declares, remaining amount, what they do? They will retain. That retained amount they will reinvest. On the reinvestment amount also, equity shareholders expect some income. That means he will expect a 2 income from you. What is that? One is directly from, this is the EPS. Dividend he will expect directly. Got it. He won't take this one. What about the remaining? Retained. This retaining amount again you have to make reinvest. This retained amount at the reinvested rate you will retained amount if you reinvest means you will get certain benefit. That benefit again you have to bring into present. He will directly bring 2 benefits. One benefit directly, another benefit indirectly. So that is a dividend. First you are getting from equity, you are paying a dividend, and that amount, rest amount you are going to invest and R, again you are going to bring into present divided by KE. So market price equal to D plus E minus D into R divided by KE whole divided by KE. Now if you pose the value 7.5 plus 0.10 divided by 0.08 into 10 minus 7.5 divided by 0.08, you will still get how much? 132.81. And here find the value of share at optimal dividend payout ratio. Optimal dividend payout ratio means 0% dividend payout ratio. Here what we do at optimal dividend payout ratio, dividend would be 0. So 0.10 divided by 0.08. Here R divided by KE estimate cheste 156.25. How do you formula? What is the formula? D plus E minus D R divided by KE whole divided by KE. Okay. Then finally what they asked is compute PE ratio at which dividend policy will have no effect. Now tell me, dividend policy does not make effect. When dividend policy does not make effect? When R of the company equals to KE of the investor. In the problem, how much R? 10% is there. In such a case, KE also must be 10%. But actually KE is how much it is? 8%. But if the KE is 10%, then dividend policy does not affect. When KE is 10% means PE ratio should be? PE ratio should be how many times? KE PE ratio reciprocally, no. 1 divided by PE ratio in percentage is nothing but KE. 1 divided by KE is nothing but PE ratio. When KE is 10% means PE ratio is how many times? 10 times. Okay. So that is the point. For example, if R is 5 means R is 5% in such a case. R is 5% means KE also should be 5%. KE 5% means what is the PE ratio? 1 divided by 5. How much? 20 times. Clear? This is, now tell me. Return on investment formula? EBIT divided by capital employed. PE ratio formula? KE formula? EPS divided by market price. KE is the return earned by the company. True or false? Return earned by the company. Who? Investor. KE also called investor expected rate of return. Right. This is the which theory? Walter theory. Walter theory, market value of equity formula? D plus E minus D into R divided by KE whole divided by KE. Right. Thereafter, there is a one more problem they asked. Here it is. Here it is. We can take one is a Walter. Next important model is Gordon. What is that? Gordon model. What is a Gordon argument is? Gordon says Walter argument is this. We already just now we solved the problem. This is Gordon model. Yeah, Gordon argument is Walter suggested that when R is greater than KE, what is that? R is greater than KE, when you have to retain. When KE is greater than R, you have to declare a dividend. Gordon theory, very simple. You see, this theory also suggested by who? Gordon. Okay. Gordon theory is relevant or irrelevant? Relevant model. This argument is what it conveys that when a company, has a two rates, what is that? R and KE. If the company retains more, when R is greater than KE, if the company retains, market value will increase. Whose theory? When company R and KE, if R is greater than KE, if I retain, market value increase. Whose theory it is? Walter theory. But Gordon argues that, Mr. Walter, your theory is not appropriate because when your R is greater than KE, you can retain. But after retaining this, where you have what to do? You have to reinvest these funds. While investing reinvestment, you will find three types of comps. One is growing companies, saturating companies, declining companies. Hello? Growing companies means their return is wonderful. Their saturation companies, normal return. Whereas declining companies, their return is very, very low. So here, whatever the amount you are retaining, this retaining amount you will reinvest somewhere else. Hello? If you by chance reinvest at a low rate, automatically your growth rate gets damaged. So growth rate equal to, what is the formula? Morning class we discussed. Growth rate equal to retaining ratio into rate of return on reinvestment. But at a low rate, if you invest means your amount will get what? Spoil. That means you will get a negative growth rate. Are you getting my point? Once you get the growth rate negative, automatically investor risk element what happen? Increases. Once investor risk element increases, your market value decreases. The idea, once again I am saying. What is the Walter theory? Tell me. Walter argument is when R is greater than KE, by following 0% dividend to payout ratio, company what will increase? Market price will increase. But Gordon argument is when R is greater than KE, by just retaining, your value is not going to increase. What you have to do means thereafter you have to retain, right? That retained funds where you are going to invest. how much growth rate you are submitting. Hello. Mr. Walter argument is very simple. Gordon argument. Mr. Gordon conveyed to Walter that, Mr. Walter, you have to play a role of your father. A father gives a birth to, means he take care about his daughter, right? He take 1 lakh more than 2 lakh decisions, and she makes even chartered accountant. But one fine day, because of some reasons, he makes a marriage with one of the stupid idiot. In such a case, you retained more, but everything is good. But your reinvestment went to worst. Everything gone. Hello? That example connect ayindi kadamma? Adi. So means once you retain, you take a different situation. Once you retain, where you are reinvesting, that reinvestment gives a growth rate. Basing on that growth rate, investor expected rate decreases and market value increases. For example, you see, you stand up, ra. I am R. He is a KE. His KE is greater than my R. What should I do? I have to declare a dividend. My R is greater than his KE. What should I do? Retain. Once I retain, market value will increase. Whose theory? Walter theory. But Gordon theory argument is no. Your R is greater than KE, market value won't increase. Just if you are comparing to his KE, your R is increased means automatically this amount, again there is a lot of things are there. What to do? This reinvestment. If you reinvest and submit a growth rate negative, automatically this risk element what happen? Increases and your market value will decrease. Why? Because he will start to sell and quit the company. But whereas you are retaining and reinvesting and submitting positive growth rate means he feels very happy. He will start to buy the shares at high rate. He won't expect a maximum from you. Less only he will expect. With effect to market value, what happen? Increases. So market value depends upon his KE. His KE if increases means he is not at all feeling risk. So market value will increase. His KE increasing means he is facing much risk. Then market value what happen? Decreases. But his market value, his KE is depends upon growth rate. Where you are retaining, how you are reinvesting, basing on that what is the return you are generating. Simply, Gordon theory argues that market value depends upon risk element of equity shareholders. That risk element of equity shareholders depends upon growth rate. If you retain reinvestment, submit better growth rate, his risk decreases, your market value increases. Are you getting me? So what is it? Now tell me difference between Walter theory, Gordon theory simply. Because only these 2 points, if you get little bit confusion also, my entire efforts goes to waste. Walter theory suggested, what is the Walter theory argument? When R is greater than KE, you retain, your market value will increase. What is the Gordon argument? When same R is greater than KE, if you retain, market value won't increase. Thereafter, you have to retain, you have to where? You have to reinvest and you have to submit a better growth rate. If you retain outside and if you lost everything, automatically your market value decreases. If you retain and you invest and you increase growth rate, automatically market value increase. So picture bahut baki hai dostani. Once retaining chesnanta matrana, what will happen? Market value won't increase. So thereafter you have to retain, reinvest and submit a growth rate. That growth rate should reduce the risk element of equity shareholders. Because of that, market value will increase. Okay. Where is formula equal to? Gordon model formula equal to market price equal to DPS1 divided by KE minus growth rate. By chance, if for example you try to understand, dividend is for 2 rupees ma. Dividend is 2 rupees. KE is 15%. You are submitting 5% growth rate. Try to understand what is the market price. 2 divided by 15 minus, actually you will expect 15, but you are providing 5% growth rate. In such a case, what happened? 2 divided by 10%. Finally, net effect is 20. Whereas if you submitted growth rate, you retained and you submitted, you gave it 10% this time. In such a case, what will happen? 2 divided by 15% minus 10%. In such a case, 40. Why 40 vantra? Growth rate is increasing. This growth rate decreasing, what is that? Investor expected rate of return. Suppose you given 14 growth rate. In such a case, 2 divided by 15% minus 14%. How much? 200. But by chance you gave a negative 14? Sorry, sir. In such a case, what will happen? Then 2 divided by 15% minus gets what? Plus 14%. In such a case, 2 divided by 20, 2 divided by 29 equal to 6.89%. You 6.89. What is that? Market price. So that is the reason you have to retain and reinvest and submit a positive growth rate. Walter theory formula? D plus E minus D into R divided by KE whole divided by KE. Gordon formula? DPS 1 divided by KE minus growth rate. Growth rate formula? Retaining ratio into rate of return on reinvestment. When should we get positive growth rate? You have to retain more and reinvest at high rate, better rate. Yeah. Here you have a small problem. This is the problem. RTP they given. You see. Net profit is 30. Outstanding 12% preference share 100. Number of equity shares is 3 lakhs. Return on investment is 20%. Cost of capital is 16%. Now cost of capital is KE. Return on investment is R. Hello? But number of equity share is 3 lakhs. Outstanding preference share is 100. Net profit is 30. Now this is the RTP given for 5 marks. Let us take. In this problem, earning availability equity shareholders equal to, here already given how much net profit 30 lakhs. 30 lakhs minus preference dividend you have to pay. How much you used to get? 18 lakhs. Then EPS equal to earning availability equity shareholders divided by number of equity shares 6 rupees. Then how do you calculate market price? Market price equal to DPS 1 divided by KE minus growth rate. How do you get the estimation of market price? Here what they projected. When 25%, 50%, 100%. In such a case, if it is a 25%, what is the situation? Growth rate equal to retaining ratio into rate of return on reinvestment. How much you are retaining here? 75%. Whereas your rate of return on reinvestment is 20. In such a case, growth rate you are providing 15%. So market price equal to DPS 1 divided by KE minus growth rate. How much is market price? 150. When you are providing growth rate is how much? 50. You are earning how much? 150. Whereas estimation of market price when dividend payout ratio is 50. Previously how much you paid? 25. That means you retained 75. You retained more, you reinvested, you submitted better growth rate. Whereas if you dividend payout ratio 50 means your retaining ratio how much? 50. This 50 you will invest at 20. You will get the growth rate how much? 10. Thus growth rate is gradually decreasing from 15 to 10. With effect to market price what happened? Decrease. Whereas in last situation if you declare a dividend how much? 100%. Then there is no retaining ratio. In such a case growth rate is 0. In such a case market price would be 37.5. What is the argument is, Mr. Walter, retaining does not makes my boy. What to do? You have to retain amount, you must reinvest, you have to submit growth rate. By seeing this growth rate, investor expected rate decreases, he will start to buy your company shares, so market value will increase. Play a role of father. For my daughter, I took care from hospital to still now, okay, but marriage gone. Marriage gone. So that's why be careful, man, when R is greater than K. Okay, ma? Then this is the point. Another one is Modigliani-Miller theory we will discuss. Modigliani-Miller, so far it could not asked in exam, but we have to identify Modigliani-Miller dividend model is relevant model or irrelevant model? Irrelevant model. What this argument is this? Which one, ma? Carry. Any doubt in this? Any doubts in this, ma? Cheppu. Modigliani-Miller model. So Modigliani-Miller model argument is this. This theory was suggested by who? Modigliani. Modigliani argument is this. A company dividend decision does not influence what? Market price. But a company's market value depends upon their earnings. Not because of what is that? Their dividend decision. Dividend decision does not make any influence. Dividend decision will influence only market price. Sorry, their earning capacity. For example, his argument is that he took an assumption that the total he calculated market value. Here I will take 1 minute. See, theory, suggested by who? Modigliani and Miller. This theory is the relevant model or irrelevant model? Irrelevant model. Irrelevant model. What this model argument is, market value of firm never influence what decision? Dividend decision. But what it is going to influence means its earning capacity. What is that? Earning capacity. That earning capacity depends upon investment decision. Investment decision. So if the company invests in a right way, in a right situation, automatically their earnings, what happen? Increases. When earnings increases means automatically their market value increases. Tomorrow if you complete the CA, will you get the direct income? By completing CA? No. Once you complete a CA, by using that knowledge, by solving the problem of society, then only you will get the income. So Walter argument is that complete CA, your life will go somewhere. But theory says, hello, completing CA does not make you successful. What will make you successful means how you are going to use this knowledge to solve the problem of corporate and how you are going to make a income. So in order to identify this, he took certain assumption. Assumption number 1, investor is a free to buy, free to sell the security. He may move from this company to that company to this company. Number 2, investor have a perfect knowledge. What is going in the market, investor knows everything. Whether this by staying in that company is a good or bad, or moving in that company is a good or bad, everything. Investor has a perfect knowledge. Investor is a free to buy, free to sell the securities. And another important point, this theory argument is, he calculated the entire value of firm by taking assumption that the life of the project is how many years? Just 1 year. What is that? Just 1 year. Sir, what is this 1 year? Company runs for the long period, but for the sake of market evaluation, market calculation of firm and market price, he took the life of the project would be only 1 year. And another important point you should understand, a company has fixed investment policy. What is that? Fixed investment policy. At the end of the period, either you may do dividend decision or not, but compulsory you have to convey what decision? Investment decision. What is that? Investment decision. Let us simply example, make it the situation. This is the balance sheet of the company. On 31st, the company has to declare a dividend. His argument is, if the company has a profit, the profit is 40 lakhs is there. That profit company may either declare a dividend or another one is retain. That retained amount it may use for what is that? Investment. The logic is nothing but, if the company either declare dividend or not, but it has to undertake a investment decision, that is nothing but fixed investment decision. What is that? Fixed investment policy company has. Now try to understand, if the company profit is there, if the company declares a dividend, what will happen? Company declares a dividend means the cash from the company goes outside. Okay, but I have to take investment decision. For that investment decision, I need a money. Whatever the money I have, what I declared? Dividend declared. Now I have to take investment decision. What should I do? I have to issue number of shares. If I issue number of shares means automatically once I declare a dividend, my market value what happened? decreases. First logic Modigliani Miller is, if you declare a dividend means in your balance sheet certain amount gets what is that? Disappear. In such a case your market value decreases. Immediately you have to take investment decision. Once you want to take investment decision means what you have to do? You have to issue number of shares. But where your market value per share would be very gets low because you declare a dividend. In such a situation, what happen? You have to issue more number of shares in order to raise funds, in order to undertake what decision? Investment decision. In such a situation, in balance sheet, what will happen? You see, suppose you simply understand. Here is a fixed asset is there, 90 lakhs. Cash is there. How much it is? 10 lakhs. Total is how much? 100 lakhs. How much? 100 lakhs. Here you come to equity share is there. 10 lakh shares at a 10 rupees. How much it is? 100 lakhs. Total their balance sheet is 100. Now the company need to make an investment that is nothing but 10 lakhs. How much? 10 lakhs they meet. Now try to understand, if the company declares a dividend, what will happen? If the company declares a dividend, automatically in balance sheet, what will get disappear? This 10 lakhs goes out. In such a case, the total assets they have is 90 lakhs. Previously, 10 lakh shareholders used to share 10 lakhs. That's the reason is 10 rupees per share. Now, their share value will become out 9 rupees because asset gone. Now, dividend once declared, automatically their market value decreases. But whereas at the end of the day, you have to undertake what decision? Investment decision. For investment decision, you have to go for equity, right? That 10 lakhs, you have to issue number of shares at a 9 rupees each. In such a case, how many shares will increase? 10 lakhs divided by 9. 1,11,111, right? So these shares will added to which one? Equity shares. Already 10 lakh shares plus this is a 1,11,000. That means 111, right? 111. 11 lakhs. But each share price today is nothing but 9 rupees. So 111 into 11 lakh into 10 means your share value would be 100 lakhs only. Once you issue a shares, you will get the cash here. You will make a investment. How much investment here is? 10 lakhs you used to get. Because you issued this capital, and with this capital you will invest and balance sheet reflect. So now try to understand, if the company declare a dividend, anything will happen? No, not happen. Company when declare a dividend, for this, once company declare a dividend means automatically its market value decreased. In order to undertake investment, it has to go for new issue. Since it has to issue more number of shares because its market value decreased because of dividend decision. So in liability side, you see more number of shares getting added. In right side, you make an investment. So dividend decision does not make investment. Whereas if you don't want to declare a dividend, in such a case, what will happen? You don't want to declare a dividend. In such a case, for example, you have here, you have a fixed asset. Fixed asset is how much? 9 lakhs, 90 lakhs, we took it? 90 lakhs. Whereas cash is there. This cash directly will convert into investment, 10 lakhs. The total value would be as it is. But here, equity shares would be 10 lakhs into 10 rupees. How much it is? 100 lakhs. That means once you won't declare a dividend, if you declare a dividend, this will happens, but the total balance sheet will remain same. If you want to declare a dividend, then also your balance sheet will remain same. Then your market value depends upon where you are going to invest, how much return you are going to generate. That is the most powerful point you want to convey. Are you getting? So dividend decision is irrelevant. Either you declare a dividend, not to declare a dividend does not make any sense. For that purpose, he made certain formulas. The formula is only 1 year valuation you have to take, right? 1 year value is nothing but MP0 equal to market value is nothing but present value of future benefits. That means 1 year means what you are going to get it. MP0 is nothing but DPS1 you are going to get a plus you will get what is it? MP1. MP1 means market price at the end of the period and the dividend at the end of the period. This both you can bring into present with the present value factor, future value factor. 1 plus r whole power of n. Sir, 1 plus whole power of n means I am not multiplying with the future value factor. I am dividing with future value factor. Hello? How do you find the present value? Chappane? Present value equal to future value into present value factor r percentage n number of years. Okay. In such a case, present value you can find by multiplying present value factor. But Modigliani-Miller argument is I am not using this strategy. I am using another strategy. Future value equal to present value into future value factor r percentage n number of years. Thus, present value equal to future value divided by future value factor r percentage n number of years. That is the whatever the value you are getting in future, if you divide it by with future value factor, you will find this logic. So that's why MP0 equal to DPS1 plus MP1 divided by 1 plus K. Basing on this, you can calculate another one. What is this? MP1 equal to MP0 into 1 plus R whole power of n minus DPS 1. So this is the another formula he projected. And finally, what he conveyed is MP0, MP1 and a number of new shares. Number of new shares for investment. For investment, number of new shares needed means, first of all, you take how much amount is required for investment. But this is Modigliani-Miller theory, just discussing 10-15 minutes is highly miracle. But the thing is, I personally believe they could not ask for the period. This attempt, there would be a chance. But you have to understand all the formulas. So MP0, MP1, number of new shares would be investment amount minus earnings. From this, you have to declare what is that? Dividend. Divided by, what is that? MP1. So this is the number of new shares for investment is required. Number one, investment amount minus, for investment no need to issue number of shares, because from that minus what will go? Earnings minus dividend. So finally, what the market value of firm he projected? So existing shares plus new shares into MP1 plus earnings minus investment divided by 1 plus KE is the market value of firm. So if you declare a dividend, not to declare a dividend, market value will remain same. So these are the core formulas you should understand to find it out, to prove Modigliani-Miller theory. What is that? MP0 equal to DPS1 plus MP1 divided by 1 plus R. MP1 equal to MP0 into 1 plus R whole power of n minus DPS1, and number of equity share for investment equal to investment minus earnings minus dividend divided by MP1. Total market value of firm. Market value of firm equal to existing shares plus new shares into MP1 plus earnings minus investment divided by 1 plus K. To prove this one, let's make one of our problems in our material. You see, this is the problem which is there. Study material MTP 2 November 2018. You see, in this problem, RST Limited has a capital employed of how much? 10 lakhs and equity share 10 rupees each. Equity shares are currently quoted at what price? Per. The company proposes to declare a dividend of how much? 10. Declare a dividend means DPS. Declare. Company proposes to declare. That is DPS 1. And the equity capitalization rate of the company is 12%. So KE is 12%. Market price of the share at the end of the year. What will be the market price of the share at the end of the year if dividend is declared, dividend is not declared? That means they are asking what is that? MP1 when dividend is declared, when dividend is not declared. Assuming that company pays a dividend, company pays a dividend and has the net profit of how much? They have a 5 lakhs, but they pay a dividend and makes a new investment is how much? 10 lakh during the period. How many new shares to be issued? Use the model. Particularly they need what is that? MP1? What Maji? Now tell me MP0, how much here in the problem? The capital they have how much? 10 lakh. Equity share is 100. 100 is what is this? MP1 MP0 now? MP0 there no. And the dividend is given. KE is given. Dividend is declared, dividend is not declared. Now tell me how should we do? First one is given in the problem. MP0 equal to 100. DPS1 equal to 10. KE equal to 12%. We know that MP0 equal to DPS1 plus MP1 divided by 1 plus KE. That means MP1 equal to MP0 into 1 plus KE minus DPS1. So now what is the situation? Estimation of MP1 when dividend is not declared. In such a case, MP1 equal to 100 into 1 plus KE minus dividend is not declared, then in such a case it would be 0 equal to 112. That is 112 you will get it. Check the answer there. This is would be 112. Whereas you see 112. Whereas second situation is when dividend is declared. In such a case, MP1 equal to MP0, that is 100 into 1 plus KE minus 10 equal to 102. So if dividend is not declared, in such a case market value would be 112. When dividend is declared, it should be 102. And here estimation of number of new shares to be issued when dividend is declared means new shares equal to investment minus earnings minus dividend divided by MP1. Investment is required, what is it? 10 lakhs. For 10 lakhs they won't go issue share price. But whereas minus they have a earnings of how much? 5 lakhs. Minus dividend. Dividend means how many shares? 10,000 shares. For each share they will give you 10 rupees. 10,000 into 10. 1 lakh. 5 lakhs minus 1 lakh. 4. 10 lakhs minus 4. 6 lakh divided by 1 or 2. How many shares? 5,883. So this is the way to you understand dividend market value and number of shares estimation of which theory? Theory. But you can also prove with this given aspect when dividend is declared, dividend is not declared. Okay, ma? But this is the very, very lengthy calculation it needed to find it out. But only concentrate on this two. What are they? Walter theory, Gordon. But have an idea with respect to which theory? Theory. Walter theory formula? D plus E minus D into R divided by KE whole divided by KE. Whereas Gordon model? DPS1 divided by KE minus growth rate. Whereas model? MP0 equal to DPS1 plus MP1 divided by 1 plus KE. MP1 equal to DPS0 into 1 plus KE minus MP0 equal to MP0 हो गया ना, MP1 we need MP0 into 1 plus KE minus number of new shares should be investment minus earnings minus dividend divided by MP1. Yeah. And our time is getting up. 8:30 our class? Just I am asking ma, I to know. And last one, what is that ma? Advanced concept and ratio analysis also is there. What is that advanced concept is there? Here, where is that advanced concept? See, advanced concept, core concept are covered in where? Capital budgeting. Yeah, advanced concepts. Advanced concept means you should understand there are certain concepts to be needed. Yeah. See, capital budgeting is an investment decision. Capital budgeting is nothing but a systematic evaluation of long-term investment decision. To make this investment decision, you have to understand certain advanced concepts. What are they? Sunk cost, common cost, opportunity cost benefit, opportunity cost loss, specific cost, working capital, subsidy, treatment of depreciation in the presence and absence of tax, and tax shield, capital gain and capital loss, profit and loss. All this comes under the category. What is a sunk cost? Sunk cost means before commencement of the project, whatever the cost incurred, such a cost is called sunk cost. Common cost indicates if at all any existing company already it been incurring some cost. Okay, if you undertake a project, not to undertake a project, certain cost remain same. Such a cost is called what cost? Common cost. Opportunity cost means Navajeevan Hospital. We discussed morning. What is Navajeevan Hospital? Yeah, because of undertaking an investment, if you are getting some benefit because of making investment, an opportunity gets created. Because of that opportunity you are getting benefit, that is called opportunity benefit. Opportunity cost loss means because of making investment, an opportunity gets death and you are losing certain income, that is called opportunity cost loss. Specific cost means because of this project specifically you incurred, such a cost is called specific cost. Specific cost to be considered. Sunk cost should be it should be ignored. Common cost should be considered. No, common cost also should be ignored. Sunk cost means before commencement of the project the cost incurred, such a cost is ignored. Common cost means if you undertake a project, not to undertake a project, such a cost will exist. Such a cost also should be ignored. Opportunity cost benefit should be considered. Opportunity cost loss should be considered. Specific cost should be considered. Working capital should be considered. Subsidy should be considered. Treatment of depreciation in the presence of tax, in the absence of tax should be considered. Tax and tax shield also should be considered. Capital gain, capital loss also should be considered. And profit and loss. See, what is the difference between gain and profit? Gain and profit. See, while purchasing an asset, because of by using this asset, whatever the commodity you will produce, by selling that commodity, if you make any income, that is called profit. If you purchase an asset and at the end of the period, if you sell that asset, if you make some income, then it is called what? Gain. Gain happens only once in the life, whereas profit happens regularly in the life cycle. Regularly business company purchases asset, with that asset company produces product and makes a sale and generates a income. That is nothing but profit. Clear? Profit and gain. So while evaluating profit, while evaluating any project, this cost should be, you have to consider. This concept already we recovered. Now another most important point is what decision? Replacement decision. For advanced concept, only one concept plays very important role is what decision? Replacement decision. In replacement decision, what is a replacement decision? First you should understand. Replacement decision means a company may replace its existing machine with new machine. Existing machine with new machine. For that purpose, it has to, for two reasons it may go for. Number one, to increase output or to decrease maintenance cost. Sometimes it may expect, what is that? Both. Are you getting? What is the reason for replacement means? To increase output, to decrease maintenance cost, sometimes both. In replacement decision, you have two approaches. Total approach, another one is incremental approach. While calculating estimation in incremental approach means, suppose you try to understand, I have a bike and I want to replace this bike. Same situation, company has a machine. Company wants to replace its old machine with what? New machine. What they do, step number 1, first they will sell which machine? Old machine. When they sell old machine means income tax people may come. For that purpose, what they do means first they have to calculate depreciation for old machine. Why? Because you are selling, right? Once you make a sale means automatically you may get what? Capital gain or capital loss. If gain it happens means you have to pay tax. If loss means you have to get tax shield. To determine this one, step number 1, what to do? You calculate depreciation for each of the machine. Old machine you calculate, new machine you calculate. So depreciation, cost minus scrap divided by life. Now old machine also you calculate. Thereafter, sell the old machine in the market. And whatever the revenue you will get it, with the revenue you purchase new machine. For that purpose, cash outflow. Present value of cash outflow means cost of new machine you take it, less what is it? Net sale proceeds of old machine. If at all working capital also is there, you can add the working capital, and finally you can find it out, present value of incremental cash outflows. And finally you have to calculate operating cash inflow. To calculate operating cash inflow, both the machines, old machine is there, new machine is there. You can calculate the revenue versus new machine versus old machine. You can find it out incremental revenue. But luckily if the PBDT is given means, then you can calculate what is it? Incremental PBDT from less what is it? Depreciation. Then you will get the PBT less tax, PAT, add back to depreciation, you will get what is it? Incremental CFAT, and you can bring it into present, you will get the incremental operating cash inflow. And finally you may get it what cash inflow? Terminal cash inflow. The terminal cash inflow not, that is the incremental terminal cash inflow. Incremental terminal cash inflow means net sale proceeds of new machine at the end of the period less net sale proceeds of old machine at the end of the period. If you compare this both, you will get it what is it? Incremental net sale proceeds. And if at all any working capital is there, you can recover the working capital. You will find what cash inflow? Terminal cash inflow. And you bring into present, you will find the present value of incremental terminal cash inflow. Finally, you calculate incremental NPV. Incremental NPV equal to present value of incremental operating cash inflow plus present value of incremental terminal cash inflow minus present value of cash outflow. Okay, so this is the replacement decision. Tell me step number 1. When tax is there, better to calculate what is it? Depreciation for old machine. Then sell the old machine, get the money, buy the new machine, and find it out because of purchasing this new machine, what is the incremental benefit I used to get it. Hello? Then finally you calculate incremental terminal cash inflow. You add the both cash inflow and you deduct a cash outflow. If incremental NPV is positive, then project should be accepted. Otherwise, rejected. Okay, now there is a problem. Here it is, this problem is our material only. You try to understand this problem. An existing company which is operation over the period of how many years? 2 years. Its remaining estimated life is how many years? 10 years with no salvage value. Already it been used for how many years? 2 years. In such a case, what is its total life? Maji, remaining life is how many years? 8 किधर माँ? उधर देखो, an existing company has the machine which has in operation in 8 years. How it came? See, an existing machine. This is existing machine. This machine been in operation for how many years? 2 years, and its remaining estimated life is 10 years. What is the total life? 12 years. So remaining life is 10 years. 2 years is gone with no salvage value. Means if you sell this asset in the market, you are not going to get it any income. Its current market value is how much? If you sell this asset in the market, you will get how much? 1 lakh. The management is considering proposal to purchase an improved model of the similar machine which gives an increased output. Do you understand why the company going for selling a replacement? Because of what? Increased output. Okay. Then relevant particulars is given. Purchase price 2,40,000. This is a 4 lakhs. Estimated life 12 years, 10 years. Salvage value, nil, nil. Annual operating hours, 2 hours, 2000 hours, 2000 hours. Selling price per unit, 10, 10. Whereas output per hour is 15, 30. Material cost per unit, 2, 2. Labor cost per hour, 20, 40. Consumable stores per year, 2000, 5000. Repairs and maintenance, 9000, 6000. Working capital, 25,000, 40,000 required. The company follows what method? Straight line method of depreciation. Tax is how much purpose? Should the existing machine can be replaced or not? Assume that company required rate of return is 15%. This is the situation. Now the client came to my office and he has an existing machine over the period of, he is using how many years? 2 years. What is the remaining life? 10 years. Now tell me, what should I do first? Tax is there. First, what should I do? Depreciation. Depreciation, what method? Straight line method formula. You take a calculator, respond. So, here you see. Evaluation of replacement decision basing on what approach? Incremental. Step number 1. Depreciation for each of the machine. Depreciation equal to cost minus scrap divided by life. What is the new machine? 4 lakh minus 0 divided by 10 years, right? How much it is? 40,000. Old machine is 2 lakh 40,000 minus 0 divided by 12, 20,000. Okay, this is the depreciation we calculated. Now to make a replacement, I have to sell what machine? I have to old machine I have to sell. The gross sale proceeds of old machine, if I sell in the market, how much? 1 lakh. But you know, when I purchased asset worth of how much? 2 lakh 40,000 I purchased. Just I used how many years? 2 years. In the 2 years, after selling this asset, how much I am getting? Just 1 lakh. What I do means, I will calculate written down value. Written down value equal to 2 lakh 40,000 I purchased. 2 years asset getting depreciation, 20,000 into 2, 40,000. 2 lakh 40 minus 40 means I used to get 2 lakhs. 2 lakh worth of asset I am selling for 1 lakh. I am getting capital loss. On the capital loss, I will claim for tax shield. And net sale proceeds from the asset would be 1 lakh 50,000 I used to get. Actually, I sold 1 lakh only, but because of this, I got what is it? Net sale proceeds. Okay, ma? With this amount, I go to the market. I want to buy cost of new machine is how much? 4 lakh. Less net sale proceeds of old machine as on today. But I don't need to spend 4 lakhs because I sold. Which machine? Old machine. Because of that, I got how much? 1 lakh 50,000. If I deduct 1 lakh 50,000, net amount I will get 2 lakh 50. But along with this, I need additionally working capital also. But a new machine working capital needed 40 lakhs. But old machine working capital is there. If you compensate this, hardly I need 15,000. So total with respect to incremental cash outflow would be 2 lakh 65,000. Okay. Now coming to this, what is the present value of incremental operating cash flow? You try to understand how many here I made a working note. New machine and old machine. New machine works for, you see, sales. Sales revenue, how should I get? Sales I will get in hours into output per hour into selling price. So if I 2000 hours into output per hour into, what is this? Here, how many hours it worked in? Just here you see. How many hours it worked? 2000. Output per hour is 15. What is the selling price? 10. In such a case, 2000 into 15 into 10. 3 lakhs. Similar to another machine also. Tell me. 2000 hours into 30 into 10. Yeah, 6 lakhs. So like that, I calculated, what is that? Sales revenue. From the revenue, I deducted material cost. I deducted labor cost. I deducted consumable stores. I deducted repairs and maintenance. I got the PBDT. By comparing this both, I got the incremental PBDT. Yes or no? Incremental PBDT 3,89,000 minus 1,89,000 means I got it 2 lakh. What I done means, because of going this replacement decision, I got the incremental PBDT 2 lakhs. From incremental PBDT less, I have to deduct incremental depreciation. Because old machine depreciation is 40, New machine depreciation 40, old machine depreciation 20. Thus incremental depreciation 20,000 if I deduct. PBT I used to get 1,80,000. Less tax 50% means 90,000. PAT 90,000. Add back to depreciation. You will get the 1,10,000. 1,10,000 I am going to get the CFAT over the period of how many years? 10 years. This 10 years I have to bring into present means PV of operating cash inflow equal to 1,10,000 into present value annuity factor 15% 10 years. That means 5,52,090 I used to get. And coming to terminal cash inflow, present value of terminal cash inflow means gross sale proceeds, net sale proceeds of new machine is nil. Gross sale proceeds, net sale proceeds of old machine is nil. But where is the recovery of working capital is there? 15,000. This 15,000 is the terminal cash inflow to me. And I have to bring this one into present means I used to get 3,705. Finally, I have to calculate incremental NPV. Incremental NPV equal to present value of incremental operating cash inflow, present value of incremental terminal cash inflow minus present value of cash outflow. By estimating operating cash inflow 5,52,090 plus 3,705 minus 2,65,000. I used to get 2,90,795. Now incremental NPV positive or negative? Positive means should we accept or reject? Accept. So one of the method is very important point and examination is replacement decision. See, I chosen this a problem. This problem covers major areas. 8 steps it is considered. Now, question number 1. What is replacement decision? Hello, last 10 minutes, be active. You should not get... Array, I'm talking, you are listening, right? Whose energy gets depreciated? My energy. After break, no break to me, right? Without break, I'm taking class because I don't want to give career break to you. Yeah. That's why, I never gets tired because, you have, at any cost, there is a much blessings on you that you have to get cleared this exam. Okay. This, if it is a matter of job, I won't involve this much. It's not, my work is not linked with my salary. My work is linked with my passion. So many of the students, they are spending this time means, if I talk, your life is going to be changed means, I feel proud of myself. Are you getting? I never judge with respect to what is a bank balance. Okay. But amount would be credited. I will get the message. Comparing to this message, here I will get the message. Arey Balu, aaj acha kiya re tu to. That is the thing. But jagrata chuskondi rani. Arey, it is not the, what is the script I've written, right? It is a wholehearted, right? Sometimes, I'm doing the best means, I feel myself, today evening if I go on means, Arey Balu, kya kiya? I done maximum best. But how you reach it is secondary issue. The process should be enjoyed perfectly. I should not concentrate the results. Because when I'm live, right, at the time Dhoni also is living. Dhoni also used to say, never think about what is that. Results. Give your best. Sometimes it may reach, but it may not. But the thing is, you people are staying here means, try to understand means you have a passion. At any cost, this attempt what? We have to pass. Such a people are standing in front of me and expecting to listen my voice means how powerful my voice should be. That is the point. Even though tight sum is there, whatever it may be, nothing chalta hai. I have to give best. But after completion of this class, story is different. Okay. So step number 1, I have to calculate depreciation for old machine. Step number 2, I have to sell old machine. Next step number 3, I have to buy new machine. Then I have to calculate PV of incremental operating cash inflow. Then PV of incremental terminal cash inflow minus, and finally I have to calculate incremental NPV. Incremental NPV positive, accept, otherwise reject. Okay, with this model is completed, but there is a one question they asked. If you observe the entire material, there is a one area they asked. This is only number. Where is advanced? We could not write. I will show you. In the advanced, see what model they asked, ma. Even replacement also not asked. Are you getting? Replacement also not asked. Only one point they asked. What is it? life disparity. What is that? Life disparity. But I will discuss all this concept. NPV IRR conflict is the only one topic which will provide you 5 marks. NPV IRR conflict means while evaluating two mutually exclusive projects, okay, there is a topic NPV IRR conflict. What is that? While evaluating two mutually exclusive projects. How many projects? Two mutually exclusive projects. So sometimes what happen, we will calculate. This is NPV IRR conflict means while evaluating two mutually exclusive project, for one project NPV may be higher, another project NPV may be higher. Such a situation is called, what is it? Conflict. Here you see, there is fighting. This is NPV, this is IRR. So reason for this conflict, as per one project NPV shows high value, another project IRR shows high value. So in such a situation, the what we have to do means that is called NPV IRR conflict. Reason for conflict, given projects are, what is it? Mutually exclusive and having a disparity. What disparity? Having a cash flow disparity, having size disparity, having what disparity? Life disparity. In that point, life disparity means what? I will tell you. Here it is, you see. NPV IRR conflict. First, what disparity? Size disparity. देखो ये कितना बड़ा है, this is disparity called what disparity? Suppose a client who comes to your office, he want to make investment in project A, this is the 40 lakhs, whereas project B is 20 lakhs. Now tell me, between these two, because of having disparity of an investment, NPV IRR conflict certainly forms. What disparity it is called? Size disparity. Whereas life disparity means one project life is how many years? 12 years. Another project life is 8 years. Such a situation, here it is a 12, this is 8. What disparity? Life disparity. Another project is cash flow disparity. Cash flow disparity means one project gives initially more and gradually decreases. Another project initially gives less and gradually increases. This is what disparity? Cash flow disparity. Are all are seems to be same? One is what disparity? Size disparity arises because of life or investment. Life disparity arises because of life. Cash flow disparity means that is cash flow pattern of generation. One project initially generates more, another one initially generates, what is that? Less. Between these two, how to identify this life disparity is very important. What is a life disparity means? Difference of life. Suppose how this life disparity should be identified, I will tell you. Here it is. This is the life disparity. In the life disparity, there is a two techniques you can follow. For example, a project A is there, project B is there. Project life is nothing but this life is 10 years, this life is 5 years. This project life is an NPV is how much? 20,000. This life is NPV. No, instead of this, we can directly take a problem. You see, here this is the problem. R Limited is considering modernized product facilities and it has two proposals under the consideration, which as project should be accepted basing on annualized NPV at a given NPV. You see, project A, NPV is how much? 6.497. Project B, 5.192. Life is how many years? 6 years and 3 years. Which project should be accepted means what should I do? Which project should be accepted means, shall I say, project A is the best? No. Why project A is not best? Because this giving NPV 6.497 by taking lifespan of how many years? 6 years. But there is 3 years. In such a situation, what to do? Two techniques should be used. The technique number one is we used to go with whenever life disparity is there, first to go with annualization. What is that? Annualization means don't take total, go with annualized. How many years the project given does not takes into consideration. Take what is that? Every year how much it is going to get it. For that purpose, what to do means you have to calculate annualized NPV. annualized NPV equal to NPV divided by present value annuity factor or percentage n number of years. Keep it in word, my dear students. Either NPV or revenue, cost, maintenance, whatever it may be, if you divide it by with annuity factor, every year equal value it will come in future. So that is the reason whatever the NPV is there, you divide it by with annuity factor. In such a case, total NPV turns to annual NPV. So like that, project A NPV you calculate, project B also you calculate, and which project annual NPV is highest, you can recommend that one. For example, you see here, in project A, annualized NPV equal to 6.47 divided by present value of annuity factor. 6.497 divided by 4.111, because 12% 6 years means how much it is? 1.59. Similar to project B, annualized NPV equal to 5.196 divided by 12% 3 years. If you estimate how much it will be, 2.1465. Now tell me, as per total, project A NPV is highest, but as per annual, which project is life is? Project B, because that is the total is good, but the total is outcome of 6 years. But whereas here 5.16 is outcome of 3 years, but if you convert into per year, it would be how much? 2.1465. I told you while taking the class, Swami Vivekananda lived just 35 years, whereas my grandfather still is alive. But is there any benefit? No. How many years you lived, it does not make any sense. But how effectively you lived, that is the most important. That's why you should not take total. Total, wonderful. My grandfather lived more than year. Kyun? That is the important thing. So you have to consider annualized NPV equal to total NPV divided by present value annuity factor. You should not take, what is it? Number of years. Okay, there is one more simple concept. Cash flow disparity. Life disparity means what? Difference of life. Whereas size disparity means difference of investment. Whereas cash flow disparity means pattern of generation of cash inflow. Okay. So this is the concepts. Along with this, one more point. With this, we concluded. Actually, up to 8:30. Okay. One thing is, here the point is, in financial management observation, only you concentrate morning class. I told with respect to NPV, XYZ Limited, Cello Limited, another one is Navjivani Hospital. These three problems are very important. But in this problem, only which disparity? Life disparity. You have a cash flow disparity. That cash flow disparity can be resolved with modified NPV, modified IRR. Whereas size disparity can be resolved with incremental NPV, incremental IRR. But total, if you observe the question paper pattern, right, they are asking 10 marks question, 5 marks question, and there would be a MCQs also. Means MCQs they are expecting. For 10 marks question, which chapter we can pick it up means, first you concentrate working capital management, capital budgeting, cost of capital, and leverages also they are regularly asking. This 4th chapter is very, very important. But comparing to leverage, capital structure, they are giving priority for 5 marks. 10 marks they are not giving, because they too know that if the capital structure is asked for 10 marks means they can easily handle this one. And ratio analysis is one more topic is there. Okay. So ratio analysis maximum they used to ask, what is it? Just for 5 marks. See, for ratio analysis also I will talk just 5 minutes. I will give you information. See, every company performs during the year, and any investor or outsiders wants to know the performance of the company. In order to know the performance of the company, what should I do? Should I stand in front of the company? Should I make a shout? Hey, how you are working? If I shout means in window one balance sheet will flow. That means they fly. Means somebody is going to throw, what is that? Balance sheet. By seeing that balance sheet also, I should able to identify whether this is worthable or not, right? So each and every company's how it is going to perform, how it is performing. If you want to know means you must know the knowledge of to reading the income statement and profit and loss account of on balance sheet, all the financial statement of the company in effective way. Unless until you cannot read it clearly, you cannot come to a conclusion. For that purpose, to read and make analysis, there is multiple analysis is there. Funds flow analysis, cash flow analysis, comparative statement analysis, common size statement analysis, trend analysis, via one more analysis. What is that? Ratio analysis. What is that? Ratio analysis. Ratio is nothing but certain numerical values from the given income statement. So by taking that two income statement which has some close relationship, and we will bring some conclusion. That is called ratio analysis. For example, you are a doctor. A patient comes to your office. A patient comes to your office. So what do? You have to make analysis, right? A patient came and just he is stand in front of me and he asked that, sir, I have some health problem. Immediately the doctor gives a prescription. Will he accept? No. Then doctor asks that. Then patient will certainly ask, sir, how, without examining, without checking, how do you give what is that? Prescription. For that purpose, you have to check eyes or you have to check the pulse rate. Basing on that, you have to identify it. And for example, he may ask you that go and get the BP test. BP test, tiskurandi, sugar test, he will ask it. If the sugar is beyond that means, okay, bye, Jai Hind. Because by seeing that rate, we can identify, bhaiya, ho gaya tera kaam to. Abhi tu gaya idhar hi jayega. Bhag ja bachcha idhar se. So while seeing this one, how a doctor can identify health condition of the company, in the same way as a financial manager, we will also identify the same condition. For that purpose, you see, for doctor, patients are the clients. For chartered accountants, companies are clients. Their doctor body will come. Here balance sheet will come. Their body, head, body. For us also, for doctor checks what is that? Head and body. We will also check it. Head is a profit and loss account. Body is a balance sheet. And what is the parts of the body? He will check. Here we will, part of the body is nothing but assets, expenses, revenue, all these things. By studying all these things, we will bring what is that? Some conclusion. For that purpose, there are certain ratios to be identified. Total in your study material ratio, I will give you a simple shortcut to identify. Clap. Ratios, clap ratios. You don't have a material there. Clap, C-L-A-P. Clap is the ratios total available. What is the capital? CLP. What is the C means? Capital structure ratios. L means liquidity ratio. P indicate profitability ratios. Another one is? No. CLA. C, capital structure. L means liquidity. A, activity ratio. Hello. Activity ratio. P indicate profitability ratio. Once you know the knowledge of all these things, being a manager, people will clap you. Without knowing this, if you make analysis, people will slap you. Okay. So these are the ratios. You try to simply remember in your study material, all the ratios you can remember within a second. What is it? Clap. Beyond this, from the capital, you can identify it. It would be very, very easy. But for learning ratio analysis, don't mug up. Because if you start to mug up means you will count what ratios is. This ratio I don't know, that ratio. Array, you don't want to mug it up. Just develop a relationship. Just develop a relationship. Once you develop a relationship means you can identify it. Somebody will ask how many curries are there in the world means? Curries, how many curries are? How should I say? If you pour water, one curry. Okay, without oil, one curry. With vegetables, one curry. You try to understand different curries may form. At the same time, for ratio analysis also, without mugging up, you have to understand some relationship and develop some relationship between income statement and balance sheet and purpose. And first calculate, then analyze, then come to conclusion. This is the very, very important. I would like to say that this way you can remember the ratios, right? So with this, we concluded this part, and I would be available here itself. Still you have any doubts with respect to this? So you contact the sir. I will be available. Right, ma? Jai Hind.